Hello, and welcome to the third annual SOSV Climate Tech Summit. My name is Sabriya Stukes, and as Chief Scientific Officer of IndieBio New York, I'm honored to be your host for the first day of the summit. With locations in both New York and San Francisco, IndieBio is an SOSV startup development program that funds and supports scientists building solutions for human and planetary health problems. I'm so excited to kick off this summit. The sessions over today and tomorrow will highlight some of the most important discussions and topics in the climate tech world today, while at the same time showcasing the work of many founders and investors in this ecosystem. Our hope is that the insights shared at this summit will bolster startups and investors in their common and vital task, the task of a generation, fighting climate change. If you're watching me, you're already on our summit event platform, which is called Hopin. Before we get started, a few quick points on how to use it. You are watching the stage. All the main programming, firesides, and panels take place here. These have been pre-recorded. We also have another area called Sessions, which is where VCs and other special guests are presenting to founders and taking questions. These are live. You can find both the main stage and Sessions on the schedule, which is under the reception icon in the left navigation. Another important feature on Hopin is chat, which you should be able to see on the right side of the Hopin screen. You can message individuals or all the attendees from there. Our SOSV moderator is pinned at the top of the chat, so please direct any questions or concerns there. Lastly, in the left navigation, you'll see Networking, which is where you can try your hand at randomized networking with other members of the climate tech community. And just so you know, we will be posting all the main stage sessions on SOSV's YouTube channel right after the event is done. So if you want to jump to a live breakout session or you get called away from a meeting, you can always find the sessions you missed online. One more thing, I'd like to say a big thank you to Goodwin Law, our platinum sponsor. Please join their breakout session to hear from their top-notch climate tech legal team at 9:30 a.m. Pacific, 12:30 p.m. Eastern. Now, I'd like to introduce SOSV's founder and managing general partner, Sean O'Sullivan, to say a few words.
Thank you, Sabriya, for hosting day one of the SOSV Climate Tech Summit. This is Sean O'Sullivan, and I am speaking to you from SOSV's HAX office in Newark, New Jersey. We have close to 9,000 people registered for the summit, which represents nearly 50% growth over last year. That's a pretty good indication that this summit, launched 2 years ago, really benefits the climate tech ecosystem. It probably also shows that the ranks of climate tech founders and funders are growing fast, which is exactly what we all need. So, welcome to all of you. The state of the art in climate tech is changing fast, and we'll be bringing you top insights and insider knowledge from many of the world's most knowledgeable experts. Members of the SOSV team have been working hard on this production for months. We are all super grateful to the more than 100 speakers who lent us their precious time and expertise, which we'll see in a record 20+ hours of content this year. The agenda draws from all corners of the world, from Iceland and Kenya to India and Argentina. In addition to the classic topic of this event, what are early-stage climate VCs thinking? We'll have lots of new topics like first-of-a-kind financing, critical minerals, adaptive agriculture, measurement of all things climate, our new relationships with electricity, and how to get a job in climate. Plus, we have live Ask Me Anything sessions, AMAs, with partners at venture firms like Khosla Ventures, Energy Impact Partners, ARPA-E, The Engine, Pale Blue Dot, and many others. These are great opportunities for founders to ask the check writers direct questions interactively in real time. I'm also very excited about the invitation-only SOSV Climate Tech Matchup, which runs in parallel with the summit, also interactively and in real time. We started the matchup last year, and it was a huge success. This year, it's even better. We have 1,500 VCs and founders registered, and it's clear they are on track to have literally thousands and thousands of meetings before the week is over. All that is so awesome and such a perfect fit for our purpose here at the summit, accelerating the development of this climate tech ecosystem, helping create a community of dedicated founders and funders so we can all turn this climate catastrophe around. Looking back over the past year, it's amazing how much the climate world has changed since the last summit, just 11 months ago. Remember back then? The ink was barely dry on Biden's IRA climate bill. Climate investors were writing record-sized checks. And in the energy world, all eyes were on Russia's invasion of Ukraine. The big macro driver today is higher interest rates, which finally popped the venture bubble, not to mention two of the world's largest VC banks, Silicon Valley Bank and First Republic. So it should come as no surprise that VC-fueled boom times are, at least temporarily, over. Climate VC, though stronger than the general software VC market, has been affected. The first half of 2023 saw a 40% decline in funding, most of that coming from later stage big checks. Across several panels with VCs at the summit, we discussed that shift and what it means for climate startups. The too long didn't read summary? No one's overly worried. The capital is still there. The slowdown is a reflection of the new and warranted caution in VC and institutional investor circles. And actually, the pace does seem to be picking up in this last half of the year. Another big twist to the past year has been the stunning impact of the Biden administration's Inflation Reduction Act, also known as the Climate Bill. Just 13 months later, we're seeing the huge effects of this historic bipartisan legislation. Since the bill's passage, there have been more than 200 projects announced, $88 billion committed, and almost 80,000 new jobs created, according to E2. And it's just getting started. The other really big shift in the past year is not easy to characterize, but it amounts to this. The big high-level conversations about climate in years past, how to decarbonize and who will pay for it, are now touching down on terra firma as a result of the IRA, growing corporate involvement, shifting public sentiments, and of course, startup investments and the new technologies. It's really happening. We are really building now. Inevitably, things will get messy as the rubber hits the road and founders discover problems and conflicts and setbacks in real life. But repeat after me, that's a good sign. That's what comes with doing the engineering. We've moved this from talk about doing things to doing things at scale. Take the U.S. electrical grid, for example. We are lucky to have Princeton's Professor Jesse Jenkins to talk about the U.S. power grid, the vital and historically underinvested power infrastructure that will make or break the future of renewables and electrification, as well as make it possible to keep people cool in the decades ahead. Can all the regulators and special interests somehow stand aside so the U.S. can create the grid we need to enable more rapid development of renewable energy? For controversies, we have to look no further than the debates around investing in carbon capture startups and plants, which the Biden administration is backing not only with tax credits, but also direct carbon purchases. Is direct investment in carbon capture a necessity to reach net zero by 2050? Or is it a backhanded way to ease pressure on oil producers in the energy transition? That's a hard one. But it's also a great sign that these disputes are happening in real time, involving real deployments and substantial investments. At SOSV, we don't have all the answers, but we do know one very important thing for sure. It will take hundreds of shots on goal to find the dozens of startups that will provide the transformations necessary to change our means of production, of energy, of food, of materials, and of the built environment. A few of these will become the highest impact climate startups of the 21st century, the names and brands that become the iconic technologies that change what the future looks like. Like the pioneers we all know in the information technology brands formed in the late 20th century, Apple, Microsoft, and Google, these technologies will change how we live our daily lives and power financial revolutions, new economies, and a greater quality of life for all. Climate tech, by its nature, needs to be affordable and universal enough to work in every economy. Unless every one of us can incorporate these technologies in our daily lives, none of us will be able to thrive in a choking and drowning and starving planet. By doing so, we have to reimagine industry for a sustainable and more equitable future. SOSV, like the hundreds of other VCs attending this conference, is all about helping founders take that shot. At SOSV, we invest and launch dozens of new climate startups each year across our IndieBio and Hacks deep tech startup development programs, which is why SOSV consistently tops the leaderboards for the most active climate tech investors. SOSV keeps investing, advising, and cheering on our founders all the way from pre-seed to IPO. You can learn more about how SOSV's IndieBio and Hacks work in the SOSV Ask Me Anything session at 10 a.m. Pacific, 1 p.m. Eastern. Founders out there, please join my colleagues, Dr. Pei Wu and Dr. Susan Schofer, for a live overview of our programs, including a Q&A. So, at the start of our 2023 SOSV Climate Tech Summit, let me say, welcome to the new world of climate tech. It's more real, more on the ground, more in action in the economy, and more important to the world than ever. We should welcome that. The responsibilities for all of us as technologists, as investors, as entrepreneurs and policymakers has never been more imperative and urgent. So, let's get on with the summit. Thank you.
Thanks, Sean. It's always great to hear your take on this moment in climate tech and investing. Now, let's get the third annual SOSV Climate Tech Summit underway with our first session, the outlook for climate tech investing. Climate tech investing really soared over the past 2 years, but this year, so far, it's tumbled quite a bit. As our friends at the climate tech media and research company CTVC reported, climate tech funding fell 40% year over year in the first half of 2023, with late-stage and growth-stage investments seeing the biggest slump. Yet, the number of deals climbed 8% year over year, driven by early-stage funding. Notably, repeat climate tech investors joined fewer deals, while more generalist investors stepped up their participation. These stats led us to ask so many questions. What do climate tech VCs make of these shifts? Have the conditions for follow-on funding, scaling, and deployment changed? How has the Inflation Reduction Act impacted their portfolios? To answer some of these questions, we've gathered 3 of the most experienced climate tech investors around in discussion with our moderator, John Schieber, former climate editor at TechCrunch and partner at Footprint. Take it away, John.
Thanks, SOSV, and thanks to all of y'all for tuning in for what should be an amazing panel. We are looking at a very important topic, which is, what's going on in climate tech VC right now. And the title of this panel is Climate VC Still Exuberant, which, may be a bit of wishful thinking or maybe spot on. But to help me answer this question and to help us think through the topic of what's new in climate tech right now, we have an amazing panel with Gabriel Kra, who is a managing director at Prelude Ventures, Christina Parapataki, a partner with Breakthrough Energy Ventures, and Rachel Slaybaugh, a partner with DCVC. Now, I'd like you all to just, for folks in the audience who may not know what your funds do and what they're about, it'd be good to give a bit of a brief introduction about how y'all think about both the investment space right now and what your funds are doing within it. So Rachel, if you want to start us off with a brief explanation of DCVC and how it's thinking about climate, that'd be great. And then Gabriel will go to you, and Christina, you can take us home on this one, these intros.
Yeah, sure thing. So DCVC is a deep tech firm. We've been around for about 12 years, and we've been investing in climate for a long time alongside other sectors. We just haven't necessarily always flagged it as climate in the intervening years since Climate 1.0 or Clean Tech 1.0. So our sort of flagship fund is Seed and Series A. We sometimes will incubate companies. We often lead, and we have a new climate-specific later stage fund that's Series B and later. And there, we lead, we don't lead, we take board seats, we don't take board seats. It's kind of whatever's best for the company at the later stages because it varies a little bit more. Yeah. And our check size ranges from about $250K to about $30 billion. in the climate space. And so we invest sort of across climate technologies. We'll do adaptation, we do mitigation. I think that's it.
That sounds great. And thank you so much for dropping in with us from the airport, where I think our audience will see various and sundry guests coming around you as special guests as you answer some of these questions. So we really appreciate you taking the time. Gabriel, what about what you're up to at Prelude? How should folks think about y'all as an investor?
Sure. Well, thanks, John, for bringing us together. Nice to see you, Rachel and Christina. And also very big thanks to SOSV and all the people over there for hosting this fantastic event this year and in years past. Prelude. We invest in and support early stage startups with the highest potential to mitigate climate change. We seek out purpose-driven founders, and our goal is to provide them the capital and the expertise needed to build the next generation of category-defining businesses that are going to reshape our global economy for the greatest good of people and the planet. For us at Prelude, climate is everything. We've been doing climate for a long time. We look forward to doing climate, unfortunately, for a long time in the future. But if we ever work ourselves out of a job, that would be great. I said climate is everything. We invest in a lot of categories. We invest in the built environment. We invest in carbon management, which is a big catch-all. We invest in compute. We invest in energy, which is kind of what people think of as clean tech 1.0. We invest in food and ag, which is fairly self-explanatory. We invest in manufacturing and industrials, and we invest in mobility. We, at Prelude, we share a broad commitment with our founders and with the co-investors in the ecosystem that we work on to a real commitment to climate. We understand the enormity of this challenge and what we're trying to do here, and we are really seeking out visionary climate heroes. That's how we view our job.
And what a job it is. And Christina, I'm going to get you to take us home with a brief introduction into what Breakthrough is and does. I guess specifically we can focus on Breakthrough Ventures, because I know that there are lots of different aspects of the whole Breakthrough project.
Yeah, absolutely. Thank you, John, and thank you very much to SOSV for bringing us together on this great panel. So you're right. With Breakthrough Energy Ventures, we have $2 billion under management, and we're a climate-focused venture fund. We've invested in more than 110 companies so far, and we focus on technologies and companies that can significantly reduce greenhouse gas emissions. And for us, that's 0.5 gigaton of CO2 emissions per year. That's about 1% of global emissions. So we're looking for sectors that can have a huge impact in terms of reducing emissions in the environment. And we're company builders. We like to invest early. We go in seed, Series A, a few Series Bs. But we like to invest early and work with those founders and build companies around them. And as you said, John, Breakthrough Energy as the whole organization has a number of other pillars, from fellows to policy to partnerships to Catalyst. But for this conversation, we'll focus on ventures. And some of the areas that we invest in ventures is electricity, transportation, manufacturing, buildings, and food and ag. And for us, it's all about partnering with the founders and building the company alongside them from the early days.
So the focus of this panel, or the title of this panel, is Climate VC, Still Exuberant. And I guess I'd like to go around the horn and get your take on just a simple yes or no about whether climate tech or climate VC is still exuberant right now, and where you think it is. So we'll start, Gabriel, with you. Is it or is it not an exuberant time for climate tech in the market? Yes or no? Very simple.
Yeah, it's not a simple question. and also, I think it's a funny question. And the funniness is all the way to, is it still exuberant? A bunch of different ways I think about to answer it. So assuming it once was exuberant, look, since then, whenever that then was, a year ago, say, tech markets are down and down dramatically, especially if you still choose to admit Apple, Microsoft, Nvidia, Meta, Amazon from that tech index, then the tech markets are still dramatically down, I think, from their highs. Interest rates, the risk-free rate went from 0 to 5%. So, of course, any exuberance that was there in capital investing has been dampened by those two simple, very correlated, very related facts. So everything, all capital is more expensive. But, to borrow a phrase, we had a bit of irrational exuberance. I talked about this with other people a year more ago, that things, what goes up must come down. So we're certainly not where we were a year ago. And I think a lot of funds, a lot of investors have gone from a strategy of putting as much capital to work as quickly as possible to, we got to protect ourselves. We got to correct valuations. We got to preserve capital. We've got to make sure that the positions we took in the prior couple of years are still good positions. And a lot of revaluations and recapitalizations have come. I think the biggest change has come in the later stage funds. Those entities as money managers need to look at public companies and other late stage companies as their valuation comps, and those things are just down. That said, at Prelude, we are still wide open for business. We invest in seed companies. We invest in A-round companies. We have well over $1 billion of that phrase dry powder to invest. And when you're investing at those early stages in companies with 5 or 10 years to when they're going to sort of grow into a big business, you can be you don't have to pay as much attention to the vagaries of the market over a 12 or 24 month cycle. And I'd urge entrepreneurs, when they're thinking about this question, to sort of look at their investors. Have they been around? Do they get the long-term nature of the commitment? Do they get the long-term challenges? These are people you're partnering with. And if some people are not as active or not supporting their companies, you should think about that hard, the why, and look into it. Right. I'll stop there. I think there's another way of approaching this problem. Right. Maybe we can.
Well, so Christina, and then Rachel. Christina, do you have any sort of alternative point of view, or do you agree with Gabriel's position that this is maybe the period of over exuberance or exuberance is done, and we're entering a sort of more rational phase for climate investing?
Yeah, but overall, I do agree with the point. I do agree that the market is definitely not as exuberant as it was a year and a half ago, for sure. And in addition, we're seeing a lot of the rounds taking longer, right? We're seeing fundraising rounds that might take 8 to 10 months to come to completion, compared to the era of exuberance where we were seeing fundraising rounds take a month or two to come to completion. We're seeing lower step-ups, or some of the corrections for sure, that Gabriel mentioned. And the other thing we're seeing is that strategics tend to play a little bit more of a role, especially if you're talking to those Series B companies, Series C companies that have raised the high valuations over the last couple of years. We're now seeing the ones that can still successfully raise large rounds to have strategics play a fairly key role in leading some of those syndicates. So bringing some of that comfort for financial investors to jump in. But I do want to also offer a little glimmer of hope. If you look at the last 2 to 3 months, you can see some fairly large rounds come together. You can see the Redwood announcing $1 billion round last week. You can see Iceland Materials as well announcing a super large rounds. So we're seeing a little bit of the turn, but it's definitely slower, and it's definitely fewer number of deals, but those large financings are still coming together.
DCVC as a fund is broadly focused on deep tech, but clearly the LPs and your partners have seen an opportunity to do later stage investing around climate stuff. what is the opportunity set that y'all see specifically around later stage?
Okay, I'll try to get all of that. So we still do early stage in climate, but part of why we wanted to do the later stage climate fund is in part because there's a bit of a gap there, or what we, and I'll give Albert from Union Square Ventures credit and writing a good blog post about this. It's really aligned with what we see, is that people who have knowledge about climate and are investing in sort of Series B, Series C, there's just not that many. And we think if these companies are actually going to get to commercialization, that gap in the funding ecosystem really needs to be filled. So from a climate outcomes perspective, like companies need to get funded. From a fiduciary duty perspective, when there's fewer investors, we can get good deals and pick this on cars if there's less competition. But we think it's a really interesting place to be, because this is where the technical idea sort of converts into commercial reality. And so it's an exciting place to be. How it is in the market right now, in climate specifically, it's okay. I mean, Gabriel and Christina have talked about this a little bit. It's getting a little bit better. But to give credit to the government, the Inflation Reduction Act, the creation of the Office of Clean Energy Deployment in DOE, all the work the Loan Program Office is doing, Breakthrough Energy Catalyst coming online. There's a lot of these finance structures specifically for climate tech that are helping to buttress the ecosystem in the face of a bad market. And so that means some of these companies are able to close these big rounds and get project finance. And don't see that necessarily in other sectors. So it's not exactly exuberance, but I think that we're getting really serious about the climate problem and starting to put the things in place so that even in a market downturn, companies can still move forward. So hopefully that addresses some or both.
Right. Well, it addresses some of them, and I will touch on the capital stack later and sort of the funding mechanisms that y'all recommend for first of a kind projects, the kinds of things that are coming online that involve new technologies. But I did want to touch on
Series B and Series C. That's just a lot of what we are thinking about is what's the path forward for these companies and where are they going to get finance in the long run. And then for water.
No. That's where I wanted us to go. So
So we haven't done any. Our water companies haven't made it to the later stages yet, but we view this as a larger sustainability and to some extent climate adaptation. So we really want to do everything we can to prevent, slow down, reverse climate change. We also are recognizing that we're not succeeding at that super well. And so what are the technologies that we're going to need to survive and thrive in the face of a changing planet? And water is essential for most things. So our premise is that water is going to be increasingly important, and there's some really exciting technologies that can improve water quality, reduce environmental impact, and maybe change the game for some industries that have additional benefits. So that's kind of our water thesis.
Gabriel and Christina, am I wrong in this assumption that the focus really is on sort of mitigation and carbon removal and things or methane or just greenhouse gas emissions broadly? Or are y'all starting to think about sustainability, or have you been thinking about sustainability through a larger lens?
Part of that statement is right? If you look at our portfolio, a lot of it has been focused at mitigation. And a lot of our portfolio companies have been active in that space, but I think there is a fine line, and now we're definitely expanding the lens to look at adaptation as well. But we have been looking at food and ag since the day one that BEV started investing to a certain extent. That falls in the adaptation category as well. Companies like Pivot Bio that enable you to have more fertilizer uptake. That is actually a co-investment with Prelude and would be with all three of us, right? So I think there's just a conversation where we're now expanding the horizon. But if you look at a lot of the existing companies and what companies in the climate space have been doing, I think it falls both within mitigation and adaptation in many cases. It's just people now are paying a lot more attention. And it probably will make us deploy a lot more capital in sectors that we invested before, but not as heavily. Things like fire prevention and fire mitigation, things like the one I mentioned in fertilizers with Pivot Bio. I think it's just making us focus a little bit more and deploy in a more concentrated way in those areas.
Gabriel, anything?
Yeah, I'm going to stake out a little bit of space between Prelude and the other two firms here on the call. We're not doing adaptation, period. We are doing mitigation, and that doesn't mean that adaptation is bad or that and it certainly might be a great place to invest. It's just not what we're investing in. Yeah. And we're not going to pivot, excuse me, towards adaptation. And I would argue, look, we're looking for big, massive, profitable companies. Our theory of change is that if you invest in a company that becomes, even if it's really good for carbon or CO2 equivalents, and it's just becomes a small company with a small outcome, well, then you didn't really change much of anything on the climate front. Right. But if you invest in a company that has the potential to have a massive impact, but it can't grow into being a big company because it can't be profitable, well, then that's not an investment. That's philanthropy or something else that we don't do at Prelude. Right. And so, just to pick an example, Pivot might have some adaptation kind of benefits to it. But if you use Pivot instead of using fertilizer that was made from nitrogen that was sucked out of the air with the Haber-Bosch process from natural gas that was sucked out of the ground, like you just avoided, I don't want to, a whole mess of, I think the number that comes to mind is about a half of 7% or 5 to 7%, which is emissions that come from fertilizer. And we can dive into why I say a half of a half, but that's still a whole lot of global emissions that you've avoided.
I'd like to touch on the exit conversation for a while, because there were a number of climate tech companies that exited during the SPAC boom over the past couple of years, and their performance has been not great. Now, has that impacted sort of valuations for other companies in that sector? Is the sense that like the timing was just off there and we'll see these companies, start to catch in the next few years? What do you think of the exit market right now, I guess is the question.
Sure. I think everybody's staring at ARM, Instacart, and what's the third one that's going public? And we're thinking that the exit market for the next 12 or 24 months is to be written. I guess ARM had a pretty good aftermarket or after issue performance yesterday. So one day we can be exuberant again. Let's go. More realistically, I think just markets in general, public and otherwise, are going to be choppy until the election, if you ask me, because I don't think the full macro shakeout will have happened before we're into 24, and then once we're in 24, all eyes are going to be staring at November. So I think it's post-election when people have certainty one way or another that things start to really normalize. But public markets have a way of humbling people who are even experts in them, and I don't claim to do that. Right. So what we do, what we think about, and this sounds trite and it sounds weird, but we try to think about building really good companies that can get to cash flow, that can get to profitability. It can be a long horizon, it can be a short horizon. That's what Rachel was just kind of talking about earlier. But think about building a quality company. Don't think about building it to flip it. Don't think about building it to take advantage of an IPO window that may or may not be open when your time to get there. Build a good, big company with great teams going after really big markets to solve really hard problems, and you'll get your exit when you get your exit.
For us as well, I mean, we're going after massive market opportunities, right? Whether you're looking at that, and we're a long-term investor, and we know these things will take some time. So whether you're looking at decarbonizing steel or decarbonizing hydrogen or changing power infrastructure and transmission infrastructure, these are massive market opportunities that will take some time to develop. So we don't see specific points in the public markets as affecting our strategy. We believe that climate is a humongous opportunity, that we're in it for the long haul.
Are there any sectors that you would advise companies or entrepreneurs to shy away from now? Or is there anything that's sort of not a space that's investable, or is everything still on the table, whether it's novel photovoltaic technology, new, like wind turbine designs or structures, is there anything that's off the table right now, or is it still like if there's an innovation, it's worth looking at?
Game-changing innovation is always welcome. Some of what we think about as climate has become a really popular space, it's just where is something really differentiated. So there are spaces that are interesting, but very crowded. So it's not that people shouldn't work in them. It's just for us, like a new battery chemistry is a little bit difficult to invest in because there are so many new battery chemistries and they're all solving something slightly differently. So if you're going to do something in that space, like what's the breakthrough that is super different, that really stands apart? And similarly for something that now that solar and wind are kind of commoditized, are you doing something that is game-changing, that's really going to take the economics? Does it have a meaningful path to adoption? For solar, most of the cost is in installation. Are you transforming installation? So I don't think there are sectors that are off-limit. Everywhere can be disrupted with innovation. So when people are, what are they working on? It's how does it really fit in the system, and how does it really change the game, and how is it really different from everything else? Because there's so much cool stuff. But similar to what Gabriel and Christina said, we really want things that are going to move the needle. If it has to, how is it going to do that?
No, to us, it's not a specific sector that we would exclude. That we would look at the technology. Is it unique? Is it differentiable? Is it defensible? Is there a product down the line, right? Versus this being a research innovation in the lab? Is there a need for it in the market? And are you going after a large enough opportunity with a unique team? And in fact, always pairing up the business side along with the technology. So I wouldn't exclude sectors, but there's a lot to going into whether we think a particular company or technology is investable.
Yeah. Gabriel, do you want to take us home on this one?
Sure. I think you always take a look. When you find a compelling entrepreneur or a compelling, more accurately, a compelling team, you always take a look. You highlighted too. I'm not going to, you have a long run to get me excited about a solar cell module panel manufacturer today. And you got a lot of convincing to do if you tell me you're going to design and build a wind turbine that a startup, that an early stage company can have a big impact. I can point out some other sectors. I'll stake out some, like you'd have to be a really bold person to be wanting to start a new company right now in nature-based carbon removal. Throw a little spice into the very end of the presentation. I'll leave it at that.
We didn't talk about sort of the challenges that these deep tech, hard tech companies face when it comes to non-dilutive financing to get things built and get things done, and even like permitting and regulation and citing some of this stuff. Rachel, y'all, bless your hearts, are invested in a nuclear fission company that's doing small modular reactors. And that is a tough road to hoe with the Nuclear Regulatory Commission and everything else. And I know that everyone's invested in some flavor of fusion as well, I believe. So as you think about the amount of money it's going to take to get some of these things into commercial production, how much of that is going to come from equity financing? How do you think about first of a kind projects? How do you think about citing and regulatory approvals for some of these new things? I know this is a vast area to cover and we don't have a ton of time, but I'll just go around the horn, starting Christina with you, Gabriel then you, and then Rachel, how y'all are thinking about, what are the best ways for startups to start navigating these issues, and when should they start thinking about them?
Very early in their product development and engineering, especially if the company is going to be deploying projects and plants in order to get their technology commercialized. But credit to the government. Again, we're seeing a lot of non-dilutive funding, especially with things like the CCS hubs, the DAC hubs, and the hydrogen hubs. So we're seeing a lot of opportunities with non-dilutive government funding. But there is still a gap in the market for how do you build and how do you finance your first of a kind plant? And where does that money come from on the cap table? Is it construction debt? Is it project financing? Is it not dilutive? Is it equity from the top co? And the way we look at that capital stack, it's all of the above in different ratios and different percentages. We see the startup itself always needing to put some top co capital into the projects. But in terms of project financing, that's why we created Breakthrough Energy Catalyst. The whole purpose of that vehicle is to finance project opportunities. They need to be commercial scale. They need to have an off-taker. They need to have a client. But they're willing to take the first of a kind technology risk, an engineering risk, where we're seeing some gap in the market in terms of traditional project financiers being able to come and take it. But the only way that program is successful is if we enable traditional project finance to also come in.
So Gabriel, when y'all are investing in an early stage company, seed, Series A, whatever it may be, are you advising them to start thinking about like alternative capital structures from the jump, or which government programs they may be able to access, even as they're designing or sort of piloting their initial technologies? Like, should they be thinking about things in parallel? We are developing this project. We are also going to be then thinking about financing for it.
Yeah. I mean, the answer to your question is yes, they should be, but you might as well ask, and I don't mean this negatively, but like literally, you might as well ask, are we asking our entrepreneurs to be entrepreneurial? I fundamentally don't think that there's that. I don't think that the difference is as big between climate tech companies generically and enterprise software companies of the 2000s in terms of capital intensity, in terms of overall capital requirements. Look at how much money Salesforce raised before it was ever profitable. Look at how much money Amazon raised before it was ever profitable. Look at the money those companies and still do, sink into data centers, the hyperscalers. Now there are massive big differences in terms of how investors were able to look at those businesses and understand the economics of the business, even though they hadn't been proven out. So you can push back on what I just said, but the capital and the pathways and the structures, they're there. It's available. And yeah, we work with our entrepreneurs from the get-go to think about it and to develop strategies and tactics to access them. But I think really great teams figure it out and get it done, just like they have historically in early stage company building.
Rachel, I'm going to ask you to take us home for the entire panel, but with a slightly different flavor on the question. So if government funding is one way that things can get done through the loan programs and various other things, when should companies start thinking about partnering with or working with like corporates or corporate venture capital arms that can help move some of these things along, either from a strategic perspective or in partnerships or what have you?
Yeah, I'll say there's no one answer because different sectors are different. One of the things that we try to advise our companies, try to adhere to, is that if a strategic is going to come in, that they need to be a customer first. Now, again, this doesn't always make sense. So basically, they sign an offtake agreement, they become a customer, or perhaps they lend some very specific knowledge to help the company improve so that when they invest, they're basically benefiting from the upside they're helping to create. So we try to make sure basically when strategics are coming, they're really adding value, because there can be a lot of complex incentives of why different kinds of corporates or strategics might come in. So there's just a lot to, it's not a simple answer. But especially the further along they go, those partnerships it's more frequent that those partnerships are easy to align. So I think we're more often in those conversations with later stage companies where corporates have big checkbooks and they can be very well aligned.
Thank you, SOSV, for giving me the opportunity to chat with these incredible investors. Thank you so much again for y'all's time.
I doubt anyone was surprised by that upbeat outlook. After so much rapid growth, maybe this year was a good time to take stock and reflect on the changing landscape. By the way, I am speaking to you from the offices of IndieBio New York, which is at 7 Penn Plaza, right in Midtown Manhattan. We built out a modern facility that opened late last year with the support of a $25 million 5-year grant from New York State. The 25,000 square foot office includes this beautiful meeting space where I'm standing, as well as a biosafety level 2 lab and office space. We welcome dozens of new companies here each year to build alongside our SOSV general partners and expert team. If you're a founder interested in our program, please check out our website at indiebio.co for more information. And now for our next session, the IRA 1 year in with Jesse Jenkins. When Princeton's Jesse Jenkins releases a new report on net zero pathways and policy, the climate tech world pays careful attention. Jesse and his team at Princeton University's Zero Lab first made headlines in 2020 with their report, Net Zero America. It showed, among other things, that the US must electrify everything possible to achieve net zero emissions. From the New York Times to Mother Jones to the Wall Street Journal, Jesse continues to argue for mass electrification, but warns that without upgrades to the US electrical grids, that won't be possible. For this conversation, our moderator is Robinson Mayer, the founding executive editor of Heatmap, a terrific new media company focused on climate change. He's also a contributing opinion writer at the New York Times. Over to you, Robinson.
Thanks so much. I want to welcome Professor Jesse Jenkins, who's a professor of energy systems engineering at Princeton University and the director of the Zero Lab at Princeton, which produced some of the best analysis of the IRA before and now after it has passed. So welcome, Jesse.
Thanks for having me. It's good to be back with the SOSV crowd.
I want to, start out just by asking the question of the moment, which is 1 year in, how do you feel the IRA is going?
Yeah, I think it's going pretty well. It's an interesting point in time because we really are just at the point where money is starting to flow and the rules have really started to, come into crystallization. I think a lot of folks think the law passes and then, we're off to the races. But of course, what the Inflation Reduction Act does is effectively puts clean energy on sale through a variety of tax credits, grants, loan guarantees, rebate programs, et cetera. And every one of those has to be implemented by a federal agency. The Treasury Department in particular is in charge of all of the tax credits, which is the bulk of the spending and probably impact of the legislation. So they've been working overtime, trying to get through a number of guidances or rulemakings to clarify how a number of the brand new tax credits are going to operate, things like hydrogen tax credits or sustainable fuel credits or other things, as well as all the kind of modifications of the existing credits. So like the wind and solar production tax credits have been around for decades, but the law substantially modifies them, tying in, prevailing wage and apprenticeship requirements to claim the full credit, offering new bonus incentives for domestic content and deployment in certain energy communities. So all those rules have to be written, and they're starting to come out. Every week we see new ones coming out. And then if you go over to EPA or to the Department of Energy, which are in charge of a lot of the grant and loan programs, and once again, every one of those programs has to have rules written. They have to have an RFP. They have to get proposals in, and then they have to select the winners of those programs. And so once again, every week there's a new announcement of $1 billion for this and $10 billion for that. And we're starting to get to the phase where some of those grants are being awarded. and actually going out the door. And so, it's interesting. This first year is a lot about setting the stage. And really, I think the next 3 years is where we're really going to see like steel in the ground and the rubber meet the road. But what we are seeing is a lot of announced projects. And so that's where we're starting to see the kind of leading indicators of where things are going. Is huge number, tens of billions of dollars of announced investment in everything from wind and solar to manufacturing facilities for batteries and EVs and wind and solar components to hydrogen production facilities, carbon capture pipelines, et cetera. And so, if the goal of the bill was to kind of put Uncle Sam's thumb on the scale on the side of the clean investments and purchase decisions, it seems like that's what's happening, and we're seeing that response from the private sector and from consumers, adopting electric vehicles and things like that.
I want to go back to this idea of clean energy on sale in a second after a few more questions. But I think let's start by asking, what of that whole mix do you feel like is working best right now?
Yeah, I'd say the electric vehicle transition seems to be moving at or faster than the pace that we were projecting or expecting to see. With a pretty strong commitment from the whole industry now to transition. I think the writing's on the wall, both globally and in the United States now, that, by 2030, the majority of vehicles sold are going to be electric in the US and over the majority globally. We're already about a fifth of all vehicles sold throughout the world are electric now or plug-in. And so, these automakers are finally realizing, in some cases reluctantly, but in other cases more proactively, that this is where the future, and they need to be investing heavily to make that transition. And consumers are starting to really, the adoption rate is going up. And I think there's lots of, there's lots of hand wringing initially about whether there'll be enough EVs and the supply chain, coming online. Now we're seeing that the supply chain is developed and, auto manufacturers are kind of hitting their production run rates. And now there's hand wringing about there being too many vehicles on the dealer lots. And that's which is it? But, this is a big transition and it's picking up steam. I think we're seeing that in the numbers on a regular basis. The other areas that we're seeing is a huge response on the manufacturing side. So one of the things that IRA is trying to do, in addition to making clean energy just the smart financial decision for businesses and households, is to drive much more production of critical supply chains in the United States or in allied countries. That's to build resilience, but also to create jobs and build the political durability of the legislation, I think, and the clean energy transition more broadly. And so there we're seeing huge, announcements as well. Every week it's like a new manufacturing facility for wind components or solar panels or cells or EV batteries or assembly. And those are spread across a good chunk of the country too. And so there's, quite a diversity in the locations that are benefiting there. It looks like solar PV deployment is on track to double the previous record deployment rate in both this year and next year.
In the U.S.
In the U.S., yeah. So that's really encouraging.
Because I feel like up to now, we haven't had a great sense of how this is going to trickle into the electricity sector.
Yeah, that's right. So we saw about 20 gigawatts of deployment in 2022 of solar PV. I think the EIA is now projecting close to 40 gigawatts per year this year and next year. So that's great. I mean, that's sort of exceeding the pace that we were expecting from our modeling of the Inflation Reduction Act. The flip side of that is that wind is only going at about half of the peak rate that we've seen historically. So we hit about 15 gigawatts in 2020, I believe, of wind deployment. That was right as the production tax credit was sort of winding down. And unlike the solar credit, the investment tax credit, the PTC for wind actually fully expired. And so I think we kind of cleared out the whole pipeline of projects. And we're still rebuilding that now in response to the new policy environment. That plus headwinds around supply chains and siting means that the EIA is projecting only about 6 or 7 gigawatts a year over this year and probably next year as well. And so that's, wind is lagging behind, solar is running ahead, and that, maybe on net we're running about right in terms of new clean electricity supply.
You kind of anticipated my next question, but let me just skip over, what are you nervous about, and kind of ask, how much of that wind slowed? I mean, you kind of just explained it with the wind tax credit expiring, but how much of the wind tepidness we're seeing is from policy factors, and how much of it is from these troubles that the offshore wind companies are having? And even in your projections, were you thinking most of our near-term wind capacity was going to be onshore or offshore? Just what was the mix? Yeah,
we expect most of it to be onshore still. Offshore projects are, gathering steam in response to state mandates and incentives are all up and down the eastern seaboard now. But really, if you look at what's just sort of the most economic, I mean, offshore wind is still quite a lot more expensive than onshore. So really we're seeing that driven by these state policy commitments to try to build these industries up from scratch. Until that's established, that this is going to be, it's going to be fairly expensive to build offshore in the US. We have to build whole new, offshore service industries and supply chains to support those industries. The onshore sectors, has been around for a long time, and again, it's gone through booms and busts as the PTC has expired and been extended. I think there is an impact of the fact that we had a full expiration and the supply chain, the pipeline kind of was emptied and now has to be rebuilt. But I don't think that's all of it. If you look at, we saw inflation and real cost increases in real dollar terms in wind, solar, and lithium-ion batteries in 2021 and 2022 for the first time ever, really, since we started. We have these sort of consistent downward cost trajectories for those technologies, and they reversed themselves a little bit in 2022. Already, we're seeing that for batteries and solar, costs are back down again below the 2019 levels and 2021 levels. And so they're kind of back on trend, but that's not true for wind. We're still seeing, price elevation, from inflation and limited supply chain, redevelopment in the wind sector. And it's not clear how much longer that's going to persist. The wind manufacturers were all losing money even before inflation. And so they can't really absorb a lot of that. I'm a little worried that, sort of a combination of the greater challenges of siting wind farms, given just how much more visible they are, their reliance on transmission, which they tend to rely on much longer distance lines than solar does on average. And these sort of supply chain, challenges mean that we may have, the wind run rate may be a little lower than would be ideal, or that we would sort of see in an economic optimization.
How much? You mentioned that one of the ideas of the IRA is to put clean energy on sale. How much is the rate environment affecting any of these deployments? It doesn't seem to be affecting it in EVs. Let's say, if I could editorialize, from what I can tell, the EV deployment's happening, on roughly the rate, I think, on actually an even better rate than one would expect. But in renewables, I've heard it starting to bite. So are we starting to see that? Is that a reason to be concerned?
It is a reason in general to be concerned. We, in the sense that almost everything we're talking about, whether it's a heat pump or an EV or a wind or solar farm, is replacing capital for fuel cost. Right? We build a wind farm or a solar farm. It's all upfront capital investment. And then over its life, it displaces a bunch of natural gas or coal-fired power that we would have otherwise needed. And it delivers its savings that way. Same with an EV, right? It costs a little more upfront to buy, although the tax credits help knock that down. And then over the life of your, ownership, it's costs about half as much to, fuel and maintain as a conventional vehicle. Same thing for a heat pump, or efficiency upgrades at your home. And so to the degree that those are all, most of that is financed upfront, having interest rates at 7% as opposed to 2% really does make a pretty significant difference in the relative cost. And you don't see that. You see its own volatility in the fuel markets, right? We've gone way up, after the war in Ukraine began, and are still elevated relative to that level. But in North America, have come quite a ways back down. But it's sort of a different cycle, right? Than we see. Those commodity booms and busts are a little different than what we see for the rate environment. The rate environment tends to persist longer, and hopefully will come back down again in a little while. But for now, it's made all those investments relatively more expensive. And so it's a good thing that we just knocked, 20, 30, 40% off the cost of these projects, because that does help absorb some of that inflation, that interest rate increase.
I have been wondering if they basically are now coming out even.
That's a good question. I'd have to go do the math on that. I don't think so. I think that the inflation increase is lower than the interest rate increase is less than the incentive value, but I'd have to go do the math on that. That's a good question.
What don't we know yet?
So what I don't think we know is how well we're going to be able to build out the kind of enabling infrastructure that maybe isn't directly supported by IRA, but is induced demand. This is
like transmission.
So transmission, CO2 pipelines, hydrogen networks. We don't need interstate hydrogen pipelines necessarily, especially not in the near term. But we are going to need to build some industrial clusters that can, harness hydrogen at scale to make cost of production or cost of transport much lower. All of that is sort of indirectly supported by the incentives to produce the fuels and clean electricity or do carbon capture and storage, but much less direct support. We had a little bit of funding in the infrastructure law for transmission lines and for CO2 pipelines, these hydrogen hubs. demonstration programs, but that's all, a few $1 billion that will run out pretty quickly, right? It doesn't take more than a couple transmission lines before you've spent, a couple $1 billion. So those are helpful to get a few initial projects moving, but they're not a substantial direct support. And the other thing that is a limitation of the Inflation Reduction Act is that because it was passed as a budget reconciliation act, it's all about spending money or raising revenue. That you can do a lot with, right? You can create a lot of carrots and or sticks with that kind of program. But what it can't do is establish new institutions or state capacity for planning, for coordination, for all the things that we probably need to make these sort of network economies of scale and all the coordination that goes with that work out at the kind of, the efficiency and pace that we would ideally see. So I'm a little worried about that. We can have our faith in the private market to respond, but I think the reality is that if you look at all other network infrastructure, whether it's, fiber optic or transmission, original electrification and transmission lines or the federal highways or railroads, there's always been a pretty direct role for the federal government in accelerating and coordinating the development of that network infrastructure. And we don't really have that right now, really for any of those sectors, right? I mean, and so that's one area where I think I'm concerned, and we probably need further legislation, further state, further state capacity development, whether that's at the federal level or kind of a public-private, consortia at the regional scale that could help guide this process. I think that's an important area for concern.
It's funny because I think that in the climate world, we got very used to for literally 20 years, 30 years, talking about how the Senate was the obstacle to passing climate policy and federal climate policy in the United States. And then, of course, the Senate is where a lot of these ideas came from. It passed the IRA before the House did. It was where the final deal was struck over the IRA. And yet we're still running into all these institutional constraints of the Senate, because if it wasn't for the Senate and the reconciliation measures, we would be able to do, the policymakers would have been able to be much more creative with the legislation. Yeah. It's that they're limited to these revenue measures. And it just always tracks back in some ways to the how the Senate works.
Where good ideas go to die, as they say.
Yes. There's so much in the IRA that touches on the innovation economy and how the U.S. handles its innovation pipeline. And in some ways, the IRA feels like the second part. I remember us talking about this in 2022 before it passed, but it's like the second half of a lot of ideas that kind of started off in the bipartisan infrastructure law. So just what's that whole set of changes to the kind of U.S. innovation pipeline, and where do they stand now?
Yeah, so I'd say the first thing we should recognize is sort of why we're able to go hard and big on wind and solar and EVs now. Why are those the technologies we're talking about so much? And the reason is because 15, 20 years ago, when they were nascent industries that were these sort of expensive alternative energy technologies, as we call them then, governments around the world, from the U.S. to states, in the U.S. to Germany, Japan, Italy, et cetera, decided to create early niche markets to deploy those technologies at scale, whether that was Germany's Energiewende and feed-in tariffs, or our renewable portfolio standards in the U.S., or Denmark's support for commercial wind, et cetera. All of that created initial markets to deploy these technologies at commercial scale, which drives these sort of feedback loops that of all these sorts of causal factors that get reduced down to what we call experience curves or learning curves, right? This sort of correlation that we consistently observe for many technologies, where the more you deploy of it, the more cumulative deployment you have, the cheaper the technology gets on a fairly regular timeline, right? A fairly regular ratio. Mm-hmm. Now, there's a bunch of stuff that actually, is behind that. It kind of shifts, the causal factors shift over time. But what's interesting about it is the recognition that you have to build at scale to kick those things off, right? Yeah. To drive innovation and production at scale, to drive learning by doing in installations and efficiency of labor productivity, all the kinds of things that you learn as you do more and more of it, and you have competitive pressures to get cheaper than your competitor in the market, right? That doesn't happen if there isn't a market. And induced demand for more R&D, right? And whether that's publicly funded or privately funded, that R&D doesn't have anywhere to go and be deployed and tested if there isn't a market for these technologies. And so what that says is we need kind of a full pipeline of support from, yes, early R&D, which has traditionally been the role of government to subsidize basic knowledge and science, but all the way down through demonstration and first-of-a-kind projects, first N-of-a-kind projects, and then ultimately commercial scale deployment of these technologies. And so we're at that commercial scale phase for wind and solar and EVs and lithium ion batteries only because we did the other stuff earlier. And now we have to basically repeat that kind of full pipeline for all the rest of the solutions we need in the clean energy portfolio, whether that's clean, firm power or long duration battery storage technologies or energy storage that we need to kind of complete the transition to 100% carbon free electricity and complement wind and solar. Again, all those technologies are, we know what they are, but they're nascent, whether that's, natural gas with carbon capture or advanced geothermal or advanced nuclear or hydrogen, fuel cells or turbines. Like all of those are, we know how to build them, but we have to get a lot better and cheaper at it. We have to make those mature industries that scale. Industrial decarbonization strategies, synthetic liquid fuels, all the sort of additional suite of technologies, carbon capture, hydrogen. And fortunately, the Inflation Reduction Act and the infrastructure law really contain a pretty comprehensive suite of innovation policies to support expanded R&D, demonstration hubs and demo programs for the new Office of Clean Energy Demonstrations, Loan Program Office Authority, which was dramatically expanded to sort of underwrite the early first N-of-a-kind deployments of these technologies. Mm-hmm. And then for many of them, the first commercial scale deployment subsidies we've had, whether that's advanced nuclear, which now qualifies on equal footing with all other carbon-free generation for the full wind and solar production tax credits, the same production tax credit that wind and solar have had, or the new hydrogen production tax credit, or an expanded 45Q subsidy for carbon capture and storage. We really have the kind of full suite there for most of the technologies we need. I would say with maybe the exception of a broader focus on industrial decarbonization and agriculture, which are kind of have some initial levels of funding, but are largely left incomplete in the current legislation.
It's funny, that feels like the biggest change in many ways between what you might call like Obamonomics and especially the kind of, Recovery Act of 2009 and just the thinking that went into that law and all the green investment that it fostered. And now, the Biden set of legislation I feel like there was a lot, 10 years ago, we thought we could do a lot by being smart and like having a better technology, like a raw technology than other countries or other companies. And now it feels like the U.S. has recognized, in large part due to China, frankly, right, the importance of scale and that, VHS beats Betamax any day, as Jigar Shah would tell us. Yep. And it just matters whether you scale or not. Yeah,
it's kind of remarkable that, I was making the case in 2009, 2010, 2012 that we should be, doing something like IRA then. It was interesting. The mentality in the Recovery Act, which made, $90 billion plus investment over a few years in the clean economy, the biggest to date, was that this was a temporary intervention, right? It was about economic stimulus. Mm-hmm. It was about shovel-ready projects. Yeah, there was some case to be made that it was a down payment on further, clean energy investment, but that the mortgage never got paid on the down payment, right? And in contrast, China used that same time period to implement a very robust industrial policy strategy to basically dominate over the next 5 years wind, solar, and batteries, right? And now we're in this world where they control a huge portion of the critical minerals and the manufacturing capability and the machine tooling and all the kind of components that go with those industries. Again, not because there's some inherent natural advantage in China, but because they made a conscious choice to make that a strategic priority of the government and therefore of the industry. To perfect these technologies, to scale them up and to drive them down in cost and to get really good at manufacturing them. We could have done the same thing, a decade ago. So we're now a decade behind, but at least we're finally in the race and we have the kind of robust industrial strategy that we need to be able to compete on the global stage.
It's funny, even the phrase shovel-ready projects like conveys a certain approach to, which I remember from the time, just conveys a certain approach to like how you do infrastructure investment and like how you do societal capacity, which is like, well, is it ready to go? Because if not, we're not interested in investing in it.
Yeah.
It's just so different, mentality. I think, from exactly. Yeah. For this crowd, especially, what has not yet been invested in, and we could talk about that from the policy level or from like the technologies that the IRA would support if they existed, but that right now don't have firms ready to provide.
Yeah, I think that the two areas that seem most underdeveloped, both in the kind of technology suite and in the policy realm, are industry and agriculture. So if you look at the pie chart of U.S. emissions, right, we have the big ones are transportation, power, and industry. Buildings is a smaller one if you only count direct combustion of fuels in the buildings, but if you count all of the electricity that goes into them, it becomes the biggest wedge. So it depends on how you're thinking about that. And then you have agriculture, which is about 10%, 10 or 11% of our emissions. And so, if we're going to get to net zero greenhouse gas emissions across the whole economy, we have to hit all of those wedges. And I would say if you score IRA on each of them, right, it does pretty darn well on transportation. Right. Again, not just consumer EVs, but there's new business tax credits for medium and heavy duty electric or fuel cell vehicles that I think are going to have a huge impact because businesses are actually much more price responsive and rational than consumer purchase decisions around cars. Right. So if they can save money and, get a competitive advantage by, adopting an EV delivery van like Amazon has running around my neighborhood now, that's going to happen fast, I think, because they have a sustained cost advantage there now. So anyway, transportation, I think, is in pretty good shape. I think power certainly has a big chunk of the emphasis from the legislation, right? And we know we can cut emissions faster and deeper in that sector than really any other, and that it has to grow and expand to help electrify everything else. So that's critical. And then we have a decent amount of support for building electrification and efficiency in the bill as well. Although I should say, I think some of the consumer-facing credits in that case are a little underpowered. Like you can get a $2,000 tax credit to install a heat pump, but if the heat pump install costs $20,000 or $25,000, which is what a whole home, system might cost these days, it's not a huge incentive to, it's not likely to make a determinative difference for a lot of people. So we maybe could do more in buildings to think about how to do that, or had a couple of those incentives with good standard setting and building codes so that, the first time you build something or the first time you go to replace an appliance, you just have efficient options are the only options available. That often is the most, effective way to get that turnover going quickly, and then to buy down the upfront cost of that with these rebates and subsidies. But the ones that are really lacking are in industry and ag. We have a little bit of money for industrial demonstrations, decarbonization demonstrations, about $6 billion in IRA that goes out through the DOE's Office of Clean Energy Demonstrations, and that might be able to help fund some creative demonstrations, whether that's industrial electrification or smarter energy efficiency improvements or ways to change out processes or material inputs that can reduce emissions. The 48C advanced manufacturing tax credit, which is supposed to sort of support investments in clean energy manufacturing, actually got modified so that energy efficiency improvements that save on emissions at industrial facilities can also count for that. But that's one of the only credits that's capped at a fixed value. You can only have $10 billion in expenditure on that credit before it's used up, whereas most of them are uncapped. So that's enough to fund maybe $20 billion of public investment. Maybe that makes it something like 30 or so in total. Public and private investment that can get us going, but there's no long-term, industrial decarbonization policy driver, right? We don't have any clear incentive for that yet. And then on agriculture, there were some grants in the bill for, wildfire mitigation that can help preserve forest stocks, for some creative agricultural conservation programs that might improve soil carbon and things like that. But again, that's it. There's some limited grant programs, really no broader agricultural decarbonization strategy that you can see in the legislation. And I think that's partly a lack of mature technologies that you can point to and say, yeah, that one, let's get that one going. Where you can say that, in the case of hydrogen and carbon capture, which I guess can play a big role in industry, we did do that, right? We gave very specific subsidies for them. So might be a lack of mature technologies, but also I do think, for us policy wonks, it's a lack of thoughtful policy development. There wasn't a very clear policy manual, rating to be inserted into IRA for those sectors the way there was for transportation and buildings and power. And so I think we have our work to do to think very carefully about what a smart innovation strategy looks like, what a smart policy strategy looks like, and what the full suite of technological or behavioral solutions are to tackle those sectors.
It is always funny because you do realize, at this point, I've been covering climate since 2015, which is not as long as you've been in climate, but you do realize how much policy runs slightly ahead of need, but only slightly ahead of need. Yeah. Like when I came, it felt like most people were in power. Transportation had just become the biggest emitting sector of the economy. And since then, there's been more and more focus on transportation. Industry, I think, is getting close to being the biggest emitting sector of the economy. And now it feels like people are starting to pay attention to industry, but it's like it has a 6-year-olds falling around a soccer ball feel, more than I think people expect who are not kind of in the topic all the time. That being said, this has been a great conversation, and I want to thank our host at SOSV for having us, but I think we're going to have to leave it there. So thank you so much, Jesse, and we'll send it back to you.
The work of Professor Jenkins really shows how quickly we're getting smarter about what needs to be done to achieve more electrification and really embrace renewable energy. Before the past year or two, the grid was not in focus as a core challenge for policymakers, but it certainly is now. The SOSV Climate Tech Summit focuses mostly on VCs and founders, but as this is an all-hands-on-deck situation, we wanted to bring in other climate experts to join in on these discussions. For this next session, Climate Tech, the Analyst View, we chat with a couple of the best-known analysts in climate tech for perspective on where investment dollars go and how they use research methods, trends, and data points to shape their views on climate tech. Our moderator, a very experienced analyst turned VC herself, is Sierra Peterson, a founding partner at Voyager Ventures, a climate tech VC based right here in New York. Her experience in climate policy and market design includes the Obama White House Office of Energy and Climate Change and the International Energy Agency. Over to you, Sierra.
Thank you. We are delighted to be here. So SOSV asked us to convene today because myself, Mark, and Nat have all spent some time in part of our careers as analysts, that is, thinking about systemic change in terms of decarbonization, the climate system itself, and offering our systemic views on promising trajectories, alarming trajectories, and overall movements within the system that are particularly interesting for anybody building a company, anyone policymaking, anyone navigating the overall landscape of climate tech. And Nat, what are the bellwethers that you're paying attention to right now?
So, there's some sort of like Gaussian distribution memes that you can see about like what people do at the very, as a very novice and as a very expert in thinking about what's happening. When you're very early on, you tend to look at compound growth rates. And when you're in the middle, you tend to look at all kinds of complex, much more sort of differentially calculated ways of thinking about rates of change. And then when you get back to the far end again, you start talking about compound growth rates again. So I'm sort of at that point. I'm tending to watch the things that are growing fast and durably, and generally much faster than baseline. So in that case, I actually still do spend a lot of time thinking about the growth rates of wind and solar tech in a mature way. Early on, you watch them because they were growing fast. Now I watch them because they are the things that are going to start to erode incumbency. So we're very near the point where in certain markets, all growth has been coming from renewable power for a while. And then we're very close to the moment where in aggregate, we're going to find that case. And that means that like the system that we see as a whole in the power sector is just changing markedly. Transportation is already there. We're at a point where EVs are the only growth in transport. But I'm trying to sort of detect where those are going to come up again in sectors that are hard to abate, that are difficult to address, and that are very, very big and incumbent in their own way. So the exciting thing for me, let's say, is going to be to watch where those rates of change begin happening in things like sustainable fuels for aviation, in terms of decarbonizing cement and industrial heat, in terms of looking at sectors like steel, aluminum, and also finally substitution rates for these incumbent systems that are very well established for a good reason. That I think is super nascent, something I'm sort of looking for when they emerge. But when are we going to see sort of massive substitutions on a material level, not just the sort of electrons level that are going to get us towards decarbonization? And we're not really there yet, but the important thing is to keep an eye on where and when and how they might show up.
Mm-hmm. Concur. Mark, what about you? What are you tracking?
Man, that looking for statement, Matt, I like that one. I'm going to steal that.
You're welcome.
That's good stuff. I mean, so at CTVC, like we're kind of known for tracking funding, right? So in tracking funding, that's kind of the base level of how I sort of look at this sector. So the first step is to look if there's money going into it, right? And so over the past 3 years, or since 2020, there's been 117 billion that's gone in venture capital into quote unquote climate tech. That's across 2,500 companies and 3.3K deals. That kind of sounds like a lot, but it also sounds like nothing. And when you put it in the grand scheme of things, of how much gets invested across other sectors, but also how much that is supposed to be needed for true decarbonization of the economy. So it's just a start, but like everything has to follow a start. And so what we're looking for is those seedlings, those saplings to start to grow. And so what we do is we're looking in all these early stage sectors for proof of life. There's a lot of announcements that go into sectors like this, right? A lot of press releases, but how do you cut through the noise? It's such a trite statement, but how do you cut through the noise to look at things like actual installations of technology? Because everything in decarbonization or climate tech has to end up in the real world, right? And so you look at installations, so whether there's projects, whether there's a pilot or demo, you look at factories that are being built, ground being broken, partnerships between big companies, small companies, things like that. And finally, contracts. Are people buying the stuff that's getting built, right? Is somebody going to buy your green steel? Is somebody going to buy your low carbon fuel? Things like that. And so I think, I'll say it again, signs of life, past funding is what we're looking at most.
Yeah, I concur. I mean, I think what we're really tracking is to your point, that moment of potentially changing the physics and the chemistry of the climate system, of the foundations of the global economy. That is the most interesting aspect for Voyager, even though we are quite early and where we invest. To Nat's point too, I mean, I think the the rates of change. Excuse me.
Landline?
It is a landline. I'm at my
Wow.
parents' house right now. It's the past calling. We're looking towards the future. Anyway, in terms of true rates of change, I think the fact of all growth in power generation being renewable, that the implications of that cannot be understated. And the electrification of light duty transportation, similarly powerful, both unto itself in terms of decarbonizing mobility, but also in what it implies for new ways of moving electricity, new ways of selling, distributing, purchasing electricity too. I mean, one of the things that we're looking at, to provide an example there, one of our early stage companies from Voyager is a company called Powerline, is enabling electric vehicles to collectively serve as mobile power plants, with the understanding and recognition that power distribution capacity on wheels by 2030 is on track to outstrip the entire generating capacity of the United States. I mean, that is a ton of power, and people haven't really grasped the implications of that sort of systems level change from infrastructure up. That's something I'm particularly excited about. So, in terms of this bright new future that we are in the midst of helping to create for a decarbonized foundation of the global economy, if you were thinking about building a business today and really getting started in climate tech and decarbonization today, where would you think about building a career, both of you?
I'm laughing because I'm not allowed to say like a research business. Am I, Mark?
Analytics.
Analytics. But what I would say is I'm gonna go out on a limb here and say that Mark is going to say something about a research business. I'm going to go ahead and say that I would be trying to build something in the kind of hard to solve problems of the capital stack, which is frankly a very ambitious thing to be stating, because at this point, a lot of the hard to solve problems, the numbers start with a B and they eventually grow towards having a T. But I think that we're going to find, this is from conversations I've been having actually in the last couple of weeks here in Asia, a sense that like the first to 10th of a kind solutions to solving in a programmatic way how you deploy a lot of new technology is not yet there. It needs to be there. To some extent, these things kind of work on consensus and agreement to a very real degree. People decide, we've now decided that we're going to go do this. This is a technology to do. But the models at the financial level are not yet there in terms of getting people comfortable with a structure, with a set of terms, with a set of conditions to deploy something that hasn't been built, but that you hope achieves the same sort of scale that electrochemical storage batteries now have. And doing that requires a bit of invention and creativity. It requires some risk. It requires quite a lot of savvy, and it requires corralling a whole bunch of counterparties together. And in one sense, that requires a lot of innovation, but in another, it's just a very old-fashioned kind of bit of financial innovation towards a specific goal. So that's where I would go.
Mark, analytics.
I don't know. I'm outed because that is basically my answer. But there's a reason behind it. So my answer is like, what would you start? I mean, I'm starting a research business, right? Like, it's going. But the reason for that is because you realize kind of what you like and what you hope you're good at, and what interests you, right? And so like, I thought as an analyst back in the day, that the trajectory had to be, go be a project developer, go be an investor, something like that. But then there came this realization that, you know what? No, I like research. I like finding out new stuff, and I like the research business as a business. And so for me, it made a lot of sense to stay in this business, but also, as I identified gaps in this market, in the research market that could be filled, it made a lot of sense to stay in and build a career, around research. And so, like, what I would say to anybody, listening or watching is think about that hard, like very, in detail, about what you like, right? Think about what you like, what you're good at, and what interests you, and just follow that. Because you might think like, oh, I've got to go take all these courses, or I've got to go learn to code, or I've got to go, get all these certifications, but it might be a step closer than you think to get involved in climate.
Yeah, I mean, absolutely. I think this, the world of possibility is not just lawyer, doctor, project developer.
Right.
True.
Right.
Yeah, I think there's a misconception there. And that's something that we actually at Voyager recently published a letter on regarding the true applicability of all types of professional experience in systemic decarbonization. It's, certainly any business that will grow to sufficient scale will need people who understand how to build basic businesses, really who are experienced in the foundations of business building. It's not just material science or project development. It is the entire spectrum of professional experience that comes to bear in building the future of the economy. And that was something that I think it sometimes gets overlooked in the overall narrative, where we focus really on the novel technologies that are particularly exciting. And there is room and truly an invitation for everybody here. And as we point out in our overall letter, you are not too early, neither are you too late. And one thing that we've seen in enduring interest among investors, who are professionals in thinking through, well, what are going to be the foundations and the durable foundations of the financial system of the economy? Valuations have remained high in climate tech. There is a sense of momentum that is certainly not held up across the larger private capital markets. And this is a growth industry that is actively hiring across all types of professional experience. So I'm interested, along those lines, why do you think climate tech has had staying power given the overall market downturn in private capital markets primarily?
For me, there's an article that comes to mind. So years ago, it's just a headline. I don't remember where it's from, but it said, when everybody's done with social media, can someone please turn the light off? The headline was something like that. In that a lot of these things have cycles, that we're like so hyped about them, then we get bored as a society, right? And we move on to the next thing, right? But for me, climate, it's not going anywhere, right? There's going to be more of a need and more of a need and more of a need until we solve this thing. That's kind of thing one. Thing two is that there's all this sort of undercurrent or swell of support for climate, be it in public funding through the IRA or the Inflation Reduction Act in the US, or that it's kind of an arms race to match that in other countries or jurisdictions, right? Like EU is putting in policy in place to sort of compete with the IRA. So is, other countries in Asia like China. They're trying to be leaders in climate, right? Because that is the thing that's not going away and is going to be around for a while. And so, it could be several of those things that are keeping valuations high. The sense that it's not going anywhere, but it could also be that it's still new. And so there hasn't been a chance to sort of get bored with any of this stuff quite yet. And so it could be early days.
Nat, your thoughts?
So I wrote a piece recently looking back, as one does, on a note from the deputy governor of the Reserve Bank of Australia in 2019, and he was writing about how you think about climate change from a monetary perspective. And he said that, the way that typically institutions have looked at these, financial institutions, fiduciaries have looked at this stuff is from a lens of weather, and that any weather-related event is something that you would just sort of ride through from a monetary policy perspective. But climate is different, and that you can't ride through these things because they're elongated beyond the timeline of any kind of monetary cycle or monetary set of impacts. And I think that there's something sort of similar in play here, which is that the macro prudential trend to be smart about climate is not going to go away. And I think all of capital is sort of beginning to reorient around that. I do think that it is a beneficiary as well of a kind of retrenching against, how shall I say it? Let's say minor solutions that solve the technology's problem. So I'm thinking of no shade, but like an NFT is an example of something that solved Web3's problem of going to market, but didn't necessarily solve any other really big problems. Whereas in climate, we're talking about solving fundamental things, and in the process, creating businesses, goods, services that have intrinsic value and have products that are sold. And this is one thing that I think the three of us on this call know and inhabit very well, but a lot of other people don't, is that it's more than selling enterprise software to large consumers. It is actually selling things that you, in the energetic sense, are the ability to do work in the form of a fuel or electrons. But there are also other products. There are also services that materially improve doing your business. And I don't think that any of those things are going to go away. We're through the point of sort of being able on an intracycle way of looking through or looking past what's going on in climate. And it's going to just have to be macro at this point.
Yeah, completely concur. I mean, we see climate as, the investment in the durable production across, the economy. This idea of securing sources of fuel for manufacturing, securing food, proteins, access to heat to keep people warm in the winters and cool their homes in the summers. These are not negotiable. These are the foundations of the global economy. And they are, particularly in Europe, recently overlaid with a geopolitical urgency that has both manifested itself in price spikes for electricity, and in a recognition of, the securing the aspect of production across the foundation of the economy for us is newly geopolitically important. That is something that we've been heartened by, and we think that will certainly continue. And Nat, this is not necessarily, as you so well put, technology seeking its own solution set. This is how we live.
Right. That's right.
Yeah, that's good. In terms of emerging segments of the climate tech economy, do you have any favorites that have recently emerged? Mark, you spoke about things being new. And certainly there was the wave of clean tech 1.0 that guided quite a bit of investment into energy, solar, wind, and the first wave of storage. And now we are in a second wave of capital excitement regarding climate tech. What are you particularly excited about?
I'll keep this really short for sake of time, but there's a few things. One is really kind of a refocusing, right? Maybe not, some of these things aren't quite new, but it's a refocus. One on sustainable mining, right, and critical minerals. We're going to need a lot of them. Some of the methods, a lot of the methods for getting them out of the ground aren't necessarily new. There are a lot of new methods, But the focus on sustainable mining is a big one. The second one for me, it's no surprise to Nat, of course, is geothermal. I thought forever that new geothermal was sort of an intractable problem, an unsolvable problem that wouldn't be solved. I have changed my tune on that in the past few weeks, actually. And I think a lot of like industrial heat pumps and those types of things are deserving of the refocus they're getting right now.
Nat, what's top of mind?
I'm really excited about getting ourselves to a world of reasonably good energy density, zero thermal runway, 100% charge and discharge batteries with really earth abundant metals in them that don't have problematic or constrained supply chains. And I'm really looking forward to the Cambrian explosion, not of the hardware so much, but of what people do with it.
Mm-hmm.
And I think that that's something that we'll see coming as these things escape the lab to the fab and then to applications for motive power, for stationary power. But I sort of look forward to seeing these enter into a really wide range, a dispersed range of applications, both in geography and in market need. And I think that's going to be exciting. And also to think about what people will build on top of these as businesses, not just on the hardware and the metal itself.
Mm-hmm. Yeah, I am very much on the bandwagon of the promise of ubiquitous energy storage. It is so exciting. And with that, we are going to wrap up. We have lots to talk about, certainly. The future is exciting given the technologies that we are working with today. Nat, Mark, thank you so much for sharing your wisdom with us this morning. And onward we go. Thanks again.
Thanks, Sierra.
Thanks, Sierra.
We are so fortunate to have deep analytical thinkers like Nat Bullard, Mark Taylor, and Sierra Peterson on the job in climate. There are so many moving parts in the climate effort, we probably need many more. I have a lot of great colleagues at SOSV, not only here at IndieBio New York, but also at HACS, our sister program that focuses on hard tech solutions to address climate issues. Think batteries, industrial processes, critical minerals, advanced manufacturing, mobility, and much more. HACS started out in Shenzhen and still has a very strong presence there. But last year, HACS established its new flagship location in Newark with the help of a $25 million grant from the New Jersey Economic Development Agency. One cool thing about that is, with both IndieBio and HACS being on the East Coast, we are only separated by a 20-minute train ride. Our founders and staff shuttle back and forth, making it easy to share not just lab and office space with the founders, but also the know-how and expertise of our staffs. In fact, I have one of my favorite HACS colleagues right here to introduce the next session. You may recognize Susan Sofer as the co-host from last year's summit with Sean O'Sullivan. Like me, she holds a PhD, but whereas mine was studying the ways in which pathogens interact with our immune system, Susan focused on catalysis and industrial processes, which makes her well-suited to be HACS Chief Science Officer. Welcome, Susan.
Thanks. Hi. As Sabriya said, I'm the Chief Science Officer at HACS's new office in Newark, where we now have nearly 20 companies working away on projects that range from advanced diagnostics to utilizing electrochemistry for green and efficient recovery of critical minerals, new building materials, and much, much more. Over half the companies in Newark are focused on climate tech. If you are a founder and interested to learn more, please check out our website at hacs.co. Before I introduce our next panel, I'd like to remind everyone that the SOSV live AMA breakout session starts at 10 a.m. Pacific, 1 p.m. Eastern. You can join me and my colleague, Dr. Pei Wu, who is an SOSV general partner and the CTO for IndieBio in San Francisco, for a brief introduction to HACS and IndieBio programs, followed by questions. Now, on to our next session. One of the very few areas of hard tech that HACS has yet to touch is nuclear. But it is increasingly clear that nuclear power will be part of the energy transition, and at HACS we are certainly interested in the topic. We've put together a great session entitled, "Is the Era of Small Nuclear Reactors Finally Here?" Today, fission reactors account for 10% of global electricity production and more than a quarter of low-carbon power. But the industry is held back by fear of the next Chernobyl. Can a new generation of reactors convince the public that nuclear is worth the risk? Our moderator is Dr. Shannon Bragg-Sitton, a pioneer in the innovative application of nuclear energy.
Thank you so much, and welcome all to this session that will focus on curbing emissions with small nuclear systems that use fission energy technologies. My name is Shannon Bragg-Sitton, and I'm the director of the Integrated Energy and Storage Systems Division at Idaho National Laboratory, the U.S. lead laboratory for nuclear energy. We are seeing governments and technology developers around the world now considering nuclear energy as a contributor in reaching net zero goals. The recent documentary by Oliver Stone, Nuclear Now, also tries to dispel the myths and misconceptions around nuclear energy. The first nuclear reactor was built in 1942, more than 80 years ago, and there are now close to 500 reactors operating worldwide. Most new reactors are being built in China, India, and Russia, but the U.S. also recently started a new unit in the state of Georgia. Historically, these nuclear plants have been large, expensive, centralized projects producing a gigawatt or more of electricity. But today, nuclear energy is seeing a revival with the development of smaller, lower cost, and more distributed solutions. Small modular reactors, or SMRs, are well suited to more remote regions, offshore deployments, hydrogen production, focused industrial applications that may require heat or steam, or as an ideal complement to smaller scale renewable installations. And today we see over 70 companies developing advanced nuclear technologies around the world, many of which are just a few megawatts to a few hundred megawatts per unit. I'm joined by the founders and CEOs of 3 of these advanced nuclear fission companies, and I'm looking forward to the conversation we'll have with them. First, let's go to Brett Kugelmoss. Brett is the CEO and founder of Last Energy, which is based in Washington, D.C. Last Energy is developing a small pressurized water reactor, essentially a smaller version of the current fleet reactors we have operating. These are designed to cost about $100 million US per unit, and they are very compact, fitting within an American football field. Brett, you've come to the nuclear industry from a different starting point than most. In fact, I fondly recall meeting you several years ago as you interviewed me for one of your first installments of the very popular Titans of Nuclear podcast. Can you tell us more about why you founded Last Energy and how you are approaching this challenge of getting advanced nuclear energy into the marketplace?
Yes, great to be here. Thank you so much for that great intro as well. My story is a little bit different than most entrepreneurs in the nuclear sector. I didn't come from the nuclear industry. As a matter of fact, I came from Silicon Valley and formerly developing other technology companies, but realizing that climate change required nuclear brought me here. I used the Titans of Nuclear podcast as a way to explore and really try to hone in on what was the right problem to solve in the sector. And after interviewing for almost 2 years, over 1,500 people, including yourself and many, many others, I came to the conclusion that the challenge that was necessary in order to drastically reduce the cost of deploying new nuclear had nothing to do with the reactor core, but rather the business model, the manufacturing model, the regulatory model. And so at Last Energy, we built a 20 megawatt micro PWR, pressurized water reactor, that is meant to be mass manufactured. But most importantly, we don't touch the core. No material science changes, no changes to the fuel, no changes to the process. It's just a shrunken down PWR, just like Belgium's first reactor or the NS Savannah, meant to be mass manufactured. And we've had incredible commercial success this last year, selling over 50 such power plants throughout Europe.
Thank you, Brett. That really is fascinating. I like the idea of turning the industry on its head, thinking about things differently in order to overcome this challenge of getting these technologies to market. So next, let's turn to Michael Boe, who is the chairman and CEO of Core Power based in the United Kingdom. I understand Core Power is co-developing molten salt reactors that could be used in electric cargo ships and to support floating industrial facilities. This design only requires refueling after operating 2 or 3 decades, which is very similar to nuclear-powered submarines. These last a very long time. Michael, I understand that you've been working with TerraPower, which is backed by Bill Gates, for reactor design, and that you're also working toward mass manufacturing, as Brett has just described. How did you come to nuclear and to the current technology solution you're working on?
Well, thanks, Shannon. Pleased to be here with you today, and thanks for the introduction. As you indicate, I come from the maritime industry. I worked for 30 years in ocean transportation, and that's the market that we think has a real need for these new technologies. It's a $7 trillion industry which transports close to 90% of global trade or exported goods, and as a result, it's the sort of backbone of global trade. We consume 350 million tons of fossil fuels every year. It's about 4 billion megawatt hours of energy, and we emit over 1 billion tons of CO2 and greenhouse gas emissions. So, the problem is we've been mandated to go to zero emissions by 2050, and that simply can't be done. Alternative fuels produced, in the conventional way, ammonia, methanol, which is being produced today from natural gas. If we were to do that, we would increase the share of global transportation's emissions by a factor of about 5 times, from 3% to 15%, and that simply isn't the solution. So we're coming at this from the point of view that here is an industry that's extremely hard to abate, and it needs nuclear power, but it needs a different and new way of doing it. There is a reason we don't have this today. So I started Core Power back in 2018 to build this new technology based on the molten salt reactor. We're now building at INL, where you work, Shannon, and also help create a framework for how this is regulated and to build a brand new market for new nuclear and maritime. It's a big challenge, and we have to be brave and we have to think big to solve it.
Absolutely, Michael. And I look forward to seeing that first unit operating here at INL and understand how that's operating. I think that you're really tackling a global challenge of the hard to abate sectors with maritime transportation. And I hope that this technology is successful in the near term to abate those emissions. Finally, I'll turn to Stefano Buono, CEO of Nucleo, based in the UK as well as Italy. Nucleo is developing yet another type of reactor, a lead-cooled fast-spectrum nuclear reactor that will operate using nuclear fuels that are derived from depleted uranium and plutonium from stockpiles of nuclear waste. Stefano is a physicist that founded a nuclear medicine company initially, and that was later acquired for billions. Stefano, how and why did you transition from medicine to the energy generation sector?
Well, actually, I was the first transition that was strange because I started as a nuclear physicist and I was working for many years on this kind of technology. So from the 90s. The idea and the motivation at that time was to create a nuclear system that was safer. So we had just had the accident of Chernobyl, and we were looking for the concept of passive safety. In that search for a safe reactor, we found lead, the idea of using lead as a coolant rather than sodium. And this, as you mentioned, would open the possibility of multi-recycling the nuclear waste. You know that any reactor today is using essentially 0.5% or maximum 1% of the power that is in the uranium that is extracted. With a multi-recycling, in principle, you can use 100% of it. So you have now a lot of waste that has been generated and the uranium extracted that can be used as fuel. And this could fuel for hundreds of years our reactor. So there is a mine of extracted uranium that we could use using this multi-recycling. So on top of the objective of having a safer reactor, so a reactor that can implement a passive safety system, and lead is a key element to reach this objective in an economic way. We have also added this mission to burn the plutonium that is in excess today in Europe. There is free plutonium in France and UK that need to be disposed. So we are joining these two missions. And we do it, of course, with a small size because we have to be small and modular like everyone else here in this meeting.
Thank you, Stefano. I think you've highlighted some really important aspects of the revival of nuclear energy technologies, focusing on continued advances in passive safety and closing the nuclear fuel cycle. In fact, looking across these three technologies that are being developed, I think we have a really beautiful set of solutions where we can utilize fuel from one technology to drive another technology and move toward a very clean, sustainable energy system. So now that we've heard a little bit more about each of your companies and what you're developing, ranging from small-scale water-cooled reactors to molten salt-cooled and lead-cooled fast reactors, I'd like to dive in a little bit more about how you see these novel nuclear fission systems truly fitting into that broader energy landscape in the coming decades. How is this round of technology development different from its predecessors? Brett, let's start with you and then move through our panelists.
So I think one of the things that we've really tried to hone in on is a difference in business model. And so we act almost as a utility where we will cut out the middleman and we'll sell energy as a service to direct off-takers. And then just like one would in the industrial gases sector, we'll find a plot of land next to those facilities, develop our own project, connect a private cable, and be able to deliver power directly to our customer. And so that's one of the ways that we think that we're able to unlock a whole new set of opportunities and a whole new set of stakeholders and cut through a lot of the bureaucracy by innovating on the business model as well as the technology.
Fantastic. Mikhail?
Well, I think, Shannon, we're finally getting to the point where if we're going to move off fossil fuels, which is really what the big discourse is in the world today, we don't really have a choice. Nuclear is the only reliable solution we have, and it's not just about electricity to the grid. It's about heavy industry, as Brett just said. It's about transport. It's those really hard to abate sectors of the economy, as well as poorer countries that have to leapfrog the fossil fuel revolution to get the energy that they need. And that means, in my opinion, new ways of doing nuclear. It doesn't have to be different technologies, but different business models, different deployment models, different way of doing these things so we can bring things to market faster, we can do it cheaper, which means smaller, simpler, cheaper with a shift, I think, as Stefano has pointed out, from active safety, not so much about more safety, it's about shift from active safety to passive safety, because at the end of the day, it's about the physics of the machine, not the skills of the people that we're going to have to rely on here. Human error is the greatest cause of most accidents, and with the one that we're looking at, the molten salt reactor, that's no longer much of an issue. So I think there are many different things that come into this to enable us to bring new nuclear up close and personal, if you like.
Absolutely. Stefano, what would you like to add on this?
Maybe I could add the fact that we are transitioning very much in the business model, but there is also a transition from a governmental approach, especially in Europe, into a private approach. So we have to try to let private money to flow into the system, not governmental money. Private money is fast. We need to return on investment that is faster. So our recipe is to control the cost of nuclear. So our aim is to have €4 per watt installed, which is in the low side, of course, of the cost of a nuclear reactor, but also to do energy production system faster. So today in Europe, unfortunately, we have bad records of having a lot of money deployed for a very long time, more than 10 years, up to more than 10 years. So we have to reduce the building and this investment phase to less than 3 years. So even if we produce a, let's say, medium-sized modular reactor, because we want to produce 200 megawatt electric, we still need to do it in 3 years. So the model is changing also because of the deployment of the capital, not only because of the cost.
I love hearing this shift in thinking on business models, lower cost technologies, faster in getting systems to market, and of course, mass manufacturing, really helping us to shift to an economies of quantity approach versus economies of scale that we have seen historically. And one thing I'm really curious about as you're starting to look at these different market segments, I'd like to understand from your perspective how those markets and the local communities around those markets are really beginning to perceive nuclear energy as an option to their future energy needs, and how that may or may not be affecting your development speed and financing and how you are gaining that market support. Let's start with Michal this time.
Thanks, Shannon. Yeah, well, Core Power's got backing from close to 100 separate investors now, mostly from industrial, strategic, transport investors, large corporations that are looking to secure this technology into their value chain in the future, becoming customers, if you like. And one of the things that I think we are able to demonstrate with setting down the criteria for how new nuclear in maritime would work, specifically from Core Power's perspective, is that we've got to be able to provide a benefit to everyone. It's not just the company that has bought and deployed the energy system around the reactor and getting the electricity or the work from that. Is also those communities around it. So having a new form of nuclear that we can bring close to population centers, into waterways and into ports, docking at berths in ports, etc., and providing electricity in those really hard to abate sectors without the liability risk and without the environmental risk around it that's perceived by populations. I think we're starting to rewrite the contract with the public, and we're seeing this from big ports, we're seeing this from industry, we're seeing this from port communities that are really wondering, what are we going to do? How are we going to, clean up our environment? How are we going to decarbonize these massive, installations that we live nearby and work in? And here comes a technology that's small, it's friendly, it's clean, it doesn't have the sort of risk profile that's perceived of more conventional technologies. And as a result, I think we can rewrite that contract. It hasn't happened yet, but it's a gradual shift from sort of, lightly skeptical to enthusiastic. And I think, as I said before, bringing nuclear more up close and personal creates that bridge between confidence and familiarity. And that's what we need. A little knowledge goes a long way with nuclear, and we all know it.
Yes, I can testify probably the enthusiasm around nuclear by the investor community. Today, I raised already 400 million. I'm in the process of raising 1 billion, which is rather a successful process. So it's really a lot of money. But I'm raising this money from a large number of people. Of course, there are funds, some banks, some institutions, but there is overall the people, family office and people who wants to put the money. And so I have been asked to invest every day. And I think the motivation of this investor is not yet a financial objective, but is really the one of letting a project in nuclear fly in Europe, because most of my investors comes from Europe. So there is really a shift already in the mind of people in which nuclear can contribute to our progress, not only for the decarbonization, but in Europe also for energy independence that has become an issue for Europe because of the war with Russia and our dependence historical from gas, of course, from Russia.
I think you're right that confluence of national security and energy security and energy independence are really driving some new discussions around energy options. Brett, what would you like to add?
I mean, I agree with everything that they've said. There has been a noticeable shift, but I do want to emphasize that shift is not necessary and should not be used as like a foundation for permission to go build. Certain societies have always loved nuclear and have a longstanding tradition of supporting it and still do support it. So whether we had half or even 2/3 of the countries against it, that's no excuse not to build where people love it. And that's always been our approach. Go to the lowest hanging fruit. Like, it's not our job right now to convince everyone to love nuclear. Our job is to prove that we can build it cost effectively and then use the incredible success generated from that to open it up to new markets and change people's perception after we have a track record of success.
I'd like to underscore something you just said, Brett. It's not about making everyone love a single technology, and that goes for any of the technologies. We have a limited set of clean energy technologies in our toolbox, and the right mix is different in each regional deployment location and for each of the markets. And so understanding what the option space is and proving that nuclear energy can be affordable and it can be built in a timely fashion is key to showing that it is truly a part of our clean energy toolbox and that we need to embrace that where it makes sense. So fully agree with that. One thing I find interesting is as we look around the field of these advanced nuclear technology developers, I mentioned more than 70 companies starting up and developing advanced technologies. Some of those are coming out of what I might consider a giant in the field, companies that have been around decades, thousands of employees. And then we have companies like your own, which are much smaller, bringing fresh, new thinking, new approaches. Love to hear your thoughts on how that has affected your progress. Is it a challenge going against these giants, or is it perhaps a fresh look and new opportunity?
Well, I have the example of medicine because you mentioned that I had a successful. I think there is no conflict between a biotech and a big pharma. They are doing different jobs. And there is an opportunity for small companies to act faster and take a decision and use the private money for a purpose that is one project. So there is a dynamic that is happening, which is similar to the one of biotech into medicine. There is a role of a small company to accelerate the innovation, and I think we are fulfilling this role.
Can I add to that, Stefano? I think that's a very good point you're making, and to answer Shannon's question. I think it's actually the other way around. It's very encouraging to see incumbent technology developers, large corporations coming in and sort of being in this field rather than just doing what they've always done before. And for us, younger companies, in that scale-up phase that we're in, like Core Power, it's very encouraging then to see the discussions and debates that we have with those companies, but also see those, I have to say, giant corporations that are coming in and investing in us and what we're doing. Some of our investors are, hundreds of times bigger than I think we'll ever become. And they do it for a reason, not just because they think they can make a little bit of money out of something which is now becoming popular, but because they have a real, genuine future customer need for this, right? And their customers themselves, etc. That part of that energy transition that does something new and different. I think it's extremely encouraging to see the largest corporations developing this technology and other large corporations, even larger corporations, investing in the young startup and scale-up companies that are coming through here. Just a sort of word of warning for everyone who's listening to this, of course, you say there are 70 companies developing technology. There is, going to be a much thinner field as we move forward, as you probably imagine. So the choice is, in fact, rather limited.
So I agree with a lot of what I've heard, and it is the right perspective to have that a rising tide floats all boats, especially in this industry. That being said, we shouldn't be naive. The incumbents include, both in nuclear, but also in the broader energy space, they're sharks, and you can't like assume that they're going to want to be there to help you out. And so how we've approached this is by trying to carve out a niche where we are not directly competitors against them, because if we tried to compete head on with the incumbents, does not matter how good your technology is, you will lose. So we just go for customers that because of their size or location, they can't provide for, and try to stay away from that direct competition.
Yeah, I wanted to add, this is also a little bit our approach. The fact of having the possibility to burn the nuclear waste is helping us in the relationship with the big companies. In France, we are becoming a partner of EDF because we have 40 tons of the all-fuel Super Phoenix that we can burn, because we can maybe reduce their storage of fuel, used fuel, etc., etc. So there is also, let's say, complementarity that is possible with the big companies.
Absolutely. And that's why I mentioned we've got a diverse set of technologies represented here. They can be complementary to large-scale systems, and they can be complementary to renewables and be a very good backbone to a clean energy grid and provide the reliability and resilience as well as that sustainability as we begin to close that fuel cycle as your technology does, Stefano. One thing I'd like to understand, and as I go to various audiences talking about advanced nuclear technologies, a leading question that I get is, when will these really be available? When can I order one? There are many companies that are frankly chomping at the bit for these technologies to be available, and there's a lot of promises out there around the technologies. Some of these companies are merely paper reactors right now. Some are moving well through hardware demonstrations. So I'd like to understand when you believe we can realistically see your technologies and related technologies deployed. Where are you in the regulatory and licensing process? And when do you think that first operational facility will be ready to go?
I can start if you like. I think it's very important for everyone to recognize that nuclear is difficult, not because it has to be, but it has become difficult, and we have to recognize that. And it takes time. It's very important that we do things right rather than do things quickly, as you probably noticed with just a few accidents and mishaps in the past. It creates an issue around this. So we've got to do this right, which means that you have to go through many hoops in order to get through the various stages of development. I think the way we see this, with a sort of public-private initiative that we were in together with the US Department of Energy, and so US government support for this, which sort of lends a little bit of additional weight to the licensing and regulatory side, at least domestically in the United States as well. We see that there is a process through several stages, and the final sort of first commercial prototype, the demonstration prototype, is likely to be there sometime between 2032 and 2035. But that doesn't mean that we're starting now and we sort of think that we can get it all done in 9 or 10 years. We started in 2013, so that's effectively a 2-decade development program to get all of that incredibly hard to find data up onto the surface, and to get this licensed, regulated, deployed, built at scale in the right kind of environment. And then you can take it from there. Then you can say, right, okay, we got one now, we'll build a second and a third, etc. And we, in the marine environment, obviously used to shipyard manufacturing. So it's not just about manufacturing as Brett and Stefano are saying, and as I'm saying as well, sort of manufacturing reactors, but it's the entire power plant, if you like. A floating nuclear power plant is built from scratch in a modular fashion in the shipyard, and then can be moved to where it's needed, moved back to where it came from when you've finished with it. So you change, if you like, the entire ecosystem around it. So once we've got the first 1, 2, maybe 5 built as serially prototype machines, I think that can be scaled in a very effective way.
Excellent. I saw Stefano pop in here.
Yes, we have initiated the interaction with the French regulatory authorities because we want to build our first manufacturing facility for the fuel and our first reactor in France. The aim is 2030. Is a long time. But we have a new technology. The technology exists, but we have to implement a new design. So we need this time in Europe.
Thank you. And Brett?
So since we're not inventing anything new, our novelty is in the systems integration and manufacturability of our plant. We intend to have our first plant ready to go live in 2025.
Wow.
And that's from a manufacturing and supply chain perspective, in which we already lined up the entire supply chain with contracts and have already started manufacturing in Houston, Texas. That being said, licensing can take longer. And so while we hope that we can get a license within the next 2 years, we're realistic and understand that it might take 3 or 4. But our power plant will be ready to go before the end of 2025.
That is excellent news, Brett. And I think that's excellent news to many of those industrial companies that are looking to nuclear energy to help them move toward decarbonization. And I think it's important for the audience to understand that these technologies that are in development, while highly varied, are essentially technologies that have been researched for decades. There's a lot of data that can be pulled from historical work, a lot of lessons learned from previous research and development approaches. So I think now it's all coming to fruition, and we have a lot to bring to the field now in our energy system solutions. And I know we are down to the end of the wire on our time. This has been a fascinating discussion hearing about these technologies. And I'd like to give you each just a quick moment here at the end to share any final thoughts and a quick lightning round. I'll start with Brett.
The message I always love to leave on, which is always a little bit controversial, is stop talking about safety. You can design a safe reactor, that's fine. The more you talk about it, the more you scare people. Stop talking about safety.
That's not the first time I've heard that message, and I think you're absolutely correct. We have a very safe technology that we are developing. Michal, your thoughts?
Moving transport of global trade away from fossil fuels presents an unsurmountable challenge of scale, and only nuclear can actually do that. So we need to have a new nuclear solution, and that's what we're building at Core Power.
Fantastic. And Stefano?
Yes, I would like not to hear that there is competition among the technologies. I think the group of companies that is innovating today, they can all be. Many can be present on the market at the same time because our market needs a lot of growth in the electricity production. Europe is forecasted to need to grow 3 times the electricity production by 2050. So that's the message. Let's collaborate, especially really in explaining to the people that there is no danger in the nuclear and is the technology of the future.
Thank you all so much for sharing your thoughts, your technologies, and I love ending on that note of collaboration. We have a grand challenge ahead of us globally to get to net zero emissions across all of our energy use sectors, and we can't get there alone. I'm excited to have colleagues and collaborators such as yourselves out in the field working toward this common goal of net zero energy that is reliable, resilient, and sustainable. Thank you so much for the time today. I encourage our audience to reach out to those of us here on this panel, as well as others in the field if you'd like to learn more. Thank you.
It's hard to believe that nuclear won't play a central role in our race to generate more affordable green electricity, because we will need so much more of it. It's encouraging to see how the technology is advancing. We've already heard from the early to mid-stage VCs at Prelude, Breakthrough, and DCVC. But for this upcoming session, First Checks for Big Ideas, we turn to the VCs who write the very first checks and create deal flow for everyone else. The good news is that these check writers have not slowed down. According to Climate Tech VC's analysis, seed investments in the first half of this year alone were actually up 23% year on year. And I'm sure our panelists are wondering what sort of funding reception may be in store for their companies down the road. Our moderator is Alex Wilhelm, who is the editor-in-chief of TechCrunch Plus and co-host of TechCrunch's Equity Podcast. Let's hear from these first check writers. Over to you, Alex.
Hello, everyone. My name is Alex, and I'm here from TechCrunch. Welcome to the First Check into Climate Tech panel. We have an absolutely amazing collection of people. I'm going to give them each a quick introduction before we start. We have Lori Manu, a founding partner at @One. Lori, hello. We also have Stephanie Dorsey, a founding partner at E2 JDJ. Hello. And then we have Corinna Chen, a partner at Material Impact. Hello. And then we also have Dr. Pei Wu from here at SOSV and IndieBio. Pei, how are you?
Hey.
All right. So one thing that absolutely surprised me when I was prepping for our conversation today was an actual decline in how much capital climate tech startups raised in the first half of this year. When I look around the news, when I look outside, it's relatively terrifying to see what's going on with our planet. And so if I was not watching the numbers, I would presume that we would be seeing an explosion in capital going into climate tech focused companies. Not quite the case. Pei, starting with you, are you surprised by the numbers we've seen thus far in 2023, or are they in line with what you were expecting?
I think we're seeing maybe a bit of slower activity, but as we're coming into this final quarter of the year, activity has picked up, and we are seeing much more interest in investing in these super important companies.
All right, and then Corinna, over to you. Are you seeing the same thing, kind of an acceleration or an uptick as we've moved past the halfway mark of 2023?
I definitely am. I feel like for a lot of firms that perhaps were cautious and sat out in 2022, after about a year and a half, we have to kind of decide to move forward. So I've definitely seen an uptake in the second half of 2023. And I'm really hopeful that the trend will continue in 2024, especially as we see some of the markets open up with a couple of key IPO offerings. Even though it's in a different industry, it's all an indicator that maybe things are kind of moving a little bit forward.
All right. And then, Stephanie, I know that your firm has an ag focus to it, so it's slightly more focused than some of the broader climate tech funds. But what are you seeing on the ground? Are things looking better than the 40% decline we saw in the first half of this year in the back half of 2023?
Yeah, I would say the same. Really no one's insulated from the broader global markets, but you do see that the strong startups are still able to raise. It is a more challenging fundraising environment across the board, but you're seeing that the opportunities are really broadening.
On the macro point about, you can't kind of outrun where the overall market is climate tech investing and climate tech startups doing better, worse, or kind of in line with the market as a whole, Stephanie?
Yeah, so the data actually suggests that they're doing better. It's a bit more resilient. So that's the, promising part there. So hopefully we could keep that up.
I'm encouraged by that. Lori, I'm curious about what you're seeing in terms of different stages, because we're talking about an aggregate figure from the first half of this year, a 40% decline. But inside of that, there's pre-seed, there's seed, there's middle, late stage. So when you look at the different stages of climate tech companies in your portfolio and outside, where is there the most activity and where are things the healthiest from a venture perspective?
Yeah, and I think that's why climate is so interesting in early stage climate. If you look at the first half of 2023, actually seed stage saw an increase in terms of funding of 20%. So it's super exciting because a bunch of funds closed last year focused on climate. So there is money for early stage climate companies. And we saw, several companies, rounds that we led, first part of the year being oversubscribed and rounds being very competitive. So it's really exciting. I think the hard part is for later stage companies. Series C, Series D, it's really tough. Takes a while to raise funding, and there is not a lot of money available for later stage climate tech companies.
I don't think there's a lot of later stage capital available, period, kind of across the venture capital market. It seems like the later stage money has retracted the most, but I am glad to hear that there is a good amount of activity at the earliest stages. Hey, Lori mentioned competitiveness inside these rounds. Is that changing the pricing dynamics that you're seeing inside of early stage climate tech companies?
I think we are seeing generally pricing is not changing a huge amount. I think the bar is high right now, especially we're a pre-seed fund. And so we are spending a lot of time working with our companies on their seed rounds and their Series A's. Mm-hmm. Maybe there's been small changes in pricing for sure, but nothing huge in terms of big differences. But I think what we are seeing is that activity, the oversubscriptions that Lori is referring to, and I think investors recognizing that capital for these early stage companies is so critical because these are companies that are, building new markets and probably have CapEx requirements that are going to be more significant even at the earlier stages. And so that recognition is leading to better capitalization earlier on.
All right. And then Corinna, I want to get you in on the same question about kind of how competitive rounds are from your perspective and how much that's moved prices just from kind of your perspective point.
Yeah, I would echo what they said in the sense that I'm not really seeing that the prices are moving up for competitive rounds. But what I am seeing is that, companies that are, have great benchmarks, are performing well, that those companies are being funded, and they're being funded, I wouldn't say quickly, but much quicker than other companies. But I would say that the valuation in terms of it being dampened is around the same in terms of the bar is higher. We are looking for more metrics, more milestones, but that the quality is trumping everything else, and that those rounds are being competitive and they are being filled at a more reasonable time frame.
Okay. I want to get to where the bar is for the founders in the audience in a second. But Stephanie, one more question on kind of the mechanics of where fundraising is today. I've spent a lot of time in my career watching the startup world through different cycles and over longer than I want to admit in public. I've seen different funding mechanisms become popular. Convertible notes were the hottest thing for a while. Then everyone started to use safes. So when you're looking at very early rounds today, what is the main fundraising mechanism that founders want to use to both raise money and also protect their own stake in their business?
Yeah, I would say it's pretty common to see safes and convertible notes. You really don't start seeing the price equity rounds until Series A.
Okay. And but no changes there. Nothing that founders should kind of watch out for. There might be a tripwire or anything to stumble upon.
Yeah, not really on the instrument itself.
Okay, good. So if you want to raise a price seed round, don't do it, because apparently no one wants that. Actually, Stephanie, just on that point, I saw some data that said that in safe rounds, we are seeing more caps, more discounts, and other more investor-friendly terms as the funding market has changed. Are you seeing more investor protection and kind of investor-friendly terms in those safes and convertible notes in the market today?
Yeah, I've read a lot about that too, but I haven't really seen it reflected in the rounds that, I've come across. Maybe it's different in food and ag, but it seems like, the terms are pretty much the same. It's just you're seeing, at least in food and ag, a little bit lower prices. So I would say at most around 15% lower valuations.
All right. And then, Pei, same question to you about discounts, caps, and other things for safes and convertible notes. Anything that founders should be expecting, and maybe notes on what's too much?
We are seeing some slight changes. Okay, look, this is very different from 2021. I'll just say that really clearly, right? So, yes. So the standards from 2021 aren't as applicable these days. Like when we're looking at notes, for example, or safes, we are starting to see these mechanisms that investors are bringing in that maybe were more familiar in the early 2000s. Related to liquidation preferences, maybe even larger discounts, things like that. But I don't think that anything is untoward, and it's mostly just a reflection of investors, I think, being more thoughtful about how they want to deploy their capital. Frankly, the competition is great out there. There's amazing companies. The feeling of optimism that I have is that there's so many people who want to start companies to solve this problem. That is a good thing. And with competition does come, I think, a little bit of different motivations, not motivation, sorry, but
incentives.
Incentives, thank you. And so that is being reflected in some of the documents that we're seeing.
All right. So, Lori, a founder comes to you and says, hey, my seed round's looking like a $5 million cap on my safe, and the lead wants a 25% discount on this. Do those terms seem aggressive? Do they seem reasonable? Like, how would a founder from your perspective do in a round like that?
I'd say discounts are still the same, still seeing 20% max in terms of discounts. Okay. But as Stephanie was saying earlier, price is lower. I think higher dilution for the companies. I mean, we used to see 21, but again, as Pei said, 21 was crazy year, but we used to see, 20, 25% dilution per round back then. Sure. Now it's more like 30, 35. I've seen 40% dilution at seed stage. Yeah. So equity is expensive. So highly recommend to spend time looking at your budget, looking at those key milestones and exactly how much you need, because founders are taking high dilution at early stage. That's
40% sounds nearly punitive given where norms were a couple of years ago. So I'm glad you said that, because it actually does set kind of an upper bound on what people should expect. Now, everyone, I think, has mentioned raising the bar and things kind of going up from a quality perspective of expectations. Very useful as a bit of speech, but I'm curious what that means in context. So, Corinna, when you're talking about the bar being higher, for founders, what does that actually mean on the ground?
Yeah, and I think the bar is different at different stages. When, let's say today, let's focus on pre-seed, seed, and then what you want to do to prepare for A. And I'll focus a little bit more on the seed and A component. I think from what we're looking at is, as a seed stage, that not only do you have, let's say, a proof of concept, but that you're working towards commercialization, that you have a product development roadmap. You have an idea of your potential business partners, and you have I would say a decent commercialization story. And as you go into the A round, then the expectation there is you've gone from like a proof of concept partner to basically initial early traction, and you're either at MVP or really close. Some of the things I'm saying is around earlier than what you would have expected in 2021. But I think that's the sentiment in terms of generally what that means is, we're looking more for, or we're expecting companies to kind of make actual traction rather than, let's say, build on potential in the first, let's say, pre-seed, seed, perhaps A round, and just kind of moving that bar up a round earlier than you would normally expect in the heyday in 2020 and 2021.
So by raising the bar, really what we're doing is we're just expecting quite a lot more progress and kind of like hard work to do earlier on. So what you may have gotten done at an A, now you have to get done by your seed round. And I presume that goes for seed and pre-seed as well.
I don't, material impact, we don't invest a lot in pre-seed, so I'll let someone else answer that. But I would say for us, those are the things that we are expecting when you come to a seed or A round.
Okay, Stephanie, jump in on this. Raising the bar, aka moving the goalposts up a little bit. Does that track with what you're seeing from founders and also your firm's expectations?
Yeah, absolutely. I think what you're saying too is differentiation is really becoming critical. Just because it is a harder fundraising environment, a lot of the smaller companies that aren't differentiated, they just won't be able to raise. So really focusing on, your core competitive advantage, building that moat, just to have defensibility around your business is really critical. And as Corinna said, we want to see, clear metrics and some positive traction signaling as well.
All right, now let's talk about the earliest stage, the pre-seed. Pay, that means you. So please, notes on what we just heard, and also what do you expect founders to bring to the table when they're coming to SOSV for a pre-seed round?
Yeah, I think one thing that we really counsel our founders on is that this really isn't about story anymore. And even for us, so we will take companies, we'll start investing in companies that are still paper ideas. That's okay for us because we're extremely comfortable with technology risk. We're extremely comfortable working with first-time founders. And so those two things in combination do mean that we have to work off of paper concepts and a little bit of story, but much of what our team puts our effort into with working with our companies is to drive them towards reality and to no longer rely on a story and instead start building out a data package, building out traction, whatever traction can look like for a team that's still building their first prototype, or maybe just getting their first conversations with customers going. And so it's really about not being reliant on this idea of a story anymore, and simply put, building a business.
Yeah, I always found it a little bit scary when people were talking about how important storytelling was for startups. And I was like, that's interesting, because I thought high margins and rapid revenue growth were all you needed when it comes to telling a story. Like, just drop the income statement and walk away. But you mentioned traction. I thought that was very interesting, mentioning, an MVP or early customer conversations. When we think about traction for these early stage climate tech founders, what are some other examples of things that people can bring to the table to show that they have made progress, that they are ready for that next round, and that they are, for lack of a better word, serious?
I'll say this, the cool thing about where I see a lot of climate tech companies right now is that so much of what we're investing in is around making some foundational changes to legacy industries. And what that in turn looks like is that most of these companies will likely be B2B businesses who need to figure out how to engage with these legacy industries. And so effectively working your way into these 100-some-year-old companies and finding an angle that is solving a genuine problem for them is a startup's first job in building that feeling of traction or the concept of traction, even if they don't have the technology fully proven out yet. And that is where a little bit of, you could maybe call it storytelling, is involved. And that's because you have to be able to convey to these maybe conservative legacy industries what the possibilities are in the future if this technology works. And then in turn, convince them to work with you in some way, some kind of partnership, some kind of collaboration. And if you're able to do that effectively, then what you're showing to the investor is that, yeah, there's a problem that's being solved, and that there can be an income sheet sometime, hopefully in the near future.
Got it. Okay, so it's pre-income statement, but certainly there are material things you can do that show that you are not miles from that, but maybe more like months or quarters away. Okay, Lori, I want to bring you in here and get your perspective. I know that you're currently over in Europe, so same kind of landscape over there?
Actually, Europe, but still focused on the US. But maybe just to follow up on what Pei was mentioning, I mean, it's really critical for us to focus on those legacy industries and to completely reset the way we do things. The issue is that those industries are extremely cost sensitive. Many of them, take steel industry, cement industry, even agriculture, very conservative. And there are a bunch of solutions that are brought to the market with some green premium. And ultimately, I don't believe in green premium. So with that one, we focus a lot on unit economics. We want to see at the moment of our investment, from the physics fundamentals of the solution, superior unit economics, meaning that the solution ultimately is going to be at least at cost parity, if not cheaper than incumbent technologies on the market, just to make it a no-brainer for those industries to adopt the solution. Because, I mean, we need to act now. We don't have 30 years in front of us if we want to stop this increase of temperature. So we need to really reset those industries now. And we need to make it easy for them to adopt those solutions.
I mean, to be clear, not to be negative, but I'm almost disappointed to hear that you're not a big fan of the green premium, because if there was more market willingness to pay more for things that were more climate friendly, that would make this entire thing a lot easier. Dang. Okay, Stephanie, I know you're heavily in the ag space. Is there also no green premium that you expect your founders to be able to kind of reap in that area? Because when I shop for food, I always try to buy organic, free range, happy chicken stuff and so forth. So I pay a green premium weekly. So I'm curious if that does show up in your area of focus.
Yeah, especially in food, you do have to start with higher prices, but we want to see that there is a pathway to lowering your prices, because you can't really have the impact if, you're catering to only a particular subsegment of society. And particularly with farmers too, I mean, it's skinny margins. And so they really want to see something that has ROI relatively quickly. And they don't really want to experiment with things that may or may not pay off either sometimes. And so we want to see that, for instance, if they've actually gotten engagement from farmers and they've been able to do demos or pilots, and they might start more expensive, there's still a pathway to be able to lower prices.
I just realized how hard of a sector ag must be from a venture perspective, because farming margins are relatively slim. Grocery store margins are famously like 0.5% or whatever. Where is the margin in the ag sector that leads to venture style businesses? Like I know this is a little bit off topic, but I'm perplexed and very curious.
Yeah, it really ranges. So, the good thing is that companies that do have slim margins, they're looking to expand those margins, right? And so, for instance, we've invested in grocery tech that improves, inventory management, order management, analytics, it's POS systems, and just sort of the full range of things, and also reducing food waste. And so what they're able to do is actually enhance the margins of grocery stores. And then you also see with farming too, it really, the resource inputs are really expensive. So if you can lower those inputs by having more sustainable farming practices, then that actually is a huge sell for farmers.
So it's not about capturing existing margin. It's about using technology to expand margin while also doing good. Okay.
Mm-hmm.
Okay. That actually I take it all back. That makes perfect sense. I understand. Thank you for that. Sorry. I was just missing a trick somewhere in that process. All right, Corinna, I want to talk about founders some, because I have some friends who have PhDs. They love to talk about what they love to talk about, and they would not always make the best founders, just to be totally honest. But when I think about the climate tech space, I think about, and this may be very silly of me, scientists coming out to build companies and putting on a new hat, if you will. But do founders today that do focus on climate tech, do they have to have a strong scientific background themselves, or is in the founding team enough to get your firm's attention?
Yeah, I'm glad you mentioned the founding team part. It's too hard to be a single founder. So I'm a big proponent of a team. And I think somewhere in there, the technical expertise is going to be really important. A number of reasons in terms of innovation is what we hope for is that this is new innovation, new science, and part of it is just solving problems. And we expect that of not just scientific founders, but the founders in general and the team itself. So from my perspective, that element is important. It doesn't always mean that the original scientific founder is, best to be the CEO, and a lot of times they don't even want to be. But I think a well-rounded founding team is really important because at the end of the day, what we're talking about is translation of basic science into a business. And you want that IP to be valuable. You want that innovation to be valuable. And to do so, you have to understand and also highlight the business model, what you're trying to do, so that you can articulate value proposition, competitive advantage, and meeting those customer needs. So at the end of the day, it's extremely vital. Is it the only thing? No, because you need in the end of the day to basically work towards a business. And, and that I think goes back to what Pei said earlier in terms of working towards reality.
Yeah, I was going to bring Pei in, so thanks for that really very convenient segue. But in the indie bio realm of SOSV, I presume that you're dealing with a lot of folks who do have a pretty in-depth scientific background.
We do. A very significant majority of our founders are PhD holders. Most of them, some of my best friends are PhDs. Most of them were actually the inventors on the core technology. So we do see a lot of really great founder product fit. Mm-hmm. What we also really look for are founders who have good founder market fit, and that might look like some experience in industry. But what that can also look like, especially for people who are coming straight out of academia, are people who have a genuine curiosity and care and empathy for the customer that they're going towards. So that could be the mining industry, that could be the cement industry, but they have to care deeply about the problems that the operators in those, again, legacy industries are dealing with. And having founders who care and want to learn and are curious and believe they can solve a real on the ground problem, those are really the ones that are best suited to go after this hard business of building a business.
Is the number of people who wake up and go, the cement industry, that's my jam, is that a deep founder pool, or is that a thinner layer than I might expect? Because I have some niche interests, but I've never woken up and think copper mining, that's what I need to fix,
You should get out more, Alex.
They don't let me out of this room. This is just where I just stay in this chair.
Look, I will say from where I'm sitting, I see so many people, young people, early professionals, mid-career professionals who are saying, I'm done with being in oil and gas. Like this is not why I set out to go to college and work hard. Making the oil companies wealthier isn't the thing that I thought that I was going to be doing in my life. And I think it's really, exciting that so many people are harnessing that energy and being able to direct it towards technology companies that are setting out to, again, solve this existential problem that we're facing.
I fully understand not wanting to wake up just to increase ExxonMobil's dividend, but I currently work for private equity. So I think sometimes you wake up and you work for an entity, you're not exactly like, yeah, all about. So I'm with you on that. Lori, over to you. I'm curious where your firm is seeing the most interesting technological progress that's leading to very interesting startup ideas. I know that climate tech is very broad. During our prep call, we all talked about kind of the limits of it and if there are any. But Lori, where are you seeing the most interesting technology, and why does it excite you?
I think it's a good segue with the conversation you were just having. I think to me, the most interesting sectors are those untapped ones, the less sexy in a sense, cement, steel making, industrial heat processing, because in terms of carbon emission, it's actually huge. Today, venture capital, a lot is focused on the cool topics, transportation. It's over half of venture funding. And then next you have energy. But when you look at the sectors, carbon emissions are not that huge. Transportation is 15% of carbon emissions, so it's something. It's not everything. But then you have sectors like cement, as we talked about, which is roughly 7% of carbon emissions. Same for steel making. Industrial heat processes, 9% of carbon emissions. And Stephanie, with her firm focus on ag and food, because methane and nitrous oxide is much more potent than CO2. In the next 20 years, ag and food will represent 30% of the carbon emissions. So actually, that's the kind of sectors where we spend lots of time, because some very exciting technologies that are being developed, and those industries have been very kind of traditional, and not a lot of innovation have happened there.
So that's a great overview of where we're seeing climate impacting pollutants are coming from. But inside of those sectors, be it agriculture or be it cement or whatever, what are people building that's new that you think is particularly?
Like, I can give you a few examples, but
sure.
Steel making, for example. I mean, the process today emits 7% of carbon emissions. So we have an investment in a company which has developed a novel chemical process fully eliminating carbon emissions, while being cheaper than current blast furnaces. Because I mentioned earlier, unit economics are very important to us. So that's one example. Lithium-ion battery recycling, and this whole topic around critical metals is also very exciting to me. So stuff related to mining, and you mentioned copper earlier. I mean, those are topics that are really exciting, and basically new chemical approaches for metal extraction.
Corinna, I know your firm mentions working on sustainable manufacturing on its website. What are you guys seeing in that area that's particularly exciting to you and your partners?
Yeah, what we aim for is we have a broad definition of climate tech. So we look at it in terms of positive change in aggregate. And so what we're really thinking about in terms of sustainable manufacturing as one pillar is, more efficient and cleaner ways of doing the things that we need to do, to produce products that we ultimately rely on today. And so, we have a company where, if you're machining a part, it uses a lot of oil, a lot of water, and we have to figure out where that waste stream is. And if you can improve that manufacturing component by using none of those components, that's what the company aims to solve. And so, we're focused on also looking at climate tech opportunities that are not only in manufacturing, but also in other spaces in terms of mobility, or even the fashion and textile industry, which we have a number of investment in as well, which is what we're talking about is, can there be energy savings? Can there be water savings? And in many ways is finding ways for industries to be more efficient and cleaner. And so that's what we view in terms of climate tech. And so we're seeing a number of companies and innovations that address that in the aggregate. And in the end, I would say greener business is more sustainable, and that's what we aim to do.
Okay, no, I appreciate that. One thing that I've been thinking about while I was prepping for our chat today is kind of the balance point between commercial interest and viability for startups that work in the climate space, and also the sheer impact they might have on the climate, because most businesses don't have an externality that makes life better for everybody. Like if you make a new CRM, great, but it's not going to save trees. Whereas the stuff that we're talking about today does have kind of a positive financial impact and much more for all of us. So Stephanie, when you guys are picking where to invest, how much weight do you put on, I'm a venture capitalist, and how much weight do you put on, I want the planet to be healthier and this technology might help us get there?
Yeah, well, for us, our thesis entirely centers around food and ag and companies that are moving the needle when it comes to planetary health. So one has to exist with the other. And we believe there actually isn't a trade-off. And, really the most valuable companies will be created in this space. And it's not something where we could sidestep it or go around it. It's something that needs to be immediately addressed. It's a climate risk. It's a business risk for everyone. So I think for us, we see companies across the value chain that are, addressing greenhouse gas emissions, land, water, energy usage, and reducing waste. And that has to be part of, the company's mission in order for us to invest.
So I really hope that you're right. But looking back in time, the companies that have often made a lot of money that had a climate impact were having a negative climate impact. And you're describing the world, it sounds like when having a net negative carbon footprint or whatever is going to be economically viable and very profitable. Does the government kind of landscape need to change to shake up the incentives for how we treat carbon and other pollutants to make that possible? Or does the world you're describing work with how things are today?
I would say the world is changing. I think we had a huge win with the IRA. And so, that's the biggest government investment we've had in climate and energy in the history of the US. And so I think that's actually going to really spur the climate ecosystem. But you also have government programs like, at the DOE, the STIR, and also state programs, within California, for instance, CalCEF, that clean energy and climate energy or climate tech startups can really tap into. But I really think, going back to the IRA, it really could be leveraged. It's early in the process, but the incentives can be leveraged, for instance, for companies that are reaching out to customers to say, hey, you can tap into these incentives if you are doing this particular clean energy project. Let's sell this to you in this way so that you can tap into that. And that helps them unlock customers. There's also access to debt financing. And it'll also just create other market expansion opportunities as time goes on. But I think it's a really huge one for the industry, and it's really creating the ecosystem that we need.
All right, Pei, I want to bring you in on the IRA. And if you don't know what we're talking about, it's the Inflation Reduction Act. It was passed August of 2022. Just to put that on the calendar for you. But Pei, I'm curious, I've heard a lot of people talking about it. Has there been an impact for your portfolio companies and also for startups you're looking at for possible investment?
I'd say it has an impact in that it does map out some opportunities in terms of where is the financial possibility for these companies. Again, we work at such an early stage that tax incentives, for example, are going to be a few years off. But the reality is something like the IRA and the tax incentives that come with it, they are greasing the skids for the market as a whole and facilitating the intake of new technologies and new ways of doing business that are going to be more sustainable and intend to have this impact at a large scale. And so the US government does a really good job of greasing the skids for lots of large markets. And I believe that climate tech is one of these markets that should and will benefit from this similar kind of whole of government approach. It's a different enemy than World War II or the COVID pandemic. But it's no less important.
Agreed there. Lori, I saw you smiling, so I'm going to bring you in just for a really quick response to what Pei said about government regulation and impacts thereof.
Yeah, no, I think government regulation, I don't know about regulation, but the IRA, I think, fully agree with Pei, and it's going to drive more investments in the sector. But it's not only the tax credits, there are a bunch of grants available. I mean, one of our portfolio companies got $480 million from the DOE in non-dilutive funding. So there is money available out there for climate tech startups, usually at a later stage. So we need to make sure as investors to be here to help the companies leverage those fundings, because it's going to help accelerate the entire field.
All right. And then Corinna, we just have time for one more short one. When I think about the amount of work that needs to get done to get our climate kind of back on track, I'm curious, what fraction of that work do you think startups are going to be able to do in the next 5 or 10 years? And is that enough?
Yeah, I think what we're learning is, when we want to talk about making impact, we're looking at the larger industries. We're not necessarily thinking about, people driving a Prius, but we're kind of tackling large industries as a whole, these legacy industries that we alluded to earlier, and being really savvy about, what that process is and understanding how that business works today. So I would say, even though there's a lot of things to work on, I do hope that the uptake is high in the sense that we are tackling these legacy industries, whether it be in oil and gas, in traditional energy, or even in fashion textiles or manufacturing. But starting there, I think, is a good place.
All right. Well, everyone, thank you very much for your time. And thanks to @ONE, eSquared, JDJ, Material Impact, and SOSV for lending their folks to this conversation. If you are raising early stage capital in climate tech, I hope that was useful. And please keep working, because it's 1 billion degrees in the Northeast today. And I would like it to be back to normal because I am sweating. Thank you all very much. And we'll hand you back over.
I am not at all surprised that early check writers are so busy and excited by what they see. Talent and science are flooding into the category climate, and we see the results both at IndieBio and Hacks. There are so many great ideas and founders out there. Let's keep that rolling, everyone. Our next session is called Iceland, Ice, Fire, and Climate Tech. At last year's summit, we had a great session on Singapore with Grace Fu, Singapore's Minister for Sustainability and the Environment. Few, if any, nation states have as clear a strategic perspective on climate as Singapore. But then there is Iceland, which shares next to nothing with Singapore apart from its small geography and big ambitions in climate, thanks in large part to its wealth of geothermal and hydropower, the source of almost all of its energy. That's why climate tech unicorn Climeworks, a direct air capture company featured at last year's summit, built its first commercial plant in Iceland, where it can draw exclusively on green energy sources. So we are honored to have two very prominent leaders in Iceland's climate effort, a VC and a minister, for a conversation about how Iceland plans to play a leading role in the global climate effort. Here to introduce them and moderate the session is our own Ben Joff, a partner at SOSV and co-producer of this summit. Take it away, Ben.
Thank you. So yes, we're going to talk about Iceland. So Iceland is a land of about 300,000 people, an island in the middle of the Atlantic between Europe and the US, known mostly for Viking and volcanoes, but also as one of the few nations where most of the energy sources come from renewables, namely geothermal and hydropower. But there is more to it, and we'll discuss that today. It's now emerging as a special place for carbon removal technologies. So for today's panel, I have two fantastic speakers. The first one is Åslaug Arna Sigurðsbjörnsdóttir, Minister of Higher Education, Science and Innovation of Iceland since 2021, as well as David Helgason, currently founder of a new VC in climate called Transition and an initiative called Transition Labs that's bringing carbon removal technologies and more climate tech to Iceland. David is also known as the former founder of game engine Unity Technologies, currently valued over $10 billion on the US stock exchange. So maybe let's start with you, Åslaug. First, thanks for making time. I know you have a very busy agenda. Could you tell us a bit what's happening in Iceland regarding climate tech?
Yes, just thank you for inviting us to be here with you today. Iceland is, of course, like you described, we are located on a geographically isolated island, and our economy is small. We are getting closer to 400,000 people, though, and many things have happened here for the last couple of years. I would say that in COVID, we saw how drastically our economy could change because one of our biggest pillar in our economy was tourism. And we saw it quite clear that we need more pillars and more variety to our economy and to don't suffer as much for things that we can't control. So the government invested a lot in making Iceland compatible in innovation to the ecosystem of innovation and R&D funds, for example. And we have also been now changing the law on getting it easier to have here for foreign experts to Iceland for those innovation companies, so they would like to get bigger here. But Iceland also has a long history on discussing between politicians and the public, the universities, and the scientific community based on decades of managing sustainable, valuable resources, like we did with the fish in the sea. So we have one of the most, if not the most, sustainable fisheries in the world. And we are now having a similar discussion in Iceland around climate change and sustainability. And I think it is like we have a strong government and a broad political and public commitment to support and enable global climate solutions. And that is the first step. Now we have competitive innovation sector, but we always aim to go faster, and how Iceland can maybe for in the future being also, or I see it as a become a cradle of new climate solutions based on both on our knowledge, but also knowledge from abroad that see Iceland as a ideal thing to try it and piloting their solutions in a small country with where you have a politically strong commitment for fighting the climate change.
Okay, well, that leads me to ask now David. So David, you come from the world of software. You also lived for a long time in the US as the CEO and co-founder of Unity Technologies. So what has been your transition to climate tech, and how did you decide to come back to Iceland and start working on those technologies?
Sure. Yeah, thanks for having us. So many years ago, I co-founded this company. I did a bunch of software, traveled the world, did stuff in Europe and Asia and America. And that was really fun. When I managed to hire myself out of a job, I became an angel investor, invested into software and games and AI and other things that I, at least in theory, knew something about. But I also went on a deep tech journey and ended up learning about synthetic biology and then nuclear and a few other things. And first, it was just really fun. I love hanging out with the scientists. Then I found that there were people working on climate tech solutions that were just extremely exciting. I'd been worrying about climate change like everyone else, but I hadn't really found the way in. I'm not a politician, and I'm a shitty activist, and I think but when I found these companies, I knew what to do. I could invest, I could advise, and so on. So I became a very active climate tech angel investor, also an LP. I invested in a bunch of venture funds, and with these two lenses, I ended up thinking or realizing that Europe really needed a strong sort of seed and Series A stage venture firm. So I started building that a couple of years ago. We announced ourselves a month ago, but we have been partnering with companies now for well over a year. That's a European platform, so we're partnering in Europe, but also across the Atlantic into American firms, where we can be a great partner in Europe. Those are all kind of, this is all kind of happening. This has all been happening. At the same time, being Icelandic, I wanted to move back to Iceland, so I moved back almost 2 years ago. And I came to sort of realize that, besides being an incredible place and a beautiful place, Iceland has these interesting natural and societal facilities. So I ended up starting this project called Transition Labs out of Iceland, where we attempt to use Iceland as a sort of a lab, a place to experiment with scaling climate technologies. So what happens in the lab initially to kind of invent the technologies is really complicated, but then it turns out it's kind of as complicated to scale technologies in the real world, and the NIMBYism and red tape and kind of complexities around that make it really hard in big parts of the world to actually get stuff done. In Iceland, we can actually get things done, and we have a very positive government, as you'll probably notice on this panel. And we're in the middle of the Atlantic between America and Europe, so it's easy to get to. We found that it's a really good platform to work out of.
Okay, so let me turn back to Oslo now to ask about those climate technologies being piloted, because one of the biggest news probably that came in the world of climate tech was the plant set up by Climeworks for direct air capture some time ago, which at the time was, and I think still is, the largest in the world. So Oslo, can you tell us about how does it work at the government level regarding things like permitting, selecting projects, possibly community building as well around those projects that are, very unfamiliar, like kind of first of a kind for not only Iceland, but sometimes for the entire world?
Yes, we are trying to, and we have aimed to get the environment that all kinds of company could blossom. We would never know where the next unicorn would be, like we are seeing in Iceland today, that we would not have guessed that would come from even our fisheries. But I think we are trying to agile all of our system So as we are small, as you mentioned in the beginning, the routes here are shorter. It is shorter to communicate with everyone in the society, so we can make everything happen faster. Even though I still aim to get it much more faster than it is today, it is much faster than most of other countries can show themselves. So with a strong foundation of innovation, a supportive government, a talented workforce, we also, of course, have a world-class talent pool in science and engineering because of our experience with our energy, and we have 100% of green energy in Iceland. Every house was heated with hot water many years ago. So we also have, because of our land, I mean, our volcanic crazy land, some would say, that we have strong know-how in geology and maritime expertise that we hope to somehow repurpose for carbon removal. And if our talent, how we did it with the fisheries, if we could put that on to the climate solutions, that would benefit not only us, but hopefully the companies that come here, try out the solutions, and then go worldwide and big. And we have, like you mentioned, plenty of experience working in the climate space, as we are the home to Carbfix, Climeworks are here, CRI and other world-class climate companies that David is as well bringing. So we are in that discussion how we can make this more agile route, how it is easy to build up here. But David is already building it up here just because of how the system is today and how competitive we are already.
Yeah, you make an excellent point about like shorter routes, because I'm going to turn to David now. Like in many cases, climate tech companies have a long road to get permits and licenses, and it sounds like Iceland is can allow companies to maybe pilot and deploy technologies a lot faster. Oslo also mentioned some expertise in different sectors, the sector of energy, maritime. I think in a previous discussion, you also mentioned geology as an important sector. David, what kind of companies are you working with already that you're bringing to Iceland, and for what purpose?
So as has been mentioned, Iceland has already become a bit of a hub for direct air capture. That's actually not something we did. That happened without. I mean, that was happening already. In my case, I started working with Running Tide, who grow kelp out in the open ocean in a really impressively engineered system to grow kelp and then sequester it from the ecosystem by dropping it into deep trenches out in the deep ocean.
That's for carbon removal, right?
It is carbon removal, exactly. So it's a really exciting company. I got to know them a couple of years ago. They then called me up and asked. They basically been looking at the map and saw that Iceland had that like really interesting positioning in the world. They also know that the Atlantic fisheries were extremely well run. There was a lot of talent there for sort of working out in the ocean. So they asked if I could help them connect to Iceland and figure Iceland out. And so I started kind of a team, which is now Transition Labs, to help them with that. On the location, figure out the licensing, access to harbors, and so on. And they started building out their facilities last summer and are now live with deployments out in the ocean. It's a really pleasant process, in that we were connected really well with the local authorities, and just had a really smooth sailing, really fast and process. So with that experience, we decided to work with others, and now we have a few others that we're working with who want to use Iceland as this kind of place for fast experimentation.
Okay, are they all related to carbon capture sequestration, or are there other types of
No,
companies?
not necessarily. It's quite a diversity of companies. But yeah, some are. There's AbCarbon, who are using different methods to address ocean alkalinity. There's Rockpour, which creates clean and circular cement. and Noia, who are leaders in direct air capture. And finally, also collaborating with former Meta / Facebook CTO Mike Schröpfer's Carbon to Sea initiative, which is not a business, but more as an R&D project, where we collaborate with them on using Iceland as a place for doing R&D, tackling ocean acidification.
It's really interesting to hear what Iceland is doing. Like I want to step back here and just recall what the discussion we had at last year's conference, Climate Summit, where we had Singapore's Minister for Sustainability and the Environment, Grace Fu. And Singapore is also an island nation, but has a very different set of constraints on resources. They have almost no local energy source, no local food. So their challenge is more about ensuring local production on some kind of sovereignty. The difference that they have access to vast pools of capital, thanks to very large sovereign funds. Everybody probably heard of Temasek or GIC. So it's really interesting to see that even though the countries that are most active and the largest in terms of climate tech, like the US, China, and some others, don't necessarily have all the answers and don't necessarily have all the advantages to do interesting things. So maybe going back to Auslog now. So what do you see as kind of the early learnings of the deployment of climate technologies, and what do you want? What do you see the policies shaping into in the coming years?
I think what I would like to see that is very valuable that we can offer a partnership in piloting those solutions, because we need to transition a very big part of our economy and piloting solutions that do that in a smaller, nimbler society that is open to change and committed to fight climate change. And that is a valuable step in the chain to making the solutions scalable and deployable across the world. And one thing that Icelanders, because I visited Singapore last year, we can learn a lot from them, for example, in the university and research. And but there was one thing that the people in Singapore said that they could learn from Iceland. And that was our mindset, and that we always think Icelandic startups must think globally from day one. And our mindset is quoted "Þetta reddast" in Icelandic. It's like we aren't afraid of trying new things. And that mindset was something Singapore really envied us of. So I was quite happy to hear that. They have a very strong university and research system, and they are building quite fast up in innovation and tech, like you mentioned. But as we have so many, just where we are located, how our group are as people, how small the system is, and our agile innovation ecosystem now, I think it is quite unique that startup could come here, expand here, and flourish in Iceland before they go worldwide. We are always trying to get our ecosystem better. We have some changes that are just now will be in the parliament this winter to make the ecosystem even better and more compatible when we compare us to other countries. But what we can't build is something that Iceland just has. It doesn't matter what the politicians does. It is the mindset, how small we are, and of course how we have suffered here on this island with all of the geographically challenges that face us every year.
Yeah, it's really interesting, and I think that connects with what David said earlier, that you're kind of the opposite of the not invented here or not in my backyard. It's actually, please come to my backyard, please invent and bring it over. It's really like, I don't know if there's an acronym for this, but we probably need one now.
Yeah, and I think that's something we really aim to be. For solutions like climate tech, just like Running Tide did. A company from the United States, David brought here through his, and that expanded into Iceland to work on research and development, and that brings Iceland. Despite the fact the changes Running Tide will make to climate change, it also gives Iceland so much that they bring the research and development related to its carbon removal systems to Iceland and to our society, to work with our experts, and that our experts can work in these kinds of companies. This is a win-win situation for Iceland.
Yeah, that's a really very unique situation, and could be a great inspiration for many other geographies. I'm going to turn to David now and ask about maybe a topic that's kind of tricky in some cases in climate technologies, is around the community building when trying new technologies that haven't been done anywhere else. So direct air capture is not very controversial, but some other technologies can be. So is it something for which you face pushback in Iceland, or is it something you're working on, or what kind of uptake do you see for example, different forms of carbon removal that could be, I'm going to use kind of almost a taboo word here, close to geoengineering?
Yeah. Humanity has done a lot of experiments that didn't go well. So, we know that when we start doing things at large scale, we can really screw things up. So I think that's something we always have to keep in mind. On the other hand, humanity has been doing geoengineering for a few hundred years at least. Although I think you can sort of detect even longer history of that. So now we have to change which geoengineering we're doing, and it's not. I don't think we can go to zero, just stop. That's not happening, unfortunately. So we have to change which geoengineering we're doing. In order to do that, we have to do a lot of research, and some research can be done in a lab, but then you have to do other research out in the field. And we can do a lot of research and experimentation with things at scale before they really can, do big damage. So I think we have to be out there experimenting, and then when we decide as a human civilization almost that we may have to do some of these things at really large scale, we'll have to have had done them for a few years at smaller scale before. And I think it's this kind of intermediate scale that we really have to be working on and experimenting with. These are not things that can do a lot of damage by themselves at that scale, but yeah, we have to understand the implications before we go to full planetary scale.
And now that the kind of planet system Earth is moving at high speed, we might as well try to have our hands on the wheel.
Yeah, absolutely. We have to kind of gain control of the global thermostat you can think of, and if we don't do that, we can really find ourselves, with our pants down in the near future.
So we only have a few minutes left, so I will mostly turn to you now for final thoughts, and I will ask first Oslo. So today, I think there's only 3 countries that are carbon negative. There's Bhutan, Panama, and Suriname. So is that something that could be on the map for Iceland to become a global carbon sink? How would you like to see Iceland being recognized in climate technologies on a longer scale?
Yeah, I think Iceland, of course, is a world leader in many areas. We have been a world leading in gender equality, for example, for 14 consecutive years, and in many other areas. And we see that in climate, we really would like to step up more and be as well a leader to this change. And that will not happen only through big words of the government or where we set our goal. It will come through companies and individuals that have their minds to it and the heart to it. And we want to get them here to pilot their solutions so they could be the solutions for the world. So I think that is where we are heading. At least my mind is to that. And if I can build the system and support these companies to come to Iceland and, of course, to be built up here, it is the ingenuity that will find the solutions to the climate. So that is something I think Iceland will and would like to be recognized for.
Excellent. Thanks, Oslo. And so, David, final words here. So actually, sure. I just say a kind of a side note here is that last year we had a science fiction writer come to the summit, Neil Stevenson, the author of Snow Crash many years ago, one of the first works on talking about the metaverse. But more recently, he wrote a very interesting climate fiction called Termination Shock. And in this story, it's the world's climate has already gone pretty bad, and private initiatives starts to try to correct it. And I can't help but think of what you're doing with Transition Lab and what Iceland is doing, and relating it to that. So I'd like to know what would you like to see in the next 5-10 years for Iceland and for transition? And if there's also a call you'd like to make to this audience, feel free to say what you're looking for.
Sure. I mean, we're not nobody's acting at the scale that is described in termination shock. And you can debate whether that's a good idea or a good thing or a bad thing. But what we can offer at Transition Labs in Iceland is quite a lot of natural facilities. There's basically unlimited fresh water, industrial amounts of geothermal heat. The Transition Labs team is operating a 50-hectare area right next to Reykjavik, with a climate tech park near an industrial harbor, zoned for pretty much anything one might want to do that is otherwise generally legal and safe. So that's great, and if we can use Iceland as a platform for some of this experimentation, some of the scaling journeys that these companies have to go through for technologies that will then be developed into the rest of the world, then I think we'll have done a good job. So yeah, we're definitely open for business in Iceland.
Excellent. Well, Minister David, thank you very much.
Thank you.
Thank you, Ben.
So many lessons to learn from Iceland and so many amazing possibilities in their bounty of renewable energy. Now, on to our next session, scaling carbon removal. With greenhouse gas emissions still growing and an enormous emissions debt, carbon dioxide removal, known as CDR in the carbon world, is fast becoming an imperative for addressing climate change. The question is, can it be done at scale and at a price the world can afford? Researchers at Oxford estimate that the world removes 2 billion metric tons of CO2 per year through methods such as reforestation, biochar, mineralization, and direct air capture. For perspective, that's about 5% of the 36.8 gigatons we emitted in 2022. In other words, we have a long way to go. So far, carbon removal ventures have struggled with high cost, uncertain economic markets, and debates about which methods genuinely reduce atmospheric CO2. The good news is that tax credits in the Inflation Reduction Act, the IRA, aka the climate bill, are making carbon removal more attractive in the US by providing a guaranteed baseline price and line of sight for future financing. The IRA raised the tax credit value to $180 per ton of CO2 captured and stored via direct air capture. And just recently, Washington announced that it will pay directly for carbon capture, the first government to do so. We have 3 founders in the CDR space ready to bring us up to speed on all of it. Moderating our conversation is Candice Amori, the founder and CEO of Climate Vine and a veteran moderator here at the summit. Over to you, Candice.
Excellent, thank you. And huge thank you to everyone on the panel. We've got Shashank Samala, CEO, co-founder of Heirloom Carbon Technologies, Brian Baines, co-founder and CEO of Veridox, Peter Reinhardt, co-founder, CEO of Charm Industrial. And in the next 30 minutes, with the 3 of you, we're going to answer the very simple question of, can carbon removal be done affordably and at scale? Which is maybe more complicated, but I think we'll get pretty far in the next 30 minutes. So the place that I wanted to start is why is carbon removal important to our sustainable transition? And Shashank, I would love for you to start us there.
Awesome. Thanks so much, Candice, for having me. So it's simple. There is no choice between carbon removals and decarbonization. We have to start scaling up permanent CDR today. And if we want to have any chance of limiting temperature rise to the Paris Agreement's targets or reversing climate change, this is also not my opinion. It's the scientific consensus and the view of the US government, who made the monumental announcement that it will be the first government in the world to buy CDR as a customer, along with some other major moves to scale up DAC hubs. So we need carbon removal. It's not either or, it's both. And yeah, super excited to chat more. So we'd love to have other folks chime in as well, why they think CDR needs to be an important component of a sustainable transition.
I think the short version is we've already overshot, right? We've already overshot on our historical emissions, and regardless of how much we reduce going forward, we just are building up a backlog, and we're gonna have to drain it out at some point. So we got to scale that up. And when you sort of do all the math and look at all the modeling that's been done, it gets huge really fast.
And that backlog gets bigger or worse every day. I mean, this industrial equipment that we put in service 10, 20, even 30 years ago may continue to live another 10 or 20 years. And so all those emissions are cumulative in their impact. And so we have to start not just getting to net zero, but then ultimately remove those cumulative emissions.
And I think that the both and approach, I think, is exactly right. And there are going to be hard to decarbonize areas that even if we get a ton of things right, we still probably will always be needing something like this in the future, right? We're always going to be having more emissions. And so each of you are co-founder CEO of a different type of carbon removal company. You're each taking different approaches. So as concisely as you can you please give us the TLDR on what your company is and what they do? So let's start with Heirloom.
Sure. So Heirloom builds direct air capture technology that permanently removes carbon dioxide from the atmosphere and stores it for thousands of years underground with a real path towards 1 billion tons of CO2 by 2035. So our technology specifically, it accelerates a natural process that enables limestone to absorb carbon from the air from about time span of years down to about 3 days. So that acceleration is what our technology is really about. We've made history as a company about 4 or 5 months ago together with Carbon Cure, where we stored atmospheric CO2 into concrete. And now we're moving from pilot stage to commercial deployment as we speak.
Excellent. And thank you for that modeling of what the technology is and where you are right now. So Brian, let's go with you and Verdox.
Yeah, so Verdox is developing a single stage all electric carbon capture system. This system's best suited for applications where the source of CO2 is dilute, such as industrial streams with, say, 5% carbon dioxide or less. And that, of course, includes dilute natural sources such as the air. In these situations, the electric system promises up to a 3 times reduction on energy consumption due to the higher efficiency of electrically driven systems versus a conventional thermally driven system. And you can think of this advantage as similar to like why an electric motor in a car is more efficient than a gasoline or a diesel motor. And those later motors have to generate a large amount of heat, which mostly goes to waste. We're based in the Boston area in Woburn, Massachusetts, and announced an initial $80 million capital commitment last year with our launch.
Excellent. And then Peter with Charm.
Yeah, so at Charm, we do biomass carbon removal and storage. And specifically, we take crop residues and fuel load reduction forest residues and cook that into a liquid bio-oil. It's actually the liquid smoke ingredient in barbecue sauce. And we take that barbecue sauce and we inject it into old oil and gas reservoirs as a way of permanently sequestering it deep underground. I guess putting barbecue sauce underground is a uniquely American idea, perhaps. But at any rate, we are a majority of all permanent carbon removal deliveries to date and have been trying to just scale up as fast as we possibly can over the last few years.
Incredible. So we've got limestone, we've got air with Verdox as well, and the electrical component, and we have barbecue sauce with Charm Industrial. This is a really diverse, awesome crew. And so what we're going to spend most of the rest of the time talking about is how do we scale CDR, right? We're convinced that it's really important to meeting our sustainable transition goals. We're convinced that, we need to do it now because there's an urgency here. And we're convinced that the scale is large, right? And so I think first, let's think about how large is that scale actually? And wrapping our heads around that. So Peter, can you share a little bit about the scale that we're hoping to reach?
Yeah, and I think this just has to go back and draw on the scientific consensus that Shashank was talking about at the beginning, which is, what's the scale that we're going to need by 2050 and where are we today? To stay within, 1.5 to 2 degrees Celsius of warming, these IPCC reports have generally shown somewhere around 10 billion tons, a little bit of variance between like 5 and 20, but around 10 billion tons per year of carbon removal to kind of deal with all that backlog and emissions that are already baked in. And so at 10 billion tons a year, that's a lot of material. It's about 25%-ish of all the emissions that we make every year right now. So it's a huge amount of material getting moved out of the atmosphere and back underground. And to put that in the context of how much is getting delivered today, probably on the order of 10,000 tons a year is getting delivered today. So, we're talking about many orders of magnitude growth. It's something like 70% compound growth for the next 27 years to get to that scale. And to put that growth rate in context, that's twice as fast as software grew over the last 30 years. So it's a staggering kind of scale up and deploying physical infrastructure as we go. And this is in the broader context of basically needing to rebuild all of our physical infrastructure, or a huge proportion of it, to deal with climate emissions broadly on the reduction side. So it's a huge amount of growth and a huge amount of infrastructure that has to be rebuilt or built for the first time.
I actually got chills when you said twice as fast as software grew in the last 30 years, because software, I don't know if maybe the last 30 years wasn't like the heyday of it, but it feels like software grew pretty quickly in the last 30 years. And when we're talking about infrastructure, that is a wildly different thing to be talking about. So thank you for grounding us in that. Yeah.
Yeah. And I think we have to understand just like what kind of wartime footing that puts us on, right? And maybe to slide a little bit into the next topic of like, what are these biggest challenges that we're dealing with? Like in wartime, you don't deal with permitting, right? In wartime, the government says, go, do whatever it takes. And we can't be kind of tripping ourselves. Like wartime footing is like, how do you get to 24/7 operations? How do you start manufacturing on 24/7 basis? How do you start operating on a 24/7 basis? Can you even start designing on a 24/7 basis? Like, does the finance department ever shut down? Like that's what wartime means. And I don't think that we have really internalized what that wartime footing means when we think about things like permitting, where if we're talking about like multiple years reviews, where like the NEPA permitting system, by the admission of many environmental groups, is like to slow things down, like that's not going to work if what we need to do going forward to save the environment actually is to go fast. And so I think there's a huge amount that needs to change about permitting to like actually enable this to happen. Otherwise, we're kind of lying to ourselves about whether we're on a wartime footing or not.
And we're going to dig into more of this. So just to ask this question now, and then we'll dig in more, but like, who controls the permitting? Who could actually make it a wartime, like switch that flip on that?
I think it's at all levels, actually. I think you experience it at a city level, you experience it at a county level, a state level, all sorts of other jurisdictional levels through the EPA and otherwise. I think the one that has been talked about the most probably is NEPA permitting. I mean, even just today, there's pretty interesting discussion about how the shale gas boom, fracking, was enabled by, I think, a categorical exemption for shale gas fracking. But still, when you do solar or nuclear or any of these other things, you still have to go through a huge NEPA process. So like things like that are where we're just shooting ourselves in the foot in terms of actually being on a wartime footing towards the thing that we want.
Right. We're almost doing the opposite. If shale gas fracking is passed through, but everything else isn't, kind of counterintuitive. Excellent. Okay. Thank you for the framing of the scale, and then the biggest challenge on your side. So Shashank, let's talk about what you would identify as the biggest challenge to scaling CDR today.
Yeah. So in CDR, it's about scale and low cost, right? And you can, and they have, there's feedback between scale and cost, because cost is many times a function of scale. So I think the first order of business is ensuring that we have an easy path to scale. So just continue on Peter's point. NEPA is an interesting example where basically it's the same toolkit that environmentalists use to ensure to stop fossil fuel, to hinder fossil fuel production, is also the same toolkit that we have right now to permit these, solar, wind, nuclear, CDR projects. So I think fundamentally there's something wrong there, right? And because we are basically hindering ourselves to advancing the principles of the environmentalists, which is protecting the environment. So that's one. And personally, we've seen all sorts of opposition, all sorts of bureaucracy, political infighting at the local level, state level, as we were building projects. I think it is hard to understate the importance of that. And a lot of the times we talk about technology and costs and design decisions and offtake and credits and all that. But at the end of the day, it's if you cannot build out there, it's going to be very tough. So, and then number two, I would say is long-term bankable offtake. Well, I'm sure we'll talk more about creating a bigger market for CDR. What enables solar and wind to really be deployed at scale is not just the demand signal, but rather a fixed price, long-term power purchasing agreements that were bankable and that unlocked trillions of dollars of infrastructure investment. Like last year, we spent about $900 billion on renewable energy projects, and that needs to happen on CDR as well. So there's a few customers who are leading the way on what those bankable contracts look like. And there's a lot of education that's happening right now to bring the lessons from solar and wind to CDR. So that's really important, ensuring that these contracts are 10 years, 15 years, long-term, stable price signal. And I think, number three, I would say is, and it's sort of connected to permitting in many ways. We will never reach gigaton scale without the trust of the communities we stand to serve. We need to do more than create good jobs. We need robust community engagement and the way to evolve and create evergreen community benefits. I think there's I think permitting and community benefits are tightly correlated, and I think there's some movement we can do as industry, as climate community forward, where both of them can live together. So because a lot of the opposition to permitting is because the communities where we built these oil and gas plants, we didn't do right by them. So we need to figure out how there's a newer world, future, positive future that we're creating for them.
Absolutely. Yeah. So long-term bankable offtakes, and then trust of the communities, I think, were the main things that you were talked about for scale and low cost. And I want to circle back on some of these, but first, Brian, would love your thoughts if you have any other additions to add to the challenges or the main challenges that you see, or if you wanted to add on to anything that was said.
Yeah, I love what Peter and Shashank said. I'll just double down maybe on the cost piece. Mm-hmm. I think if we look at the success of some of these other industries, which did eventually get to a critical mass and did start to scale rapidly, I mean, certainly a lot of the elements that were talked about were critical components of that. But at the end of the day, the economics had to make sense. And we're not yet there in the carbon capture industry for a lot of these projects where somebody's demonstrated at a reasonable scale that you can make a profit. And so it's a critical next step in our industry's growth. And a lot of folks that we could draw into this space, a lot of sources of capital, a lot of sources of political influence, a lot of potential employees and other stakeholders, when they're going to watch these first few projects that are getting built thanks to the government, U.S. government support, and some other projects that will be started globally, and they're going to see what's happening. While that's going on, I would really encourage for the VCs in the audience, for the entrepreneurs and aspiring entrepreneurs, and even for the governments, I would say, listen, the door still is open here for more innovation in our space, for fundamentally different ways to think about this and to try to drive those costs down. So in direct air capture, for example, we're still in the single-digit percentage of thermodynamic efficiency. So you could make a 10x improvement potentially here in the energy use in these processes, and then hopefully in the cost by a more ingenious approach. Not just because we haven't been smart enough to figure it out yet doesn't mean it's impossible. Okay, so I would love to see folks think more boldly and come at this problem with cost as the goal. Maybe efficiency is one of those things that could light a path towards that lower cost, and then that's ultimately going to help us make the financing easier, get the communities on board, get the governments on board, and push us to these billions of tons that we all need to capture.
So we're going to go pretty deep on the creating the market on the cost side of things. What I wanted to double down on right now, or double click on, is permitting community engagement, because it does sound, and Shashank, you said this first, that there's this sort of feedback loop between the two of them, right? Where if the community engagement isn't there, and if the community doesn't want you there, it's a lot harder to get the permits there. And that's a big focus of the IRA with Justice 40. There's and rightfully so, right? We want a lot of the community involved in this, and there's some distrust, and there's also this undertone that I'm picking up, which is clear in the carbon removal space, that it can often be talked about from an environmentalist perspective as like we shouldn't do that, right? We should first get rid of fossil fuels. We should first do these other things, and clearly we're all saying yes and, right? Like we can do both things. We can do two things at once as long as different people are doing different things. And we mobilize all of it, right? We want to scale CDR and we also want to scale everything else in climate tech at the same time, right? Not competing. And so I guess I just wanted to think more, or ask really how much of this is like a marketing around carbon removal, how much of it is just this is permitting in general for any sort of space and climate, and is that something that we should be kind of taking out as a through line here, is that communicating carbon removal, if we could communicate that better, then some of these things would get easier as well.
Yeah, I think one thing we struggle with is, I think direct air capture struggles with, is conflating direct air capture with carbon capture and storage. Right now, for a lot of these communities, carbon capture is just one all-encompassing term. And I think CDR overall, not just DAC, is falling into that perception of these communities. In general, given there's a couple of companies involved in this space that are where DAC is highly tied to oil and gas, I think that is only reinforcing that sentiment and creating more distrust in communities. And at least something that we're working on is like, how do you start creating a wedge in that perception between direct air capture and CDR and CCS and oil and gas, because that's an important wedge. Because if you talk to communities, if you go into the ground and show them who you are, your history, how your company came about, your values and principles, and why you're doing this, it's very different than the narrative that oil and gas companies have said and will continue to say. So I think that is an important thing that we as an industry need to figure out. How do you create a wedge? How do you educate and create awareness for the kinds of companies you're seeing in this panel today, where we are driven by getting us to net zero and creating a better future for us all, and protecting these communities, taking them with us into the future, instead of creating more harm in their communities and neighborhoods. And it's really sad, honestly, because we share the same principles as they do, but I think there's just a lack of education and awareness. So
I think there's also an open question of like, what does a great community engagement program look like?
Yep.
Like, what's the prior art here? Like, the prior art isn't great. The prior art is like really bad outcomes in many cases, not all cases, for the local communities. And so does that have to be co-invented at the same time? And is that necessary, or can we maybe extend some trust that if we're having a positive climate impact, that there's good intent behind some of these other pieces as well, and give a little more runway to like simultaneously co-invent how a community engagement process should be run? Maybe there's some prior art, but I think even companies that have tried, like there was a direct air capture company that tried recently to do some community engagement, and honestly, I think set them back quite a bit. Through miscommunication and other things that maybe happened around that event. So how to do it well, and how to like find communities where people are eager to maybe get started, and stay away from the communities that don't want it right now, and let them be later adopters. So I don't know what the right path is there. I think this is super important to figure out, and super important to have local communities really engaged and bought into things that are getting built in and around where they live and work. But the path to do it is actually not clear. And I think that's an opportunity for quite a constructive process and quite a constructive set of like literature and documentation and job creation. Like every single one of these companies involved in this massive industrial transformation that has to happen is going to need a team of people that are doing this and working on this and figuring out how to do it well. So it's a whole new job category, honestly, that needs to get created, and we need experts that know how to run these kinds of processes and figure out how to do it well.
Yeah. I think it's ironic that oil and gas maybe we're great at community engagement with some shady promises that now make it harder for people with decent intentions to get things done. And it does remind me of there's some bridge that was created where it was just like wartime, like we got to do this, and it was built in like a record time. And the one thing that they did instead of permitting or community engagement was like every job is going to be unionized, right? And like they had this one rule that was helpful and helped with community engagement, but was different, right? It didn't require all the hoops to jump through. Not to say that's like the solution, but I think getting creative is definitely part of the solution here. And I think, Peter, like what you said, there's such an opportunity for anyone listening who has any thoughts on community engagement to get involved here and like to actually drive this a new way of engaging with folks at the community level.
And maybe I'll highlight one researcher who I think is doing really great work here, which is Holly Jean Buck. She recently published, honestly, something that largely agrees with kind of think the direction that we're thrusting here, which is like, if we're going to fix the environment, we probably need to get out of the way of the projects that want to fix the environment, or at least have kind of a productive discussion about how we're going to get these things deployed. And it was a bit of a call to action, I think, in the world of community engagement, which I really appreciated. But I think there are great researchers in this area, and we need to figure out how to have many, many, many more of them.
Yeah, and how to connect the dots. I think it seems like the people doing that and the people like you all that are building the solutions. Excellent. So we've covered actually a lot. We've talked about challenges around permitting, social willingness to build, technology enablement, as well. And I want to dig into essentially like the overall market, the cost, the willingness to pay. And my understanding is, we're working mostly in a voluntary market, and we're maybe moving toward more compliance procurement markets that are being built out and will be hopefully built out. But yeah, let's dig into this. So first question is, what is the size of the market today? Where does it need to go? I think we've already touched on some of that, Peter, right? That like it just needs to be scaled up. Is there anything else that we want to add to like the actual on the purchase, like on the money side, right? Like we've got the scale on the infrastructure side and the physical side. But what about?
I think you can look at the curve of purchases that have even happened over the last few years, and it's crazy exponential, right? Like the first purchase ever of permanent carbon removal, as far as I'm aware, at least of any material size, was like 2020, when Stripe had their $1 million set of RFP, and they purchased four chunks of carbon removal, and they've since scaled that up. And then Shopify followed in tightly behind that with a bunch more purchases, and Microsoft with a bunch more purchases, all in 2020. But I think in aggregate, it was like a couple $1 million. Like it wasn't like that was the very beginning. And now this year, I think you've got, hundreds of millions, probably low hundreds of millions of purchases and commitments happening now across both corporate buyers and, as of last week, as Shashank mentioned, like the U.S. government actually saying it's going to purchase carbon removal for the first time. So that's a really steep curve in demand. And I think what you see is a lot of supply scrambling to catch up now.
Shashank, would love your addition.
Yeah, right. It's sort of interesting, right? It's like I get a question. It's like, is the market supply constrained or is it demand constrained? I think in the short term, medium term, it's always supply constrained because these are big projects that need to be built. But medium to long term, it's definitely the demand signal that these large corporate buyers have to send. I think we have a pretty good footing for voluntary carbon markets. Like it's growing. There's more and more folks coming in, and more and more folks need to come in. But we're starting to. We need to start putting down infrastructure for what procurement markets from the government and compliance market looks like. Because ultimately, we think 80-90% of the demand 10 years from now will have to come from those markets. When the governments actually start putting down clear regulations, clear limits and caps on emissions on big heavy industries like cement and concrete and aviation and oil and gas and so forth, like that's where really most of the emissions are. And unfortunately, the carbon abatement cost in those markets is it's too high for their willingness to pay. So that's why you have professional services and technology and so forth who have lower emission footprint but a higher profit profile taking over the initial adopter. That's what's happening right now, but it needs to transition there, and only governments actually have the ability to create those markets.
Excellent. Brian, I would love your thoughts. So the picture that Shashank just drew for us was that essentially in the short term, supply is maybe more of the constraint, but actually in the longer term, it's the demand and the large corporate buyers. And so would you agree with that generally? What's your take on this?
Yeah, I generally agree with that. I think that, in the short term, there's only a handful of buyers that can afford to pay prices that make these projects reasonable in terms of their return profiles, or at least they don't lose too much money. But in the long run, if this industry is going to get to the scale we're talking about, the cost has to come down substantially. And at that point, we have to do a lot of market development. But we think there is a very, very large market there. And that's, the promise that the whole sector holds, and why we're thinking long term as we look at these initial projects.
Excellent. So I want to jump into CDR credits, how they're structured, how they're purchased. And then Shashank, something that you mentioned earlier was just, how do we deploy some of these larger scale projects? And I think, it might be related to this, might even bring in advanced market commitments as a potential, accelerant to some of this. But yeah, would love to just learn how the credits are created today and how we think that they could be created better in the future.
So today, there's a MRV process, there's a measurement, reporting, and verification, and that MRV process is different for any CDR pathway. There's a different protocol, and those protocols are being established today. There's lots of science and industry coming together to establish those protocols. And that will change over the next few years. So in terms of building today, right? And I think an important thing that we need to learn from solar and wind is innovation via deployment. Like, we have to learn by doing, and we have to build today and learn from it. We can't just sit in a lab and wait for all the efficiency improvements and look for the next breakthrough. We have to build. There's so many things that happen when you start actually building, right? It doesn't just take technology; it takes community engagement, renewable energy procurement, storage providers, all these ecosystem things that need to come together. And costs are also a function of all those things too. So I think, when you talk about actual specifically technology, it's only a small part of the cost stack. So we have to build today. And I think that's where advanced market commitments come as well, where you're creating this strong demand signal with high prices, just getting companies to go build and learn. And I think that just is so catalytic. And I'm sure Peter has more thoughts on this too.
Peter, your 30-second thoughts, and then we'll have to wrap.
We have a slightly different challenge, I think, than a lot of the other carbon removal companies, in the sense that we build small machines and build them in large numbers. And so I don't think we face quite such the same constraints and challenge of like short-term versus long-term supply. And then that revolves then into how the credits get structured. So I think for us, we are interested in just selling out as far as possible, because it gives us clarity on how much manufacturing capacity and so on we need to build. But for us, it's a much more continuous process. So I think over time, hopefully people get more and more comfortable with signing agreements that aren't just 1 year or 2 years or 3 years, but more like 7 years, like Frontier is doing, or more like even 20 years, like often happens in more mature industries.
Excellent. I think that's a great nuance. We are going to end with each of you sharing one sentence on what you want people to take away, right? If it's like, here's what I want you to focus on in the audience, whether you're deep in CDR, new to it, what's the takeaway? So Brian, we're going to start with you.
Yeah, we still need substantially cheaper, simpler carbon capture processes. We can't be afraid of the tech risk. Let's double down. Let's try to find the next generation of solutions here.
Excellent. Peter?
We've highlighted some of the biggest problems in the space, which we think are permitting and community engagement and getting those right. So if you're interested in CDR or the climate transition broadly, those are the areas for impact.
100% agree. Community engagement and permitting are number one things to tackle. And after that, it's learn by doing. Let's build projects and learn, and let's build more and iterate and learn again.
Cool.
What counts as carbon underground? +1.
Love that. I'm going to add in workforce. I think like the demand for operations engineers and the people like actually building this is super interesting long term as well. I second that. Let's build and let's do this. Let's be bold and get shit in the ground. Excellent. Thank you. Thank you all for joining me. This has been awesome. I've learned a ton, and hopefully you all have had fun on the panel and also in the audience.
So interesting to hear the key priorities of these CDR founders: permitting, community engagement, cheaper, more efficient technology. You might see that they didn't mention capital, which is surprising. I guess the grid, as we heard from Jesse Jenkins, is not the only permit-depending bottleneck for major climate tech categories. It's not easy to create new infrastructure fast. Now, on to our next session: funding first-of-a-kind proof-of-scalability projects. Climate tech only makes a difference at scale, but getting it to scale and doing so fast is the challenge. There is a lot of funding available for early-stage ventures, but the story is very different for what has been dubbed first-of-a-kind, or as you'll hear some of our panelists refer to it as FOAK capital, to support the construction of plants and facilities that demonstrate scalability before commercialization. FOAK funding is hard to come by because the checks are too large and returns too low for VCs, while the risk is too high for project finance investors and banks. FOAK specialists seek to mitigate the risk associated with scaling pre-revenue, capital-intensive technology. According to CTVC, mid to growth stage climate tech funding is down over 50% in the first half of 2023, which means that risk tolerance for FOAK is likely down as well. So how should these early stage startups navigate this funding environment? 3 top FOAK players from the government, private sector, and the impact world are going to weigh in on this critical topic. Our moderator is Kim Zhu, the CEO and co-founder of CTVC, and another veteran moderator at the summit.
Awesome, thank you. Excited to be here, joined by a really fantastic panel. Funding first of a kind is a topic near and dear to our hearts. We've done a bunch of series on this in CTVC, and so excited to be joined today by Laura Pierpoint, who's the Director of Early Climate Infrastructure at Prime Coalition, Douglas Schultz, who's the COO of DOE Office of Clean Energy Demonstrations, and Scott Jacobs, who's the CEO and co-founder of Generate Capital. Particularly excited today because we're joined by leaders on all different facets and sides of funding first-of-a-kind projects, from the public funding side, from the nonprofit and philanthropic side, as well as from project finance. So excited to get this conversation started. Let's see, starting with Douglas, starting with Doug. How do you define first of a kind, or FOAK, as some people like to call it?
So I think, well, particularly now in the role that we're in with OSED, the Office of Clean Energy Demonstrations, is it's obviously technology. It's first of a kind technology, but I think it really is much more than that. I mean, first of a kind can be business model. It can be the markets that it's involved in. And all of those provide kind of unique situations. But I do think most people think about it as technology.
Are there specific examples of a FOAK project from your experience at DOE, whether OSED or LPO, that you could share that could help kind of clarify that definition?
Sure. Yeah, so I think that, like, for example, if you look back at solar PV, back in the early days, before utility scale was big. So the Loan Programs Office was set up. There had been a lot of projects, small kind of projects looking at PV solar, but in general, the market was not there to do large scale projects for many, many reasons, because of the concerns about the length of the technology, et cetera. And so we basically needed to be able to show business models that other financiers could look at and understand. And once they figured out that the modularity around the technology and other things that they could replicate, they were able to kind of come into that market. So that's one where obviously it was very quick in terms of the adoption. Other technologies take more time. But it's really about showing that business model and taking away that variability that financiers need.
Yeah, if I can jump in on this a little bit and just build on what Doug is saying, I think he's absolutely right that we really think of technology first as being first of a kind. And also there are these other dimensions around things like business model. I just want to say one thing, though, which is that I think we have a little bit of a definition challenge in this space because often, people, when they say first of a kind, can mean everything from like an early pilot or sort of demonstration in some way that may not even have a revenue stream, all the way up to something that's fully bankable by project finance and traditional sources of capital. And that is a huge range of projects. So one of the things that I'd love to appeal to our community on is, can we start to converge around a little bit more specificity around those stages since there are big differences?
Awesome. Yeah, that's really helpful. I think it's always helpful to start off with a definition on the topic. Maybe to Scott, Douglas mentioned a few things on financing these projects. What are the challenges you've seen with financing first of a kind? How is this similar or different to the types of risk returns that you're looking at Generate?
Well, the minute you say first of a kind, the minute you've just closed all your financing options for the most part. Certainly any mainstream or deep capital pools are not interested in taking first time risk on anything, really. Business model, technology, scale up, any of these different ways we might define it. So we may be ruining our chances for financing first of a kind by calling it first of a kind in the first place. But I also hesitate often to paint with a really broad brush when talking about financeability or viability of a technology or of a project. You really have to get into the nuts and bolts of an individual project by project, to understand the underlying risks. Because at the end of the day, an investor, whether it's an equity investor or a credit investor, a lender, is looking to make a good risk-adjusted return. And so that all starts with understanding what those risks are and then defining whether that meets someone's expectations for a risk profile that they can support. I really liked how Doug expanded the definition from technology to things like business model. Generate has been active, as I think many of us know, in trying to pioneer new asset classes of infrastructure since our inception about 10 years ago and build that bridge to bankability, as we like to call it, for these types of assets. But it's usually really a function of the business model that we're taking something on maybe for the first time. We're taking risks on that others wouldn't take. The interesting part of it is that we knew going in, and we've only validated through our experience, that it's not just about capital taking risk. It's actually people, and a lot of different types of people that need to take the risk to build a project, whether it's for the first time or for the nth time. There are people that are building the project. And there are people involved in using the project. And all of those people are often more important than anything that an Excel model or a financier might tell you about the risks involved in something. So from our experience, we've had a lot of success pioneering or establishing the bankability of certain technologies that we believed were proven, maybe others didn't, but where the business model was the evidence of it being proven in a new form. And it really starts with demand. At the end of the day, is there customer demand for what the project is going to produce? And if that customer demand is solid enough, they might be willing to sign a contract with a fixed price for a fixed volume of output. And once you start getting that level of granularity and contractual obligations with other people, other entities, other stakeholders, you start to mitigate the risks that financiers will see with respect to a project, whether it's the first time in that business model or first time in that technology, or again, like I said, the nth time with that business model or that project.
That's super helpful. And I think, coming at it from a venture perspective, it's easy to outline the risks. There's technology risks, there's market risks. Scott, maybe you can kick this off. How would you categorize the types of risks that you all are thinking about when financing projects? You mentioned a couple like demand and offtake. What are the other broad categories you're thinking about?
I think one of the most underappreciated risks involved in building a project, whether again it's the first time or the nth time, is the actual development of the project. A technology company is not a development company. And by the way, neither is a development company a technology company. They probably should never be under the same roof. They are completely different competencies, completely different business models, talent bases, cultures, et cetera. What we've found oftentimes is that in the absence of project developers being willing to take a risk on either a new business model or a new technology, the technology company takes on the risk of trying to build that project, and they're not very good at it usually. And so what we try to do is help these technology companies either find a good developer who would be willing to take that risk or build some of that development capability. But you have to be able to develop a project, which means finding the land, getting the regulatory approvals and all the permits, selecting an engineering firm to build it, getting all of the supply chain in place so that everybody delivers on schedule and on budget, all of the different components of the project. It means getting that revenue contract. It probably means building the financing and the capital stack for that project. These are all things that have almost nothing to do with the development of the technology itself, which is what venture capitalists are good at funding. Right. And so there's a whole set of competencies, as Laura said, and as Doug was talking about, that are involved in these successful projects, whether it's the first or much later one, that really don't exist under one roof in any case. So it actually takes a lot of different stakeholders to come together to actually build a successful project. And when you're doing something for the first time, very hard to even incentivize all of those stakeholders to try, much less to actually succeed at bringing them together and bringing the best of all of their capabilities so that you have a successful project built and financed.
And just to build on that, we talk sometimes about how the Silicon Valley culture is to fail fast and break things, which is great when you're developing technology, and pretty much the opposite of what you want culturally if you're developing a project. So this is one of the big bridges we have to cross. But at Prime, at the Early Climate Infrastructure Program, we're also really thinking about all of these risks because, like Scott said, every project is really different. And so understanding very specifically which are the kind of risks that apply, and particularly if we're going to bring philanthropy to the table, how do we be really targeted and surgical around the things that we're trying to support? So certainly the project development risk, the offtake risk is big. There are some nuances with basic technology risk and engineering scale-up risk, which is also something that we're looking at. So project execution risk is buried in there and sort of the development elements of what actually needs to happen. And then there's obviously all kinds of market and policy risks and things like that we have to take into account as well. So it's a pretty huge universe of things that we're looking at.
Yeah, and if I could because I do think this is one of the really important points that we see all the time, is it's hard to have a conversation with somebody who's developing a technology and then tell them that there are other areas that are as risky or maybe even riskier in a sense. Development capital is the hardest capital to raise. And as Scott and Laura said, there are things that happen that are completely outside of your control sometimes. You could spend a lot of time on developing something that looks great, and then something out of your control happens and the entire project, doesn't work. And so that's something that is really important to understand. And also, there is no cookie cutter model. This is not something where you can just say, well, I saw this done over here. Can I just do the same thing over here? Or is it the same leverage or the same? It is, you have to understand the tools and then be creative about how you use them. And that is not, that's not an easy skill set to find. So, and kind of get everyone on the same page.
That said, it's so great that DOE now has a whole system for adoption readiness levels. That's one of my favorite things that DOE has done recently to really acknowledge it's about more than the technology.
Definitely. Everyone should check out the DOE's ARL. We created a graphic for that as well in our newsletter. Laura, I wanted to pull on that thread a bit more about types of capital and types of development capital that's out there. From your perspective at Prime, how do you think about the different types of capital specifically for funding projects, especially projects where the technology might be earlier in the greater scheme of commercialization?
Yeah, I mean, we've got a lot of the types of capital represented here, of course. I think a lot of folks, when they're looking at projects that have some element, particularly of technical risk, but really of any and all of these risks, government funding is obviously a really interesting place that they start. And it's really great to see the DOE really focused on deployment and on what it's going to take to kind of get through some of these later commercialization steps. Obviously, the folks like Scott and Generate out there that do project finance are all, very much in the mix. And it's so cool to see some of them really leaning forward into some of the earlier stages to the degree that they can. Venture capital obviously is very much part of this as well. And I think it's really interesting to see that in certain cases, we're starting to see venture go maybe even a little bit later than we had originally anticipated. In some cases, I think that's by necessity because we still see that there's a pretty big gap here. But all of these are potential sources of capital coming in. On the philanthropic side, and that's really what we do with Prime and the Early Climate Infrastructure Program, we're still honestly, I think, finding our way around what is the best role for philanthropy to play. As folks can imagine, it's incredibly important for philanthropists to be making sure that their money is really going towards its highest, best use and is really doing something that ultimately is going to have impact. That's their North Star beyond all of the financial metrics that obviously really matter within these projects. So that's really what we're experimenting with at the Early Climate Infrastructure Program. How can we really try to get things moving in this space, help bridge those gaps, but make sure that we're doing it with a really strong impact mindset?
I definitely want to come back to that point on creative accelerants or enabling factors for deployment capital. But Scott, maybe I'll turn it to you on how you think about the different types of capital and where project finance kind of sits within the stack.
Yeah, I really loved Laura's overview, and I just want to build on that. I think that there are certain players in the ecosystem now taking on new risks than they have in the past. One thing that I thought was interesting about Laura's comments is early stage venture versus late stage venture. 25 years ago, I was in the venture world for technology companies, primarily focused on software, and a late stage venture investment was a company that was producing a lot of revenue. And if it wasn't producing a lot of revenue, it was an early stage venture capital investment. Well, unless you've built a bunch of projects or sold your technology into a bunch of projects as a technology company in climate tech, you don't have a lot of revenue. So I think there may be a need for rethinking venture capital stages when you've got project risk involved in the proof of the technology's viability. And it's exactly here where there's the capital gap, but there's a capital gap in large part, in my view, because there's an operational gap. To the points I was making earlier, it takes human beings to build projects. And most developers, if you just think about their incentives are to sell projects. Build projects they can sell. That's how they make money. You can't sell a project if everybody who is in the buyer universe thinks it's too risky to buy and hold for the life of the project, call it 10, 20, 30, sometimes 50 years we're talking about here. And so it has to be so locked down for a developer to think there's actually a liquid market of buyers such that the developer is even willing to take the risk to develop the project. Hence, the technology companies often try to build that development capability themselves out of necessity. And whether or not they're good at it is not actually the point I'm making right now. Where will their venture capitalists fund that? Because that's still early stage venture because they don't have revenue. And so the cost of capital for those first projects, not just the first project, but for the projects, is quite high. And do the economics for those projects then work with that high cost of capital? Far too often, I hear from an entrepreneur or a venture capitalist, we've proven it at pilot scale. It's ready. It's ready for Citibank to make a loan and for Generate to take the equity stake. And that's just the wrong conversation to have. The conversation needs to be how many hours has it operated successfully, continuously, in the exact form we're talking about proposing for this next iteration of it. How many blue chip players have been willing to put their seal of approval on it, whether it's an insurance provider or an EPC or a customer willing to buy the output. There's as much as we've come a long way in the climate tech financing ecosystem, and we've come a long way in the human capital and capability ecosystem. We still haven't really addressed this exact point that once you're at pilot stage, how do you get to a at-scale rollout of the solution that mainstream capital will find safe enough to put their money at risk for? And that's both the capital and human capacity gap that really represents the continuing valley of death for many of these solutions.
Yeah, and Kim, if I can just jump in, I think that is one of the understanding that life cycle of the capital stack is a really important thing for anybody who's trying to develop their technology needs to understand, because it is, as Scott was saying, it's that cost of those first units that the fifth, sixth, seventh project will be cheaper, or it should be, at least for everyone expects that to happen, or they wouldn't be putting the funds in. But you have to figure out, we're here at OSED, we can help with that, right? We can actually help defray some of those costs by putting grants money into that. But it's not only what we do, it's going to be figuring out who your partners are and how to share some of those benefits too. I mean, people need to think about, if someone is coming in and actually helping you to move a project forward, it's not just that project. They're not going to do it just for that first project. They may do it because they're helping to move a technology along. And so I think there needs to be an openness to a lot of different conversations too about how to think through how to share some of that value that's being created by having the first or second project done with the capital that's coming in to do that. I think that's really important. And the other point I'll make is that on first of a kind, it's really about variability. So I think financiers in general will take risk, but they need to understand what the bounding of that risk is. And so then you can bring insurance in. Then you can figure out what the leverage is for debt. Then you can figure out what your return expectations are. But if you don't understand how to bound the variability, that's when people just stand away. So I think it's really getting those first of a kind projects to help bound and at least understand that something's possible and what the variability is as well.
Yeah, I really love both of these comments, especially thinking a little bit about the value inherent in the first of a kind projects and not just about all of the risks, because there is a lot to be said there too. But yeah, just to be clear, I think all of these sources of funding are potentially available. And just as Scott said, none of them is perfect. Like none of these were really designed to do what needs to happen right now in climate tech. And that's really kind of the why philanthropy at this stage. But even with philanthropy, I think we've got a road to hoe around really kind of, showing that there are big amounts of money that are needed to start moving this space and start designing the solutions that are going to be required to really carry this forward. And also that this is something we can do, that philanthropy can work in tandem with the private sector to really make these kinds of projects happen and ultimately to create the pathways to scale the mechanisms we're going to need.
Definitely. These are all great points. And I want to pull on some of those a bit further. There was mention of, insurance, standardized offtake, project developer education. What are factors beyond just, more capital that could actually accelerate or even mitigate these bankability risks? Scott, you want to kick that off?
Well, I think we keep going back to, whether people are willing to take these risks or not. And so I don't think, a developer should be expected to take the risk on a first of a kind anything, because he or she is likely to struggle with with the sale of that project. And so we have to solve the development gap that we're talking about. It's not just education. There's no incentive. They're not even going to get educated, right? And it does go back to what Doug was saying, I think, about sharing the value over time that gets created. But I still think most developers are going to find it too risky to think about whether they can make money on project 17 when, they don't even necessarily believe project 1 makes sense. and sense sort of with both spellings of the word. So, when I just look back at our experience and I say, okay, in 2014, we did battery storage. Everybody thought we were crazy. Now everybody thinks, we were ahead of the curve and, everybody's clamoring to get into battery storage. It's only been 9 years. But even then, I would have pointed out that we've had that technology that we were using in our battery storage projects sitting on our private parts and next to our brain in different forms. And we didn't think it was risky in those forms, but somehow we think it's risky in a server rack in the basement of a building with a bunch of software and cooling equipment and other safety provisions taken. It was a business model change to the earlier points that have been made that solved, importantly, a customer problem. At the end of the day, customers benefited from this solution being installed in this particular way, and they were willing to sign a contract that committed them to paying for the services provided from these battery storage technologies. In 2016, we did hydrogen fuel cells in forklifts. Why did we do that? It was, most people would have said we were crazy then too. It was because we were solving a very specific problem for a very specific customer. And then we did the work to understand whether the technology, the engineering, the development, the insurance could all fit together in such a way that we were comfortable with the overall risk profile. Now everyone thinks that is not a scary thing. So if you're willing to do the work on a project by project basis, and you have the team in place to not only understand the technology risks or the financing risks, but you actually have the team to do the work to mitigate the risks. Venture firms don't have that. Banks don't have that. This is work that either development companies, infrastructure operators, or engineering firms have to do, right? If you do that work, you can start mitigating these risks, and then you can bring the financing along because you've mitigated those risks.
That's a great point, and I think it was helpful too to have some examples of battery storage and hydrogen fuel cells as business model implementations of this. Doug, Laura, from your experience both at DOE and at Prime, what are some other examples of either recent or within the last decade implementations of funding towards climate tech projects? What are the types of sectors or technologies you think are coming up the curve, similar to some of the stories that Scott just shared?
Yeah, it's a great question. I mean, I think there are a number of places where we know we need to focus our energy, whether these are the right things to do next, because I think really, what Scott said is so important, that it's about solving a problem and about the incentives. And one of the things that's really hard about the climate tech space is that the incentives are not always there, because sometimes really this is about greenhouse gas emissions reduction. And where there are places like, renewable fuels mandates and things like that, there are incentives and there are problems to be solved. But there are other places where there aren't. So for example, we're seeing a lot of activity in the carbon dioxide removal space. And obviously there are some great buying signals associated with certain big tech companies and things like that. But we need government level procurement of carbon dioxide removal to create a stronger demand signal there. So that said, I think that's a really interesting space. And I think more to be done on the demand side. We're also seeing a lot of activity around things like geothermal energy generation. We at Prime and Early Climate Infrastructure really focused on electric vehicle charging because we really see that as the sticking point to get EVs on the road and decarbonize transportation. A lot of things in the agricultural sector are starting to get really exciting. So we're watching that space really carefully too. So I would say a lot of places where there are some really cool things happening, particularly on the technical development side. But there's a lot that's going to need to come together to really see these projects happen.
Yeah, and I think it's already. I think everything's really been touched on, but I think it's a lot of just continuing to drive all the various pieces. We were talking about the adoption readiness level, all these different elements that are going on. It is a very complicated, we're now in a situation where it's not the same as it was 10 years ago, where you could look at an isolated project and technology. Now you're really looking at how do all these pieces fit together. I mean, we're talking about the new hydrogen economy now, and it's very complicated, right? Regionally, it's different. You're going to have different strengths and weaknesses there, different use cases, and the transmission grid and it's all interrelated. And so there's a lot you have to look at now when you're thinking about viability and how all these pieces come together.
Picking up on that hydrogen economy and relating back to Kim, your question of something recent, we just funded a hydrogen development portfolio and partnered with a developer to go after green hydrogen opportunities. But our specific business approach here, probably unsurprising given my earlier comments, is that we have specific customers who have a specific need and a specific willingness to pay under a contract for green hydrogen. So we're building for them and figuring out how we can replicate and scale that. Similarly, we have a wastewater technology that we've been involved with for many years, where we are the customer. We own a bunch of wastewater producing assets. So we've been looking for a technology solution for our problem. And so we went and canvassed the market because we are the owners and operators of these assets. We now know what will work for our assets, and we believe it will probably work for others, but we're actually just satisfied if it just works for us. And so we need to develop these wastewater technology solutions for our projects alone. And if they work for us, then there's likely a greater applicability and a greater addressable market for it. But again, we will be solving our own problem, taking sort of the customer lens on ourselves with that technology selection and that project development activity.
Fantastic. And I know we're getting to time now. There's so many areas we could dig into, but I want to leave it with one final question. I'd love everyone to answer it. Since many of the audience today will be climate tech founders, whether they're early or late in their journey, what is one takeaway that if you were talking to this founder, what is one takeaway you would tell them if they're thinking about raising financing for projects later down the road? Anyone should feel free to start.
Be very careful selecting your partners. You need the right capital partners. You need the right development partners. You need the right regulatory partners. And there are no shortcuts. No matter what people say, there are no shortcuts, not only to finding those right partners, which takes a lot of work, but to aligning your interests with all of theirs. And that takes a tremendous amount of work. But do the work. You won't regret it. And if you don't do the work, you will.
Yeah, and I'll just throw in, and it's kind of building on that. It's understand what your value proposition is. And it's going to be different to different people. So as Scott said, there are some that may have a higher willingness to pay for something. You may go after that market first, but it goes hand in hand. You need to make sure that all those partners understand and they understand the value that they're getting, and then everybody's like Scott said is aligned. But I think that's something that sometimes founders don't understand is they understand their technology, but they're not understanding why it's actually valuable to somebody.
I'll just say one thing, which is I'm going to speak to the founders who are in it for impact and who are really here for solving the climate problem and getting to net zero, because those are the folks we want to be working with. And what I will say to them is don't ignore equity issues and community engagement. I think for a long time, we've been thinking about this as something that's sort of an add-on to how we think about the climate space, and we need to rethink that. And this is not just because that's the right thing to do. It's because that's how we're going to solve the climate problem, is by actually engaging communities. That is going to speed up your project development process. That is going to enable you to have impact at global scale. So that's something that needs to be integrated into your thinking from moment one. And we're really very interested in supporting folks who think that way.
Totally agree with that.
Awesome. Thank you so much, everybody. This was fantastic. And thank you to SOSV for putting this on.
Wow, that was a lesson in raising funding that you don't often get in the VC world. Choose your partners, developers, regulators, funders very carefully and make sure your interests align. And above all else, work on community engagement, a theme we've heard before and will likely hear again. These are big projects with big impacts, and we have to be thinking critically about the people on the ground whose lives are affected. Now, on to our next session, making the hydrogen value chain work. Hydrogen is a promising but finicky energy source with the potential to decarbonize steelmaking, ocean shipping, chemical manufacturing, and more. However, the universe's most abundant element can be inefficient and dangerous, and the hydrogen economy hype has fizzled many times before. The biggest challenge with hydrogen is efficiency. Unfortunately, hydrogen is so reactive that it rarely exists freely on Earth and must be generated by some industrial process. The most common method, steam methane reforming, SMR, uses natural gas and steam to create what's called gray hydrogen, which is typically used in ammonia and fertilizing manufacturing, oil refining, and other chemical processes. Climate technologists hope to shift the bulk of production to emission-free green hydrogen by using renewable electricity to split water via electrolysis. The most pressing issue for green hydrogen is forthcoming guidance from the U.S. Department of the Treasury on how to interpret the Inflation Reduction Act's hydrogen production tax credit. This awards up to $3 per kilogram of hydrogen produced. But how green does the hydrogen have to be to qualify for this tax credit? The other significant issue with hydrogen is transportation and storage. Hydrogen transitions from a gas to a liquid at negative 253 degrees Celsius. For some quick math, that's actually negative 423.4 degrees Fahrenheit, and has only 30% of the energy density of natural gas, making transportation costlier in the same proportion. What will it take to overcome these issues and scale hydrogen? Well, we'll turn to some innovators in the field for answers. Our moderator is Maria Gallucci, a senior clean energy reporter at Canary Media, where she covers hard to decarbonize sectors and efforts to make the energy transition more affordable and equitable.
Thanks for the introduction. We're here talking today about the hydrogen value chain. So hydrogen is a promising, potentially green, and complicated energy carrier that could help decarbonize a lot of heavy industries, steelmaking, chemical manufacturing, ocean cargo shipping. So we'll be covering some of the challenges facing hydrogen and talking with technologists about how to unlock the full potential for the energy transition. So joining us today is Natasha Kostanuk, founder and CEO of Ayrton Energy, which is developing liquid organic hydrogen storage technology to enable safe, scalable distribution of hydrogen without the need for cryogenics or pressure. Rafi Garabedian is CEO and co-founder of Electric Hydrogen, which is developing new electrolysis technologies to produce green hydrogen for heavy industries like ammonia and steel. And Xiangkun Wu is a founding CEO of Amogy, which is developing an ammonia-to-power system that releases hydrogen from ammonia that feeds into a fuel cell with the goal of powering semi-trucks, cargo ships, and other heavy applications. So I thought I would start us off asking about the supply side. Obviously, hydrogen is used in a lot of industrial applications today. Almost all of the hydrogen is produced using fossil fuels, primarily natural gas. So I'm curious if any of you could comment on sort of where the green hydrogen market is today. That is, hydrogen produced using renewable electricity.
May I jump in on that one?
Yeah, please do.
Hey, Maria, it's a great question. At our company, we are very, very focused at Electric Hydrogen on that singular question, how to make green hydrogen at scale and cheaply in an inexpensive manner. I love the way you framed the introduction to this panel, potentially green. And that's exactly right. Green hydrogen is potentially green, potentially zero emissions, but only if it is produced using truly green electrons sourced from non-emitting generation assets. Of course, that could be hydroelectric, that could be nuclear if you consider that as part of the green zero emissions ecosystem. But in our point of view, the most scalable and globally accessible form of clean energy is solar and wind, so-called renewables, which are luckily now extremely inexpensive from the perspective of levelized cost of energy. The only issue with solar and wind, of course, is that the capacity factor is low. Right? They're intermittent resources that aren't operating all the time. And that puts the burden of cost. We think about levelized cost of hydrogen production. That puts the burden of cost on the capital plant. The capital plant, because it's only operating intermittently, small percentage of the time, has to be that much cheaper. That's a formidable problem, but we believe it's a problem that can and is being solved. That's why we're in the business. And it's all about producing low-cost green hydrogen from renewable electrons.
I'll add that I think a lot of the new projects that are coming are really coming out of collaboration and different hydrogen hubs as well, which I think is a great way for different groups to share their knowledge and share their resources, which will, accelerate the adoption of renewable energy and green hydrogen, which I think is very important going forward. And the more we can do to support those hubs and support the collaboration, I think will continue to accelerate that market.
I would agree with both of the prior speakers. And just to add on, one of the problems that we see for the green hydrogen production, of course, in addition to the intermittency of solar wind, as well as the low capacity factor, and offtake is not really existing there. So there needs to be massive offtake coming to the market so that supplier side can really start building much larger supply of the green hydrogen. But that's also at the same time, it is coming, especially given the IRA and other tools coming to the States and other areas as well. And also hydrogen as other molecules such as ammonia or LOHC can really help start improving that supply side, because hydrogen in different forms sometimes can be transported and stored much more effectively.
I realize that none of us quite answered your question. I want to throw out one more word on this, if I may. The way we talk about it in our company is there's a hype to reality ratio in green hydrogen today, which is extremely large. So we track project announcements, electrolyzer project announcements, green hydrogen production project announcements. We track the ratio of those to actually producing and those that have reached FID, financial investment decision. And those ratios are astronomical. So there's a lot of talk, and a lot of people in the value chain in the industry are thinking about experimenting on very small scales, megawatt kind of scales. The real game change occurs when the scale of green hydrogen production reaches 100 megawatt pixels and above, ultimately to gigawatt scales. And of course, that's not really happening yet. So we're at the very cusp of this industry. We're just starting to see the tip of the iceberg. And we don't know how big the iceberg is, but I think collectively on this panel, it's our goal to make sure that iceberg's really big.
Yeah, thank you for all that. I think it's as you said, there's a lot of hype, but also kind of excitement and hope that this green hydrogen will sort of realize its potential. But obviously, there's still some catching up to do between what actually exists and the aspirations. Building a bit on what Sang-Hoon said, talking about kind of new uses or kind of building up the demand side as well. I'm curious if you could expand more on that. We're talking not just about making hydrogen in new ways, but also using it in new ways too. So what are some of the exciting new applications that you're seeing, ways that we could start using hydrogen?
So probably I can start out. And of course, hydrogen for the use cases such as hydrogen-based trucks and hydrogen-based ferries are actually commercially available. But what we have been seeing as a potential challenge of deploying hydrogen at the massive scale has been around the transportation and storage of the hydrogen. That's probably where ammonia and LOHC can come in and help, especially around ammonia and LOHC. Probably I can speak for ammonia given what we are working on. And ammonia-based technologies and also applications are being developed very, very rapidly. Now people talk about using ammonia for power generation and shipping, especially the maritime shipping, where energy density is highly important, as well as the affordability of the fuel. Ammonia seems to be one of the leading answers for decarbonizing that heavy industry in the next couple of decades. And countries such as, Singapore, Korea, and Japan, where renewable energies are not large enough, those areas are also looking to use chemical like ammonia for decarbonizing the utility in the grid as well. So we see excitement coming from many different angles, but of course there are still questions and challenges. But we stay pretty optimistic about those challenges to be solved in the next few years.
Yeah, and I'll add a little bit more about the LOHC specifically that we've been seeing and some of the demand and the interest that we're seeing from potential markets is like utilities, being able to balance as they shift towards more and more renewable energy as their grid and decarbonizing their grid. There's a need to balance the seasons, winter versus summer supply and demand. And so being able to do long duration energy storage, hydrogen's a really great tool for that. And using a liquid organic hydrogen carrier allows you to store the hydrogen in available infrastructure that we use today to store diesel or gasoline. And so you can reuse that existing infrastructure to manage that energy storage. And the other one would be backup energy generators, for example, like data centers or other places where you want to replace diesel or natural gas generators to decarbonize. Being able to move LOHC in a similar way that you would move or handle diesel allows us to decarbonize some of those hard to otherwise decarbonize markets.
One final word, if I may, on this. So the existing applications for hydrogen, ammonia production for fertilizer, represents on its own about half of the global production or consumption of hydrogen. And rough numbers, that industry converting it to green hydrogen implies about a terawatt of new hydrogen production by electrolysis. Massive number. And then when we think about the other existing opportunities for hydrogen, it's a massive market with a lot of opportunity without even developing new applications. But there are a lot of exciting new applications, and they go from primary steel production via the direct reduction of iron process, all the way to, as mentioned already, the intercontinental transport of energy, which is going to continue to be part of the overall energy landscape geopolitically, and an important segment of the energy industry that needs to be decarbonized. We move hydrocarbons today. We're going to have to move something else in the future to supply parts of the world that are energy poor in one way or another, with energy from now areas that are renewable resource rich.
Yeah, it's a great point that it's not just that we need to, or at the same time that the industry is looking to expand into maritime shipping, backup generators, these other applications, there's still a need to decarbonize existing hydrogen production. So it's cleaning up what's already there and providing a pathway for other industries to decarbonize as well. And I'm curious, and this is kind of building on what Natasha was talking about a little bit, mentioning that existing infrastructure. To what extent does the existing infrastructure for hydrogen, the existing supply chain, support this scale up? Where is it working well?
Yeah, I guess I can jump in there first. So for the technologies such as what Ayrton's developing with our liquid organic hydrogen carrier, or LOHC, we can store hydrogen in a room temperature, room pressure liquid that can be handled no differently than diesel or gasoline, which allows us to reuse existing oil field infrastructure. That would be tanks, tank trucks, rail cars, pipelines, etc. And so being able to reuse the infrastructure is useful because it obviously reduces the cost. And a lot of that infrastructure has decades left in its life, especially when you're looking at pipelines. And so being able to reuse that will also allow companies in industry to continue to adopt hydrogen. They'll be more likely to want to adopt it if they can reuse their existing infrastructure.
I would echo that. So reusing existing infrastructure is going to be really the key to jumpstart the hydrogen economy using different chemicals. And ammonia is also pretty well positioned in that angle because as ammonia's current use case as a fertilizer, in the United States, for example, we have longer than 3,000 miles of the pipeline available and existing, together with the 10,000 storage size, as well as globally carrying carriers and ammonia carriers, as well as other ports dealing with the ammonia daily basis. Those that can really help in the adoption of the ammonia within the hydrogen vector for ammonia, as a fertilizer, as well as the ammonia as a fuel use cases as well. We can really leverage the existing infrastructure, which also comes together with the knowledges around the safety handling, safety transportation that people acquired over the course of several decades as building those infrastructures as well.
Right, which is especially key, with hydrogen and especially ammonia as well, given the toxicity and kind of these other characteristics. As you mentioned, that there's sort of these existing protocols and expanding efforts to expand these protocols as well as it moves into new industries.
100%. Of course, ammonia as a fuel, that's the area people have never explored. But at the same time, ammonia as a commodity and the cargo, that's the area people have explored longer than about a century. So that knowledge is already being transferred to the new use cases such as shipping or in the power generation, where people still handle the storage and dealing with the ammonia. So an infrastructure along with the transfer of the knowledge will really help the industry to adopt chemical like ammonia as a new use cases to really enable the green hydrogen economy.
And where are there instances where the existing infrastructure doesn't kind of meet the challenge? Where are you seeing it sort of fall short, and what needs to be done to expand how we move, store hydrogen in order to kind of realize the full potential of this energy?
If I can, I'll jump in on this one, then pass the baton. So from my point of view, the infrastructure today is essentially non-existent and needs to be built or converted one way or another fairly rapidly in order to decarbonize the sectors we're talking about. Here in the US, for example, there's probably the longest hydrogen pipeline is a few hundred miles long. All of the substantial substantive hydrogen pipelines are in Texas, Louisiana, kind of that corridor around all the refineries and natural gas production in that region. And they really serve to connect steam methane reformers producing hydrogen from natural gas to end users, typically ammonia plants, but also methanol plants and refineries, petrochemical refineries. We know how to do it. It's not very different than moving natural gas. We have a massive natural gas aggregation and transmission network in the US that ultimately needs to be converted or rebuilt out as a hydrogen aggregation and distribution network. It's not far-fetched. It is, in fact, what we did for natural gas over the period of about 40 years. And so we know it can be done. Of course, as we've already discussed, the impetus to building that infrastructure really comes from the production, being able to produce green hydrogen cheaply enough and at volumes, and on the demand side, converting use cases to take green hydrogen.
We've touched on this a little bit already, but the Inflation Reduction Act, which Congress passed last year, has potentially billions of dollars to jumpstart a hydrogen industry in the United States. And so I'm interested to hear from you how you expect this infusion of money might affect your own companies in particular, but also sort of the broader hydrogen value chain. What aspects might stand to benefit the most?
Yeah, probably I can start. So, especially the IRA, which provides the $3 for green hydrogen, depending on the carbon intensity, that is actually accelerating the production of the green ammonia, given that ammonia uses, as Rafi mentioned earlier, hydrogen as a feedstock. So that really accelerates the availability of the green ammonia, especially around the Gulf Coast area, where there are multiple really billion-dollar projects going on to produce green ammonia from 2025 plus. So the availability of the green ammonia for our business, even if our company is at the downstream converting that ammonia to electricity, but that really gives the comfort for our customers about the future availability of the fuel, as well as the full-scale decarbonization from well to wake. So that helps the company to really expand the business to multiple areas where, they were not really excited in the beginning, simply given the worries around the availability, but that is being relieved much given the IRA coming in the States.
I can just jump in and give the Canadian perspective because we're a Canadian-based company. And obviously the IRA isn't directly impacting us, but being that a big part of our market and go-to-market plans are in the US, it definitely helps us. be able to get into the market here as it continues to be accelerated by those incentives. But we're also seeing the pressure on, the Canadian government to also match the same kind of incentives in order to stay competitive in the hydrogen market. And that just is going to benefit Canadian companies and American companies that want to work in Canada as well. So it's great to see countries taking the lead on those kind of initiatives. And it does, really encourage other countries to follow suit, which is great.
For those of you who aren't aware, my heritage is from the solar industry, and I'm kind of a solar old-timer, which means I had the benefit of participating in the solar industry's initial growth that was largely driven by the German feed-in tariffs. Very, very robust incentives, not like the IRA, but of similar intensity and transformative power. Those incentives were in fact transformative, and we would not have today's solar industry without such incentives. But there's also a dark side to these incentives because ultimately, as the industry matures and grows and scales and becomes cheaper and cheaper, the incentives need to scale back. And sometimes the political process of scaling incentives back is disruptive and nonlinear. So the IRA, from my point of view, is in fact doing what it should be doing, stimulating green hydrogen projects in the US. And also, I agree, it's a very good point, stimulating international kind of alignment around other incentive programs in other countries. However, I do remain quite cautious about how these incentives will ultimately unfold in the longer term. And really, I think the whole green hydrogen value chain, the whole industry, should keep its eye on the ball. We have to make green hydrogen production, midstream transport, and utilization cost competitive to the alternative fossil resources. If we can do that and free ourselves from the necessity of incentives quickly, then the incentives will have served their purpose and the industry will grow organically. That's, I think, the call to arms for me.
Ravi, could you expand on, you said you're feeling cautious. I know there's concern that these incentives from the Inflation Reduction Act, other federal investments will kind of help accelerate growth of other sort of colors of the hydrogen rainbow, those made from gas primarily. Could you talk a bit about sort of more the concerns you have and any others as well?
Yeah, it's a great question. So lots of ways to make hydrogen. Many of them derived from natural gas. Of course, if we can sequester the carbon from the conversion of natural gas to hydrogen, great. The structure of the IRA, is actually remarkably thoughtful in this regard. The incentive level is structured around or indexed to the carbon intensity of the product. As long as the rules, which are still being formulated, and it's a hot topic in Washington right now, as long as the rules really truly do capture the carbon intensity upstream of the hydrogen production in its entirety, then I feel very comfortable with an organic competition between all of the ways to make hydrogen at very low carbon intensity.
Well, I think we need all of the ways to make hydrogen to really meet our net zero goals, because we need wind and we need solar, but we need hydrogen. Like, we need everything to be able to really meet our net zero goals and fight climate change. And so anything we can do to encourage all types of hydrogen, I think, are really great, because there's going to be parts of the country that are easier to do green hydrogen with, and there's going to be parts of the country that are easier to do blue or turquoise hydrogen with. And then turquoise just being the newest that I've heard of, that you make methane into hydrogen and solid carbon, which can also be used in other environmental applications.
And then blue hydrogen being natural gas with carbon capture and storage, is that right?
Oh, that's right, yeah.
Well, and kind of building on that thought, Natasha, we can start with you. I'm kind of curious about sort of this idea of potential competition for this renewable energy generation. We're going to need so much of it for decarbonizing the grid, decarbonizing buildings, powering battery-powered transportation, also producing green hydrogen. So how do you see sort of this potential competition shaping up, and that sort of the need to, how should the country the industries prioritize who gets the resources, I suppose?
Yeah, I think that's a tough one. I think the market eventually will just figure that out for itself. I think there'll be, different pushes for different types of applications in different market and different end uses that make the most sense. And I think as long as people focus on using the right type of hydrogen, the right type of renewable energy for the right market and right use case, I think the market will sort itself out on that. I think a great way to think about, and I know Rafi touched on this earlier, is renewable energy has a base load, and being able to take that base load and the excess energy that the grid doesn't need at a time and be able to use that to turn into hydrogen, is a great way to not take that energy away from the grid when it's needed, but to still be able to make hydrogen for other applications later.
Yeah, I agree with Natasha that, market will figure out itself, but the earlier market adopting the green hydrogen will likely be the lowest cost options, available, using hydrogen or other renewable fuels or energies to really decarbonize these industries. That is why, the policy, subsidy like IRA is important, as well as the policies and regulations has to be correctly structured so that we can decarbonize. We can really encourage those industries to adopt hydrogen or other renewable fuels to decarbonize fast for getting to net zero. Otherwise, purely for goodwills or purposes, is not really going to be happening fast enough to really reach the net zero 2050 that we want to achieve.
One point here, blue hydrogen is not renewable. Blue hydrogen is simply carbon captured hydrogen production. And we do also have to not only consider the non-renewable nature of it, you're pumping stuff out of the ground that can't be replaced, but we also have to consider the upstream methane emissions from the production of blue hydrogen. So when we talk about truly green hydrogen, truly clean hydrogen, this comment about careful accounting of emissions has to go all the way to the wellhead in the case of blue hydrogen, and it has to go all the way to the power plant in the case of green hydrogen. I do want to reframe the question, though, and the question you asked is a very, very common framing. It presumes that renewable power is a finite resource that can be built at a finite rate. And of course, it is finite in the rate that it can be built. But the real constraint to building solar and wind is actually not the equipment. The real constraint to building solar and wind is the interconnection to the grid and the ability of the grid to absorb variable renewable generation without breaking the ramping rate capability of the grid, of the other assets on the grid, to support continuous supply and demand matching. Green hydrogen production, even off-grid green hydrogen production, directly coupled renewables to electrolysis, actually decouples a whole sector of industry that can use hydrogen from the electric sector. And that decoupling, rather than integration, of course they can be loosely integrated, but that decoupling ultimately allows us to build renewables bigger and faster than we can build them just as electric resources. So I think it's not actually competitive. It doesn't have to be an either or, it can be an and.
Thanks. Well, we have just a few minutes left in the panel, so I wanted to open it up to all of you. If you had any final thoughts or closing remarks that you would want to make about this topic we've been talking about, the hydrogen value chain, its challenges, and how to unlock its potential.
I think one of the things that maybe we didn't get a chance to touch on is just as we continue to see these incentives and these programs like IRA being announced, the sooner we can have clarity on these incentives and exactly what they mean, the quicker we'll be able to invest in projects and the quicker we'll be able to get these projects built. And so I think that's one of the messages that we need to continue as an industry ask for is clarity from our governments and exactly what they're looking for and where these lines so that we can start those investments and get those projects, shovel ready and get them done.
Yeah, I'll double down on that statement. Exactly right. Clarity and stability and predictability in the legislative and incentive kind of structures, whatever country we're in and talking about. I would also just add that hydrogen to be successful, green hydrogen to be successful, is a team sport. There is no single company or entity or even country on the planet that can do it alone. As we've been discussing, there's production, There's the resource side of it, the feedstock, which is energy. There's the midstream, the transportation, conversions to other chemical forms, and ultimately the use cases. So this is really, here we're discussing a retool of the entire industrial infrastructure that we've built modern society upon. It's taken us a couple of 100 years to get where we are, and we're trying to reformulate that, retool that in the manner of 30 years. It's a massive global undertaking. I'm really pleased to be here with a couple of other super smart entrepreneurs who are doing really interesting things. We don't know what technologies are going to ultimately lift and survive this transition, but we all need to be working on it diligently and together.
100% agree with that. I mean, the collaboration is really the key. Collaboration from the upstream to the downstream, the regulators, policymakers, and all of these global collaboration is really the only enabler of the net zero 2050. Otherwise, it's going to be very difficult. And on top of that, we really have to really see the urgency that may be necessary in all places, in all players in the market. Because looking at, for example, the industry that we are often speaking with, such as shipping or power generation, shipping alone, I mean, usually the maritime vessels are going to be in the water 25 years at least. So if you want to reach net zero 2050, we have to start building the boats right now, which is using renewable fuels and zero emission solution. But that is not really happening yet, but we are hopeful that we will see significant effort happening in the next few years. So which will likely be the case in other industries that we are usually talking about using hydrogen or other molecules as a fuel or as energy sources. So collaboration is the key, but all the collaborators have to feel the same urgency so that we can make that happen. That's how we see this challenge and also the opportunity in the next few decades.
Well, great. Thank you all for taking time to share your insights. I've learned a lot talking with you, and this has been a great panel. So thank you and enjoy the rest of your days.
Hydrogen is such a promising source of energy in so many fields, but as our speakers pointed out, transitioning to a hydrogen-based economy, even in a specific industry like shipping, is complicated and it will take time. And in the meantime, all eyes are on Washington and the hydrogen production tax credit. And now for our next session, the missing link, grid-level energy storage. Energy storage is the big open question around wind and solar energy, which are the linchpins in most plans to base our electrical grid on renewable sources. They accounted for 12% of global electricity production in 2022, but are expected to surpass 40% by 2030. The weakness of wind and solar is obvious. The wind doesn't always blow and the sun doesn't always shine. The answer is energy storage for those off hours. But without a revolution in long duration, meaning more than 10 hours, grid-level energy storage, meaning more than 100 megawatts, renewables will never be a complete solution. With global renewable energy capacity estimated to grow from 107 gigawatts in 2022 to more than 440 gigawatts by the end of 2023, the largest single-year increase ever, the need for a big win in storage has never been more clear. Today, we're going to hear from 3 startup founders who have raised millions to fill the energy storage gap with highly innovative approaches. For our moderator, we're happy to welcome back for a second year Casey Crownhart, climate reporter for MIT Technology Review, where she covers renewable energy, transportation, and climate policy. Take it away, Casey.
Thanks so much. I'm very excited to be here moderating today's panel. Renewables like solar and wind are getting cheaper by the year, and they're being built at a pretty rapid clip. A changing grid means there's a growing need for new ways to store energy. Now, when you think energy storage, you might think batteries, but that's not the only way to save energy for later, as today's panelists will be the first to tell you. On our panel today to talk about energy storage of all kinds, I'm joined by Kemp Gregory, co-founder and CEO of Renewal Energy, a company using abandoned oil wells and massive weights for gravity-based energy storage. Next up, we have Ramya Swaminathan, CEO of Malta, which is building systems to store energy as heat in molten salt. And finally, I'd like to introduce Claudio Spadaccini, co-founder and CEO of Energy Dome, where they're working on plants that can store energy in compressed carbon dioxide. Kemp, Ramya, Claudio, welcome, and thank you all so much for being here today. Let's get right into it. I'd love to start by having each of you introduce your work in just a bit more detail. There's a million flavors of energy storage, all with a different cost, size, duration, and so on. So tell us a bit more about your tech and where you see it fitting into the puzzle of our new energy system. Let's start with Ramya.
Thanks so much, Casey. It's a pleasure to be here today. So as you mentioned, I'm the CEO of Malta. We are taking electricity from any source and storing it in the form of molten salt on the hot side and a commodity antifreeze fluid on the cold side. And when that energy is needed back on the grid, we reconvert that thermal energy back to electric energy and send it back out to the grid. In terms of the specific niche that we are trying to fill, you can think of us as being a really good solution for a daily or weekly cycle, firming solar, firming wind. And actually, a critical need that we fulfill is to replace retiring thermal assets on the grid because we replace the inertia that is being taken off the grid. And then the final point to make is that a byproduct of our system is heat. And so we're able to offer process heat at about 120 degrees C, as well as the electricity.
That's really a really interesting kind of piece of that. I think a lot of people don't know how huge of a deal process heat is across industries. Let's take it over to Claudio next to tell us a little bit more about Energy Dome.
Thank you very much. So great to be here and have the possibility to chat. So we at Energy Dome, we have developed a technology for long duration energy storage. And our sweet spot in storage is between, let's say, 8 to 20 hours. So daily storage is our focus. So we are mainly focused to store solar PV and wind energy, which is available and is very cheap. But the issue, as we are discussing today, is how to store in a competitive and cheap way. Our technology, which is compressed CO2 energy storage, is based on all existing off-the-shelf components. And this has been the key of our, let's say, fast development. So we have been able to leverage on existing supply chain. We use turbine, compressor, vessels, heat exchangers, which exist in the supply chain in the oil and gas industry. And we have been able to put together an innovation, which is a process innovation, which is a brand new process, battery, which is able to store electricity with very high efficiency at 75 plus round trip efficiency. And we don't use any kind of rare mineral or material. And we think that this is really the bottleneck in the energy transition. So being able to offer to the market today with a technology which is ready, based on off-the-shelf supply chain, for us is the key to be competitive and to be able to enter into the market today.
Thanks. All right, Kemp, round us out. Tell us about Renewal.
Yeah, thanks, Casey. Really excited to be here as well. Really appreciate this opportunity. Renewal is solving two problems at once. There's the massive idle and orphan well issue in the United States and Canada that comes out to about $400 billion to clean up. And there's also the wind and solar simply not matching energy storage demand. So we believe that we can solve both problems at the same time, in creating human flourishing without the sacrifice of any downside. And so what we do is we take those idle oil and gas wells and we plug them, monitor them, and then convert them into gravity-based energy storage, wherein we use a regenerative winch to move a weight up and down within the wellbore. And our aim is to install on hundreds of thousands of wellbores to create a very, very flexible profile of dozens, if not hundreds of wells operating in clusters that can be anywhere from 1 hour to 100 hours of duration, all at a pretty high round trip efficiency of around 80%.
Great, thank you. And Kemp, I just want to follow up on that. I think you've described this to me before about how gravity storage seems like kind of a quirky idea, but actually, if you think about it, it's kind of one of the biggest ways we store energy. Can you just talk about kind of what that looks like today and kind of how your system is a little bit different?
Yeah, definitely. When people get what we're doing, they're often like, oh, so you're just like pumped hydro, but with steel. And I'm like, yeah, more or less. And truth be told, about 95% of the energy storage in the United States today comes from pumped hydro. We're just going to have to add a lot of different types in order to get where we want to go. So yeah, gravity-based energy storage is, I don't want to say as old as time, but probably pretty close. We're just doing it in a new and innovative way.
Absolutely. Okay, so we heard about a lot of very different big ideas, and I want to hear a bit about kind of the challenges that have come up as you've, kind of tried to execute on those and start to build stuff. So, I mean, can you each talk a little bit about that stuff that you've built or deployed so far, and kind of how you've learned along the way as you've taken these from ideas to stuff that's actually storing energy on the grid? Claudio, do you want to take that one first?
Yes, thanks. So I'm happy to start. So, I mean, from our corner, let's remember we are an Italian-based company. So, and the company has been incorporated and started at the beginning 2020. And for us, really, that the access, let's say, to capital has been a real issue because, venture capital market in Italy is not really, even comparable today to US, but 3 years ago, it was really, really early days. So from my perspective, execution of the project has really been always my, let's say, I'm not ever been that worried about that because, we are just a process innovation using existing supply chain. So we have got access to all the equipment that we needed to, let's say, to build our demonstration commercial project from the day zero. So from our perspective, really, the idea, the main, let's say, difficult that we faced during our, let's say, early days has been really to be able to sell, let's say, our project, our idea to investors. And to do that, we have been obliged to go through a seed process with a friend and entrepreneur and friend, which have supported us. And by really, let's say, developing the technology and delivering our promises, we have been gradually able to access, let's say, the European venture capital and now also much larger investors that now, make us more visible in the market. But that has been our main issue during the development of the company.
Yeah, I think you're definitely not alone in kind of having to figure out capital and that being a really major challenge. I want to hear a little bit more. You mentioned, kind of working on that demonstration facility. Are you storing energy on the grid now at that facility in Italy, or kind of how has that, building process been going as you're trying to get these out into the world?
We decided to go directly to build a commercial demonstration facility. So a facility that is working daily into the grid. So it is a 2.5 megawatt, 4 megawatt hour, let's say, plant. The size of the plant has been chosen in order to apply exactly the same technology that we will use on the full scale technology, but to minimize the capex, because of the reason that, access to capital was not that easy. But with that approach, we have been able really to demonstrate to investors that the technology is working. And every visitor which came to the plant was, let's say, just impressed. And they said, but that is not a demo. This is a plan. It's working. Yes. If you want to start, just push the button. If you want to stop, just push the button. You can try yourself. And that is the best way to get confidence from investors. And mainly, we have been able to get, let's say, confidence from investors which are technically sophisticated. So all those, let's say, investors which have deep skill in deep tech and in technology understand that our technology works well and has components which are very reliable and can last for 30 plus years.
Great, thank you. I want to hop back over to Ramya to tell us a little bit more about, Malta's process and kind of how it's been trying to build it. I know you all have been around for a little bit longer, so I'm curious what that's looked like and kind of what challenges have come up along the way.
Absolutely. And, I'm struck as my fellow panelists speak about the similarities in many of not only our journeys, but also in the underlying technology. They're all sort of, variations on a variety of themes. And one of the themes that comes up for Malta with respect to Energy Dome is very much like that technology. We are really using kind of existing subcomponents that have existed at scale in power plants globally for decades. The youngest part, if you want to call it that, of the Malta system is the salt loop. And salt has been used as a medium for storage in power plants, including at the 100 megawatt and above scale, for close to a decade now. So that's sort of the youngest portion of the system. So very much our journey has been about commercializing the integration of a system based on known and proven subcomponents, which I think is similar to what the Energy Dome technology is. In particular, in terms of challenges, one of the things I would say is that from our perspective, technology is one thing and proving out the technology is one thing, but market is another. And I would say there's actually been more of a barrier, I think, and more of a need for change on the market side. I think there are technologies that are ready to deploy, including the folks on this particular panel and others more besides. But I do think a major challenge for all of us is the fact that markets are not fully ready to absorb long duration energy storage at scale. The mechanisms that value long duration energy storage have not yet been deployed. It's a heavily regulated market. So it's really the regulators that need to kind of lead the charge here and create a market environment, including a level playing field that really values what long duration storage brings to the table. In addition to that, in many markets, electricity is regulated in silos. So typically, for example, generators and transmission can't and don't own each other because it came about from the architecture of an electricity system where you were either a generator, a transmitter, perhaps a distribution asset like a distribution line, et cetera. Energy storage shares characteristics that cross all of these characteristics. So we're going to need a new regulatory framework that enables long duration storage globally.
Thank you. Kemp, why don't you round us out again? Tell us about Renewal, challenges and what you guys have been able to build so far.
Absolutely. Yeah. So we have built a prototype that we put into the field that raises and lowers a weight that is 3,000 pounds. Which might sound like a lot, but it is not. And so we are on the cusp of installing our first commercial device, which would be a 30,000 pound weight. So that would come out to about 40 kilowatt hours. We're very, very excited about that. That's going to be in California Central Valley. And then we'll install another system just like it in 2024. And then the plan is to install 25 systems like that in 2025. So our little internal catchphrase is 25 and 25. But the main barrier we're facing, first, I 100% agree with Ramya. There needs to be a higher appreciation for the way long duration energy storage brings value to the market. And the regulators need to take the first step on that. I am up against some other regulators, which is more on the oil and gas side. I need some regulators, always state-based, to recognize that the solution I'm bringing to the market is better than the status quo. And so I know that's a bit far afield to talk too much petroleum engineering in this forum, but the mentality is more or less the same. Hey, we have something new. We're trying to bring it to market. We want you to understand that it's better than the status quo. Here are the reasons why. And we ultimately want to help you. We just need a little help in return.
I think you've all sort of started to bring this up in your own ways, but I want to kind of take this head on. Obviously, building and running a company takes a lot more than just an interesting idea or like a really solid technology. It takes a lot of capital. So I wonder if each of you could talk. You're all also kind of at different stages and came from different places. So I think people would be really interested to hear about, your funding journey so far and kind of how you're looking forward at it too. How have you gotten money? What kind of sources? Any unconventional ones? And what's it looked like? Ramya, do you want to take that one? I know it's kind of a different situation, but
I'd be glad to. And so, yes, we've been around since 2018. We have closed 2 rounds of funding and have had the benefit of having extraordinarily supportive and I would say, very insightful and skilled investors. A very nice balance of both true financials as well as strategic investors. And strategic investors bring to the table their sort of deep knowledge of some aspect, whether it's a subcomponent or a technology or actually the market side of the power industry, et cetera. So for us, funding at the top co, we have had the benefit, I think, of having had a fair amount of success there. The thing I wanted to really talk about in terms of funding is my view that there is a real white space in the funding area that when it comes to scaling up to commercial projects. So in the R&D space, in the what I'd call the true R&D space, when you're first kind of describing a technology, understanding it's proving it out from a performance and cost standpoint, as well as potentially understanding product market fit, there is venture capital. There is a fair amount of non-dilutive funding that is grant funding in the US from the DOE, in Europe from other sources, et cetera. At the other end of the spectrum, when a technology is fully mature and financeable at scale, the project finance market is deep, it's liquid, it's very much a tool that is geared towards funding projects with no technology risk. There's a real white space in the middle where venture capital is not the appropriate tool. And yet project finance is hesitant to finance the first of a kind in terms of scale ups. And it's not just about availability of capital, because there's a lot that goes into delivering a project of scale that is not just the funding of the capital stack. It includes the performance guarantees. It includes the indemnifications, to the credit backstop, to the indemnifications, to tax equity, among other partners. It includes potentially putting up bonding to the grid interconnection organization, as well as potentially the customer. And so all of these things are challenging for an emerging technology company, which typically will not have a robust balance sheet. So that is a place, I think there's some really meaningful actions that are possible on the part of non-conventional investors, including potentially governments everywhere. And so, Casey, from my perspective, I'd really like to draw attention to that white space, because I think it is definitely a place that needs to be solved for the energy transition to happen at scale.
Absolutely. Claudia, I want to hear from you as well. What has your financing journey looked like? And do you see that challenge that Ramya pointed out as well?
Indeed, I see the same issue that Ramya was let's say, explaining. And starting from our early days with our, let's say, first seed round, and then the second round, and then the Series A, I have to say that I'm really much more confident right now. So I said that from our corner, which is an Italian-based, let's say, startup, I have to say that now that we are facing the global market in terms of financing, we are by far more excited, because we see that there is a lot of more confidence. And, I have to say it's much easier job for us, right now to get to selling, our let's say the strength of our company in the market. And so now I think that now the financing at topco level also for us is something that we have an itinerary. We are building our first full-scale commercial plant, which will be ready by mid next year, 2024. But I feel that the real point is really to demonstrate that the long-duration energy storage asset can work in a reliable way in the market and can generate cash flow. It is important for us to show as soon as we can, by end of 2024, that we can be cash positive with our business. And now that we see that the access to the market is by far, let's say, more accessible to us, we are looking also to change our business model in order to become asset owner and not only OEM, because we see really the possibility to get access to big ticket, to big availability of capital. The only thing that investors want to see is that there is a business case that works, that can supply tolling contract to the market that need those tolling contract into the energy storage market at a value that is by far more competitive than lithium-ion batteries. So that is the target that we have. Then there are other issues that I think have to be solved in the market, like the performance guarantees that have been mentioned by Ramya. Those are those kind of incentives or let's say stimulation that the regulator should give to the utilities or some help to the utility in order to take the risk to adopt the new technology. Because, as usual, utilities are always very, let's say, conservative. They don't like to try anything new, even if they feel that the product is good enough. They just ask themselves, why have I to be the first mover in the market? I just wait to be the second. So this is the barrier that, in my opinion, the regulator has to help to solve. And then we, as technology provider, we have just to demonstrate that the case study exists. Today, not all around. There are specific cases where long-duration energy storage asset can generate, let's say, faster return, but we just have to show that the business case exists and can produce the right return and the faster return that investors are looking for.
Yeah, absolutely. It's really interesting to not only be coming in with a new technology, but to be, part of this really emerging, growing field of energy storage on the grid. Kemp, why don't you round us out? Tell us a bit about, your financing journey.
Yeah, so Renewal got started in 2020, and we we won a little bit of money from the university that we were grad students in, and we burned through that pretty quick. And then we decided we needed to raise more money, so we raised what we call a pre-seed round, and we used that to build the prototype and feed ourselves, basically. And that was like basically all angels. And then just about 7 months ago, we closed our seed round. That was a little bit more predictable cast and crew, more VCs, plus some angels, plus some family offices. But we also got to pair that with a $2.7 million grant from ARPA-E. So it was like a nice way to kick off the fundraising. Hey, everybody, we just won this grant. And we think it's going to, help us in the right direction significantly. So now we want to build one commercial device, the one I was talking about previously, this year, on the brink of installing it, and another one next year, and then raise a Series A. And I was imagining that would be made up of, more VCs, and then probably go after some strategics this time, probably some oil and gas company CVCs is what I had in mind. But the ideal mix would be like one CVC, one very green VC, and then, maybe space for another. But we're very much shooting for a balanced approach in who's funding Renewal, because we try to be a very purple entity, an entity that's sort of pleasing both sides. And so that's what we're looking for. Now, I've got a lot to learn, but I'm fairly certain that the Series A will be mixed, not just equity, maybe some asset-backed debt, because we're going to go out and buy a bunch of hardware. So this is one of the cards that hardware companies get to use, and so I'm looking forward to figuring out what debt and of what type might be worth integrating into our Series A.
Great, thanks. I think each of you brought up needing to make a business case for your technology and needing to prove that, you were something that, the grid needs. Can you talk a little bit about cost? Because that's, the biggest factor, I would say, or one of the biggest factors for energy storage. So how are you thinking about cost? What are your kind of targets? And do you think that you need policy in order to kind of make your business case to be on the grid? Kemp, do you want to, I know you're early stage, but how are you thinking about cost?
Sure. Yeah. Our projected capital cost, so dollars per kilowatt hour, is $5 by 2030. So it's pretty aggressive, but we think we can very much get it. It's got a lot to do with some business model innovation. It's not just pure economies of scale. So we're sort of working through not just, buy it 10,000 times to make it cheaper, but also some clever ways to get our costs down. So that's our approach. And like what I said earlier, I need policy on the oil and gas side. I need to be deemed the equivalent of traditional plug and abandonment, which is what is supposed to happen at the end of an oil well's life. And if I don't get that, then, we'll have to figure out another solution.
Mm-hmm. I mean, that's just for context for those who aren't steeped in the money numbers of energy storage every single day. That's like a really aggressive number, right? I think, lithium ion batteries are $100, $200 a kilowatt hour, depending on what you're counting in the market. And some of these other early stage battery companies say below that. So to say 5 is, you're shooting for the moon here.
Yeah, I guess they call it a moonshot for more reasons than one.
Yeah, absolutely. Claudio, can you talk a little bit about Energy Dome and how you guys are thinking about cost?
Yeah, so when I was speaking about the business cases, I was referring to, let's say, our, sweet spot is energy shifting. So our business case that we are really chasing is daily storage, so energy shifting. We are not competing in the ancillary service, but and that is what we need. So in order to get penetration of renewable into the grid to 70 or 80%, the storage that the grid need is the time shifting. So in that regards, the time shifting is the most relevant, let's say, business case. Today is possible to generate renewables, which is very cheap. With solar, you can generate electricity, which is as cheap as 1.82 cents per kilowatt hour. With wind, maybe between 2 and 3 cents per kilowatt hour. But the coal, let's say that the fossil, let's say, electricity is priced between 5 or 6 or 7, let's say, cent per kilowatt hour. So it is important for the storage, the cost of storage, to shift the daily production of solar into night is important to have a cost of storage that is less than 4 or 5 cents. And that is what we aim with our technology. We believe that already today, with our first of a kind project, we have a cost of storage, a cost of time shifting to shift the power from day to night that is in the range of 4 cents per kilowatt hour. And by economy of scale, by deploying more plant, we will be able to drop that cost by approximately 35-40% in the next couple of, let's say, 3 years.
Ramya, quickly, the cost and how you all are thinking about that at Malta.
Absolutely. And I think cost is absolutely critical for a number of reasons, right? One is that the energy transition kind of at scale, to mirror the comments from before about business case, the customer group in this case, that is utilities, IPPs, et cetera, are really looking for a cost competitive solution. So as an OEM, we really need to offer to them something that is competitive. And today, anyway, there is not a willingness, I don't believe, at scale to pay what's called a green premium. So I think really all the technologies that need to be competitive in the market need to compete on price. And electricity, ultimately, of course, is a commodity. Right. So I think part of the challenge for emerging technologies is to identify the specific market segment that supports the cost profile that enables the early deployment cases. In our case, that includes not only using the electricity, but also being able to offer this high quality process heat with which our overall efficiency ends up being 90% or greater. And then, with deployment, of course, comes a cost down. And the cost down and the cost targets, I know we were talking a little bit about numbers before, really depends on how many cycles you expect to use a year, right? So for a daily or weekly type of shifting, that's a very different cost profile than it would be for seasonal or hundreds of hours of storage. So in that context, we expect to be competitive as a daily or weekly cycling asset.
Got it. Thanks so much. Okay, I think we're almost out of time. So I'd love to hear from each of you why you're excited about energy storage right now, and why you think everybody should be excited about energy storage right now. Ramya, do you want to start us off with that one?
I'd love to. So I think the most remarkable thing that's happened in the electricity business over the last few years is that wind and solar are now the cheapest form of generation, and that for the first time ever, it doesn't really matter whether you believe in climate change, you're asking for policy changes that support green technologies, because the logic of the market means that wind and solar are the choice of generation. That's a remarkable fact. And I think it's a remarkable kind of springboard for a green future. And long duration energy storage, in my view, is the linchpin that enables the unleashing of this amazing fact, right? So we've got all this cheap generation in the form of wind and solar. We're now creating a lot of projects that generate a lot of wind and solar, but there is a limit to that. You cannot build a grid out of wind and solar or other intermittent resources. You just can't do it. And what makes it possible? Well, it's long duration storage. So to me, this is the natural next step of a journey that ends in a much greener electricity grid.
Well put. Thank you. Kemp, anything to add? Why are you excited about energy storage?
Well, yeah, Ramya basically nailed it on the head. That was amazing. I would just add in sort of Renewal's extra layer here is that, we really believe that the hydrocarbon foundation of civilization is a redeemable, massive amount of value. And we really think that the same people who built that infrastructure could be put to work doing a new thing. And that new thing basically makes no compromises. It delivers the cleaning up of millions of idle oil and gas wells while building clean energy storage that can do really, really wide, flexible output in terms of duration and term. So yeah, we're very, very motivated by sort of looking at it from two lenses. The oil and gas side, like, let's clean this up. It needs to be cleaned up. And unlocking everything Ramya just said about, delivering wind and solar to power civilization in a new and cleaner and better way.
Thank you. And Claudio, final word to you. Why are you excited about energy storage?
I'm very excited to be in a sector which is interesting for everyone. When I speak with my child or I speak around with any person, is interested in energy transition. So, and I totally agree with Ramya that it is a fact that solar and wind today are the cheapest way to produce electricity, and energy storage is just the missing piece in the puzzle of the energy transition. So, being in a market which is potentially that big, that let's say impactful for the life of every person around the world is just exciting, and that is something that it is like to be, in the real, let's say, it's really personally, really exciting and very much, let's say, motivating, because it looked like that these, the daily work that all the team and the people I'm working with is doing is really matter for everyone, and that really the long duration energy storage can really unlock, let's say, a greener future, and hopefully we will be relevant in that transition.
All right, thank you all so much. I'm gonna let you go get back to work. Thanks for joining me in this conversation. Thank you to the audience. Thank you to all the folks at SOSV. And I'll hand it back over to them.
Great session, Casey. The good news is that when you take portability out of the equation, power storage at the grid level looks like a less challenging problem. But clearly, the innovators in this field have a massive amount of building and deployment ahead of them. I hope they are talking to those FOAK folks. To help me introduce this next session, I'd like to bring in Stephen Chambers, General Partner at SOSV and Managing Director of IndieBio New York. He's my boss and one of the big reasons that everything runs so smoothly here. Hi, Stephen.
Hi, Sabriya. How's it going?
It's great. I'd really like your help introducing our next panel, but first, maybe you can give us an update on how things are going here at IndieBio.
Things are going great at IndieBio in New York. A lot of progress. Big thing this year has been we've moved into this great site at 7 Penn Plaza in Midtown. We've been running cohorts, 2 cohorts a year, minimum of 10 companies.
Can you tell us anything about IndieBio New York 7, our upcoming cohort?
Yeah, we've got a number of great companies, as you know, a number of companies. It's the typical blend of IndieBio companies that you see. So we see therapeutic companies, we see climate tech companies, we see food companies, ag tech companies. But what I'd always like about the companies that we see, there's always a couple that you go, oh my God, I've never seen that before.
I know, and I actually think I said that this time around as well. Can you talk a little bit more about what being here in New York has meant for the growth of IndieBio?
I think what New York State are trying to do across the state, across New York, is really ambitious. Growing the life science ecosystem, across the state. It's a huge challenge that they have, but the raw material is here. Like one of the numbers I quite like is there's over 200 universities in the city. 200 universities. There's 300 universities across the state. So the raw material here for innovation, like it's on the ground.
Yeah.
And we are seeing it come through.
Well, the audience has heard me introduce so many of our panels today, so I would love for you to introduce our next session.
Okay, so let me introduce our next session, which is entitled Our New Relationship with Electricity. Okay, until recently, homeowners, businesses didn't really have to worry much about electricity. When you think about it, it was like this magic thing that just appeared in the outlet in your home that you plugged your appliances into. But that's changing now, and it's changing for a host of reasons. Homes and businesses with solar have now become mini power stations, selling electricity back to the grid operators as they become even larger consumers of the electricity, thanks to charging of electric cars, heat pumps, and everything else electrical. And what's happening is a crop of startups aim to put more power, give the pun, in the hands of the consumers by giving them selective control of how they consume and distribute power. Let's hear how they see our new relationship with electricity unfolding. Our moderator for this session is Emily Pontecorvo, who was a founding staff writer at Heatmap. Previously, she was staff writer at Grist. Please take it away, Emily.
Thanks so much to SOSV for having us today. Welcome to this panel on our new relationship with electricity. As I'm sure many of you know, tackling climate change requires a massive shift from fossil fuels to electricity, whether we're talking about how we get around in our cars, to how we heat our homes, to how we power factories. But this is much easier said than done. There are challenges in expanding the grid and ensuring that it's reliable, in upgrading millions of buildings and assembling the workforce to get it all done. So it's great to be here today with these founders who are trying to solve some of these issues in really unique and interesting ways. First, we have Arch Rao, the founder and CEO of Span. Span is a tech startup that's reinventing the home electric panel for the era of electrification. They've developed a smart panel that helps homeowners more easily integrate new devices like electric vehicle chargers, and also better understand and manage their electricity use. We also have Paul Lambert, the founder and CEO of Quilt. Quilt is building a residential electric heating and cooling system that is not just energy efficient, but also aesthetically pleasing. The company is integrating this heat pump system with software that uses artificial intelligence to make the whole process of switching from fossil fuel heating as smooth as possible. So, Arch, I wanted to start the conversation with you. Why did you believe the electrical panel was ripe for a retrofit? What problems were you solving with this product?
Yeah, the electrical panel is a fairly ubiquitous device. There is no home or building in the world that isn't served by an electrical panel. And by design, the power coming in from the grid, the power being generated by new forms of energy like solar, and all of your appliances, be it an electric vehicle charger, that's a new appliance, or a traditional appliance like an air conditioning system connected to the electrical panel. To me, I think it serves as the best gateway in the home for managing both energy and power. And that's why we started by reinventing the panel. There's been an analog device for a very long time now.
And Paul, what about you? There are already very efficient heat pumps out there on the market. Why aren't they good enough? What's missing?
Yeah, so the issue isn't the efficiency. I agree. They're very efficient heat pumps out there. The issue is sort of the attractiveness of one class of the products. So you can either have ductless heat pumps, which are generally speaking large white plastic boxes, no matter who you buy them from, or you can have a central heat pump. And there's a large class of homes and buildings generally where the ductless systems are stronger on every dimension except for sort of the aesthetics and installability. And there's also a bunch of upside you can get when you network them together, and no one really does that together today. So it was about taking a product that is great on paper and making it great in real life, and unlocking some additional upside that currently isn't being explored.
So in some of my reporting on electrification, one thing that always comes up is that it can just be a really confusing process for homeowners. Like, some people are concerned that they'll be more vulnerable to blackouts or that their bills will go up. Some people talk to a contractor who tries to convince them to keep gas. And then taking a step back, this new relationship with electricity, we're entering this moment where we're sort of asking homeowners to, even get involved in energy markets and sort of selling their energy back to the grid. So I wanted to start actually with Paul here, because I know this is something Quilt has thought quite a lot about. What are the big sources of confusion around heat pumps today, and how is Quilt trying to address those?
Well, I think I just touched on one, which is there's already this decision right away around duct versus ductless, which is not something most people have ever thought about before. There's another one where, there's a lot of maybe misinformation in the market. Historically, heat pumps in the past didn't work so well on colder temperatures. That's not as true anymore. But that kind of still pervasive, especially around a lot of the sort of older workforce. So consumers will call and actually ask for a heat pump because they've learned about it somewhere and sometimes not get the right information. And so I actually had that happen. I live in Redwood City, California. It's a warm climate. When I was first getting into this about 2 years ago, I tried to get a heat pump installed and they told me it wouldn't work here. And so that was a little surprising. So yeah, there's misinformation. There's also a lot of decisions that people have to make in terms of, like I said, ductless versus ducted. Does it work with my existing home? How big of a job of it is it? The pricing is not very transparent at all. People generally don't know what they're going to spend until they get a quote, which happens after a site visit. So we just think there's a lot. Basically, the internet hasn't really hit this market. Like, there's not really good transparency, and you can't keep directly as a consumer being empowered to make a decision like you can in other markets.
So what are some of the ways that Quilt is trying to address some of these sources of confusion?
Yeah. So, the first part is create a desirable product that engenders consumer demand and pull, right? So this is a market that, honestly, the products are often treated as commodity. You don't know if you're getting a Mitsubishi or a Daikin until you see the quote. And when I said the internet hasn't hit a market, generally what happens is the consumer gets a more direct relationship with the manufacturer, right? So we don't really have travel agents anymore because we can go direct to the airline companies. But then you have to build that consumer-centric purchase experience that is empowering to the consumer. So you have to create low-friction ways for people to do research, complete purchases, get their questions answered, use the technology that they're comfortable using in order to make those decisions. So it's doing all that. It's creating a great product and then making it available for purchase online with low friction journeys that really will be familiar to people that have been using e-commerce in many different parts of their life.
And just one more follow-up on that. Who do you see as the customer base for Quilt? Like, is it anyone and everyone who wants to electrify their home, or are there particular, building types or situations where this product will make sense?
Yeah, similar. Arch said something at the beginning, which is that every home and building basically has an electric panel. It's kind of similar, right? Essentially, every building has a heating or cooling system or both. And so in some ways, the challenge of the startup is that the market's almost too big, which is kind of a funny thing to say, but it's really important to focus. So we are going after single-family homes, think detached single-family homes, suburban residences. This is 70% of America. They have an outsized carbon footprint. and they are a good fit for distributed ductless systems, whereas like window-based systems, for example, are much better fit for multifamily, not a good fit for single-family homes. And as you might expect, we're going for sort of design-centric, tech-comfortable consumers to start. These are the people who are probably on the forefront of other things electrification, right? They probably own an EV. They're looking at solar. They may well have a span panel. That's kind of our consumer.
Can you actually just describe for people tuning into this, like what, why are the existing heat pumps sort of not aesthetically pleasing, and how are you improving on those?
I don't know if I have to describe it. Maybe I can just point it out. they like truly 95, maybe 8% of the market looks like that. Doesn't matter what brand you buy it from. So, I mean, like that has a place and it's functional, but I think it was designed from a very utilitarian perspective. It's also quite large. That's the other really important factor about it, is that they're taller than most people want to put these about in places of their home where they won't fit. So another thing we really had to invest on was reducing the size so that we could kind of more seamlessly integrate with the home. It wasn't really designed for the American market. It was actually really designed for an Asian market. And then it was imported and was never really sort of rethought in terms of the form factor.
So we're still on this topic of sort of customer confusion and customer experience. And Arch, I wanted to move on to you. So the electrical panel is probably not the first thing that someone thinks of when they think, I want to make my home more efficient, or I want to electrify. So how do you sell this product? Like, how do people find out about it?
Yeah, that's a good question. In fact, electrification is not often the thing that customers are thinking about. They're often thinking about an end benefit they're getting, right? They're either looking to get resilience for their home, or they're looking to get home charging or comfort for their home in the form of air conditioning, right? So it's very rarely electrification, or definitely the electrical panel, that people wake up and think about doing, except for maybe a handful of folks that are already pretty at the bleeding edge of, let's say, green energy adoption, right? The electrical panel that we build is therefore bundled with a lot of products that customers think about buying on a regular basis or are offered by partners of ours. So we initially started off by pairing the span panel with a home battery, as the rate of outages in the US was continuing to grow, given the impacts of climate change on utilities trying to provide and supply energy consistently. Storage adoption went up, and pairing our panel with the storage products allowed us to have a relevance in that decision customers made. And we made it a very simple economic decision for them. You could either buy multiple batteries, which is often required to meet the power requirements for your home, for your whole home, or you could have a single battery and a span panel that often costs less and could still get fully software controlled or software defined backup, if you will. We expanded from there to include an electric vehicle charger that's a span-made EV charger, because EV adoption has far outpaced storage adoption, and that almost always is the first step in that journey of electrification that customers take. And that's been a very successful product for us, because first-time EV buyers very rarely have the amount of capacity, the current capacity in their home to fully charge their car at high speeds. So our panel acts as a control system, if you will, when pairing with our EV charger. And then we've been expanding beyond these two products into products like heat pumps that we are now integrated with as well.
So it sounds like what you're saying is that usually a customer will find out about span when they're sort of in the process of buying something else, like a heat pump or an EV charger. Once they have it, what are the other benefits that this product provides?
Yeah. We have a strong number of customers that come direct to span simply because of the functionality we offer or the product simplicity we offer. But once they have a span panel installed on their home, they typically are coming back. The primary mode of engagement is through the consumer app that we have, the homeowner app. And what they typically get is a functionality benefit and an economic benefit. The functionality benefit could be being able to control appliances or devices in their home that they previously could not control, right? Being able to control individual circuits, being able to monitor exactly how much power is being consumed by an appliance. And we're increasingly improving the software capabilities of our system to give consumers the ability to identify when devices might fail in their home. From an economic standpoint, it's often, people talk a lot about ongoing energy efficiency or savings from energy. I think those are hard for anybody to place a finger on, mostly because each of our living circumstances are different, right? But in almost all cases, there is a clear economic benefit when you make a considered purchase, whether you're buying a car, whether you're buying an air conditioning system, whether you're buying a battery, and that's where SPAN really shines for the customers.
So this is, this panel is our new relationship with electricity. You're kind of asking customers to become more invested in how their home works, in, choosing which devices to have on at any given time. What has the response to that been like? Are people, nerding out about this? Or do you have customers who are like, I just put it on some kind of auto setting, I don't want to think about it? Like, what are the range of reactions?
Yeah, it really does range. I think the early adopters are the folks that tend to be technophiles, and they're buying it because they really want to nerd out about it. Increasingly, we've surpassed that early adopter ecosystem to customers of one of two categories. One that is very environmentally minded and is already on that journey of buying an electric vehicle, of having solar on their roofs. And for them, this is a directionally necessary step for them to take as they continue to electrify their everyday lives. That is, switch their cooktops with induction cooktops, switch their heating systems with electric heat pumps like quilts. And there's a second category of customers that is now more relevant to us than ever before, as especially the US moves towards electrification mandates, where they're simply making this decision because of the rational economic choice. It's not economical for them to have a gas-powered vehicle anymore. It's not economical for them to have a fuel oil-powered HVAC system anymore. And SPAN enables them to make that transition incredibly seamlessly and cost-efficiently.
So one significant bottleneck for electrification that I've written about is the workforce. And a lot of places, there are simply just not enough contractors equipped to install a lot of this new technology. So I'd love to hear from each of you about how you've dealt with that or are thinking about that. Arjun, you said you work with some companies like Mitsubishi. Do you work directly with contractors, or do you do any training, or how do you sort of ensure quality control on this product?
Yeah, this is perhaps the largest challenge and therefore the biggest opportunity for us as we think about scaling electrification solutions. The technologies are out there like Quilt and SPAN. The demand is out there. Customers make rational choices, but fulfilling against it is going to be complex because this is an installation that often requires a licensed contractor to do the work. And that ecosystem is relatively small. We work with contractors that are solar contractors, electrical contractors, now increasingly HVAC contractors as well. And we work to build an installer network where we can train them on how to both educate customers about the technology and to be able to give them a very high quality customer experience in terms of transparent pricing and very simple installation. So our installer network is continuing to grow, and we partner with the right combination of distribution players as well as technology players to bring the solution to market to the contractors.
When you got into this business, was that something that you were prepared to kind of deal with?
Absolutely. I think for the last 5 years since I founded SPAN, we've maintained that there are sort of three legs to this tripod, right? Technology, demand generation, and fulfillment. Fulfillment being entirely the contractor ecosystem or the deployment ecosystem that's required to get these solutions out to market at scale.
And Paul, I know Quilt isn't on the market quite yet, but is this something that you guys are thinking about?
Yeah, absolutely. And in fact, we're trying to get ahead of it. So we have also already started building an installer network and have made some announcements around this, but have partnered with three really, really great installation businesses that are sort of growth oriented and very progressive, thinking about how they're going to get labor and talent into the industry. And it's very, symbiotic because we can give them sort of the differentiation of the product and training and some access to these digital consumer journeys that I was speaking about before, that the type of people we have at Quilt are good at making. We've been making things like that most of our career. What we haven't been doing is frankly installing heat pumps for the last 20 years like these folks have. So we can partner with them to provide that part. They can provide their expertise and we can grow together. And so we are looking for sort of really forward-looking partners that we want to go deeper with versus rather than trying to say build 100, 100 partners out of the gate that we have very light touch with. There's also something really interesting that we've discovered in this market is that in some ways, the labor market has a marketing problem more than anything. Meaning, if you want to join an HVAC contracting force, the barrier to entry is quite low. There is licensing, but the more senior people at the company need to be licensed, but you can learn the skills on the job and then get licensed after working. So I think part of the issue is frankly, it's just not as sexy as a job as some others out there, and people just aren't considering it when actually they are good careers. Like you talk to people who've been doing this for a decade and they're making six figures and they're doing well and they're like, so, and I think an analogy here is I suspect there's a lot of people who are excited to go work at a gigafactory who weren't interested in working at a plant in Detroit 30 years ago because of sort of the brand around the industry and the excitement. So I think we can help drive that attractiveness on the labor side as well for the whole industry.
Yeah. So and when it comes to this, building relationships with contractors and sort of these networks, are you guys focusing on any areas geographically? Like, are there particular parts of the country that you're focused on?
Yeah. So when we started rolling out the SPAN product about 2.5, 3 years ago, we were initially focused on what we call the solar states, right? Places where the adoption of solar and therefore by extension adoption of storage and EVs were fairly significant. So you can think about the western coast of the United States all the way to the south and the southeast. As we've been launching into more products around the home comfort space, including the fuel switching from gas-powered heating to electric heating, the Northeast has become an increasingly important market, and we've been investing in building out an installer network there. To echo what Paul said, right? These are very attractive jobs for a lot of people across the country, and oftentimes these are generational jobs. There are a lot of people that have been doing this for decades now, and what we try to do outside of helping them understand the technology is give them the tools that they need to be successful. A simple example of that is when we work with electrical contractors that are part of the SPAN network now, we give them the ability to maintain their credits, education credits required to keep their license active year on year through our portal or through our app, right? So I think it's not just about trying to push them towards a new technology, it's bringing them closer towards what I think they care about to be successful as installers.
So I wanted to move on and talk about the Inflation Reduction Act. As many people watching this probably know, this is one of the biggest things that happened in the last year for climate tech, and it included a ton of subsidies for electrification, what we're talking about today. And these subsidies will be around for about 10 years. So I'm kind of curious how that changes things for each of you, because, from what I understand, your companies existed before this legislation was out. Yeah. So Arch, let's start with you. The Inflation Reduction Act created a new tax credit for electrical panels. So homeowners can get, I think, up to $600. How much does SPAN's panel cost? And how much does this sort of help get the product out?
Yeah. First, I'll start by calling out that the Inflation Reduction Act is easily one of the most forward-leaning legislation that we've seen come out in the last 20 years from any government, let alone the U.S. government. And the Department of Energy has been incredible to work with in moving the ball forward. The Inflation Reduction Act has two pieces, right? There's the tax credit piece, which is what you called out just now. There's a $600 tax credit that anyone is able to access today. And separately, there's a cash rebate specifically designed to motivate low and moderate income households across the U.S. to also take this necessary step towards decarbonization. Our panel costs $3,500 retail today, which is actually fully covered by the Inflation Reduction Act if you're a low-income household. It offers the Inflation Reduction Act offers a $4,000 cash rebate to a low-income household and a $2,000 rebate for a moderate-income household. What's lesser known and kind of ties back to your previous question is as an installer, you can get an additional $2,500 of a cash rebate for the labor associated with installation of said panel. So by any measure, if you look at it, the demand is there if you're able to educate homeowners about the benefit of these technologies. We just have to find a way to get it out to customers in a hurry.
And do these programs change anything about your approach in the coming years? Like, do you have plans to expand into other products or other ideas?
Yeah, absolutely. I think it's probably a defensible statement to make that this has pulled forward our addressable market by at least a half a decade. We were on a cost curve, if you will, that would have unlocked new segments of the market in the future. But we're pulling that forward to say we now have to have solutions that not only solve for single-family homes in the handful of states we described, but also solve for multifamily residences, potentially even small commercial. And when we think about solutions as opposed to point products, we're not just building a panel anymore. We're building integrated solutions that we can bring to market, be it, again, resiliency solutions with batteries, home charging solutions with our EV SEs, or home comfort solutions that pair heat pump, air conditioning, and heat pump water heating solutions. That's directionally where we're going.
And how about you, Paul? There's, of course, lots of incentives for heat pumps. What does it mean for the launch of your product?
It hasn't changed that much. We're trying to get to market as soon as possible. We want to make as much impact as soon as possible. This is an accelerant. I think it does, to exactly what Art said, it expands the addressable market. I also think it's a great signaling to the market and consumers that this is to stay. Whether it's Quilt or any heat pump, it's a new technology, and I think it's a vote of confidence that this is going to be the way forward to the average consumer who maybe isn't familiar with the term. Heat pumps are actually been around for a very long time. So in other words, it hasn't really changed our strategy, but I think it has just sort of added fuel to the fire. Quilt is a much younger company than Span. We're not in market yet. This is why, I showed you a Mitsubishi unit up there. In my own office, I don't have one here because we had one from before, but we do have them in some other homes. But yeah, we'll be in the market next year, hopefully right at the same time that these incentives are coming to market. So
yeah, if I can actually put in a plug for the heat pumps, right? There's a $8,500 rebate that you can collect if you're a low-income household for making that switch to heat pumps as well. And the really neat thing is you don't have to strip out the existing ducted heating system you have in your home. You're just installing a new solution that displaces ostensibly much of the need for you to use a gas-powered heating system in your home. So we're incredibly excited about the future of electrification.
Well, I think we're just about out of time. Do either of you want to just share any closing thoughts on, our new relationship with electricity moving forward?
Yeah, I'm happy to go first. I think we've been on an incredible journey trying to bring the cost down of renewable energy, right, since the beginning of the century. And that has meant that we have more affordable sources of clean energy, either powered by the utility or decentralized sources of clean energy like solar on your roof. But it doesn't change the fundamental fact that if your appliances are powered by gas, those electrons are not displacing those gas molecules, right? So the only way for us to truly shift towards a decarbonized future is for us to change those end demand of fossil, be it the cars we drive, be it the way we heat our spaces, our water, or cook our food, etc. And that's why I think this is our decade to decarbonize through electrification.
Paul, any closing thoughts?
Yeah, I just want to say how cool this is as a species. So fire goes back a million years. Homo or sapiens is only about 300,000 years. So we've actually been using fire to heat our homes, cook our food, bring light to our homes for longer than our entire species has existed. And that's not an exaggeration. So if we can successfully complete the transition that actually started in the 19th century with the light bulb. If you think about fire produces light, produces heat. So we fixed the light thing about 150 years ago. We're now working on the heat side, whether it's to cook, water, HVAC, whatever. We're going to complete a transition that is truly like a species level transition. It will be the first time in the entire history of humanity that we're not using combustible fuels to power our lives. And I just think that's an incredibly cool thing that we can all be a part of. And I don't know what more you could ask for. So let's get it done.
Well, thank you both so much for being with us today. Thanks to SOSV for hosting this event, and have a good rest of your afternoon.
Before I introduce the next and final session for the day, I want to make sure you know that we have a live startup competition starting at 2 p.m. Pacific, 5 p.m. Eastern that features 5 incredibly interesting companies in the carbon capture category. We worked with our partner Extreme Tech Challenge to attract nearly 70 applicants for this competition and brought in a crack team of evaluators who helped whittle it down to these final 5. They will pitch our 4 judges: Sophie Purdom, co-founder of Climate Tech VC and founder of Planeteer Capital, Andy Golok, a principal at SOSV's Hacks, and legendary investor Bill Tai. Be sure to get over there and judge for yourself. It won't be easy, as each of these companies has their own very distinctive take on CDR. You can find the competition listed as a session in the schedule. And now back to the main stage for our next session. Better Call the Specialist, VCs and Climate Verticals. Until recently, climate tech was either called clean tech and often bundled with impact investing or buried within various categories and tech stacks. But since 2020, interest and investment in the category has surged. More VCs than ever branded themselves as climate tech specialists, and many went further, focusing on just one or a very few sub-verticals. In 2022 alone, 198 VC firms qualified for CTVC's list of the core group of firms actively investing in climate tech VCs, up from 177 in 2021. So you might ask yourself, what do vertical specialist climate tech VCs know that generalists don't? What are the benefits of specialization for their firms and portfolio companies? And what are the challenges of being so focused? Our moderator, Katie Fehrenbacher, has been a journalist covering climate tech for over 15 years and is currently the climate tech deals reporter for Axios. She formerly worked for Fortune, GigaOM, Red Herring, and GreenBiz.
Hi there. I'm excited to be here. I write Axios' Climate Tech Deals newsletter. It's a subscription-based newsletter. I started covering clean tech back in 2006 when Silicon Valley first started investing in it. Today, we're going to be talking about category specialist climate VCs. You know, there's the argument that, climate is everything, so broad and covers so many aspects of society that investors need some kind of specialization to be able to go deep in the sector. At the same time, investors who fund across verticals say there are benefits to leveraging more diverse technologies across their networks. But we're going to dig into all the nitty gritty on the potential benefits or some challenges with specialist climate tech VCs. And today we're going to be chatting with a group of investors that are leading funds across agriculture, buildings, and oceans. First up, we've got Rob Leclerc. He's the founding partner of AgFunder, which is a decade-old firm that's one of the most active in food tech and ag tech. They've backed companies like MycoWorks, Kula Bio, CH4 Global, and Rob has a background as a scientist and engineer. We've also got Kate Danaher. She's the managing director for S2G Ventures Ocean Fund. The S2G is a firm out of Chicago, and the Ocean Fund, launched in 2020, I think it was, is a $100 million fund to invest in tech around oceans and seafood. They've backed companies like Brilliant Planet, Avant, and SoFar. Kate has expertise in food ag financing. She was previously the chief lending officer at RSF Social Finance. And finally, we've got Greg Smithies. He's the partner at Fifth Wall. Fifth Wall is the largest venture capital firm focused on tech from the global real estate industry. And they've backed companies like SolarCycle, Aurora Solar, and Blend. So I'm just going to jump right into it. What are the biggest benefits of raising funds from category-specific climate tech firms? Why don't we start with you, Rob?
Okay, sure. I'd say one of the biggest benefits is that, we get to see a lot of things and some of the patterns are going to hold the same, and it's going to be different from something like enterprise SaaS. And also I'd say at least from my standpoint, the entrepreneurs we speak with, we're generally operating in the world of atoms, and we need to understand that. I've come from a scientific background, and a lot of the founders I speak with have PhDs, and they're really able to connect with them at a technical level is both important sort of to build trust and really understand what they're working on and how to help them forward, and then also how to help them tell their story better sometimes and raise capital. So,
yeah, Kate, what do you think?
Along the same lines, I think specialized underwriting it can't be overvalued in this sector. I think that there's a lot of, to Rob's point, pattern recognition, especially in these emerging industries, is really important. And it's not always easy to see when we're only, AgFunder is a decade into this and is one of the earliest. Pattern recognition just takes a lot of reps and seeing it over and over and over again. And pattern recognition is a great benefit to the companies, whether we're sitting on boards and helping them think through their unit economics or helping them think through validation to scale and how they do that. I think it's really important. And the last thing is also I think syndicate risk is something that we all have thought about in the past, like how we bring in and crowd in capital to help our companies grow. It's gotten easier in ag, I think, over the past few years. Like oceans, for example, is still relatively like nascent and niche. And so having those relationships built out that you can call on to support your companies, I think is something a specialized underwriter can do.
Yeah. So some of the benefits, kind of mainly you talked about for the startup's sake, are there benefits for the LPs? I mean, are the returns better? Do you guys have any details on that?
Yeah, I can maybe take this one. I think that there's definitely much better returns. Well, actually, the SEC says I can't say there are better returns. There, in theory, should be better returns here for the LPs because especially with these sorts of companies, meaning they're atoms, they're manufacturing companies, there's science involved. Typically, that means two things. One, they're probably going to build factories at some point in their life cycle, or go and build manufacturing lines. And two, their products are typically project financed when they go out there. So think of like batteries going into the grid, or solar panels going into the grid, or things like that. There's project finance involved in actually pushing those products out to market. Now, what that means is you've got a very complicated capital stack that can go into how you finance a factory and those projects for the deployment. If you do this the dumb way, which is, just using venture capital dollars to build factories, you're probably crushing your LP's returns because that's not the most intelligent way to do it. There are pools of capital out there like project finance debt, there's MES, there are grants, there's loan program office stuff from the DOE. So people who are specialists in the space are really a lot more sophisticated at getting those other pools of capital here, which means you're taking less topco dilutive equity as a startup, which is better obviously for you as a startup founder, but also better for the returns for the entire company and therefore for the LPs.
What are some good examples that you could show? I mean, I know Fifth Wall has backed a lot of startups in the space, kind of building technologies. But do you have one or two examples that you want to highlight about how the specific vertical has helped them from the funding aspect?
Yeah, absolutely. And this one is topical because I think actually the news is out today. One of our portfolio companies is Sand Elements. So they recycle lithium-ion batteries, raised $452 million today. That is on the back of them getting an infrastructure bill grant for $480 million earlier on this year. So when you look at a company like that, right, you're building massive gigafactory scale recycling facilities. Each one of those, rough numbers is like $1 billion. If you went and raised $1 billion of straight topco equity capital, that would be very punitive to the management team and everybody's returns. Whereas instead, what that team has really been able to do with our help and the help of the other investors around the table here is first go and access the quote unquote free money. That was the infrastructure bill that gave them $480 million in a grant. That is about as good as you can get in terms of non-dilutive capital. And then this topco equity, the $452 million today, but we're still going out there and exploring actual sort of project finance, meaning project debt type stuff. So when you look at these companies that need to get billions of dollars of capital into the ground, you don't actually need to raise billions of dollars of topco dilutive equity. There are other pools of capital out there like that.
Yeah. And just to poke at your argument just a little bit, kind of what would, kind of Fifth Wall is in the kind of building and built environment, like how would that kind of give, something like Ascend an edge to kind of have your vertical expertise, like with that growth? I mean, to play devil's advocate, like a firm that invests across would also be knowledgeable about, private project financing and kind of the other types of capital. So like, why would it benefit them to have kind of you guys in their corner?
Yeah, actually, two layers here. One, specifically to Sand Elements, where we see this in many of our portfolio companies. So we've got about 115 corporate partners around the world in and around the real estate and construction space, right? So that's in 17 countries. I think we account for a third of all the homes built in the US, for example, and I think 2 million apartments and 2 million hotel rooms. It's kind of ridiculous numbers. When you think of where are all of the batteries in the world going to go? Around about a third of them are going to go onto buildings, right? They're going to either be on the side of a building or a house powering it, or they're going to be nearby, in a community solar or utility grid type thing. So think of it as a third of the batteries going into the built environment directly. Where are all the dollars going for batteries in terms of investment? They're all going into EVs, right? So we've got a massive mismatch here of not every, but the vast majority of the investment dollars out there are steering battery companies to just chase the EV world, where it turns out that a third of all the batteries are going to end up in buildings. Those are our corporate partners, and where we can arrange those offtake agreements to go and put those batteries into, say, the 380,000 houses that our corporate partners build every year, or the 10 billion square feet of commercial real estate that we've got.
Great, thank you. Do you see any challenges or do you see any benefits that some of your partners that are investing across verticals are having that climate-specific ones or not?
Yeah, I mean, I can jump in. I mean, it's a little bit to my last point, right? I think due diligence is extremely challenging for some of the generalist investors. Both they don't have the network to be able to properly due diligence. Even if you have some expertise in it, we typically pull in sort of some of our founders, other people in our network, corporate partners who have some really deep understanding as well. I mean, we build and persist relationships in a very particular area for very particular types of companies. And that's sort of more difficult when you're a generalist. You can't have relationships with everybody everywhere all the time. And those relationships can be, extremely valuable as sort of partnerships or investments or even advice.
Yeah. Sorry to rephrase. Like, do you see any challenges for vertical specific funds that, maybe the kind of the more generalists have a leg up in some way? I mean, do you see any?
Well, I mean, there's I would say some sectors get hot, right? I mean, we look at AI and people are asking us what we're doing in AI, and we're just not doing much. We're maybe in the world of robotics, we can see some interesting things that intersect there. But if everyone wants to be in AI or wants to be in crypto, maybe the LP dollars dry up a little bit or get allocated in other areas. So it can be sort of challenging to, certainly on the fundraising cycle, to fundraise against that. And certainly if certain areas are hot, it may inflate other areas. I mean, we're not software, right? But entrepreneurs may see software valuations and start to think in those terms, particularly when they may have some upfront capital. So there's certainly some challenges.
Gotcha.
I also think, if I can just add one more thing, I think check size can be a big differentiator. For a lot of specialized funds, we, on the average, are smaller than the larger generalist climate tech funds. And so their ability to either write larger checks or their ability to follow on with different pools of capital that they have is an advantage that they could have over a specialist fund. But that's why specialist funds and generalist funds need to be working together, because we need to bridge the capital stack.
Great, thank you. Kate, I wanted to dive in with you. Kind of, what are the technologies in your in ocean and seafood that you're most excited about investing in right now? I know it's the kind of more nascent space that I don't know a ton about, so I'd love to hear about what you're excited about there.
Yeah, I think, I referred to it as a nascent space earlier. There's certainly not a lot of capital going into the space right now, but in terms of the potential disruption of existing industries, it's just a huge opportunity. I mean, if you think about 80 to 90% of goods travel the oceans. There's oil and gas has been there for a long time, but there's also emerging renewable energy opportunities. There's shipping, seafood. There's a lot of very large industries that are being forced to think about how they adapt or mitigate the impacts of climate change on their business. And so the things that we're really excited about some of the decarbonization work happening in the maritime and seafood industries. There's enabling technologies that allows shipping to be much more efficient. And efficient in the shipping industry is usually like fuel savings. That means a lot to a big shipping company. So there's a really strong business proposition for doing that. So we're excited. There's also a lot of regulation, especially in Europe, happening around carbon emissions for shipping. So there's just a lot of good tailwinds going into that space. And the other one, I guess the other two I'd say is, one, we're really interested in the plastic problem in our oceans, and we're really interested in trying to solve it further upstream around material sciences, new materials that are not plastic, enzymatic solutions that can dissolve microplastics, or a company that we invested in we just closed their Series A, is called Matter out of the UK, or a group out of Dyson that makes a microplastic filtration component that can be integrated into washing machines and eventually can go to industrial scale. So actually like capturing 90% of the microplastics that otherwise would flow into the ocean that currently make up 30% of the microplastics. So that, and then I get the last thing, and this is nascent in our base, but the ocean is one of the biggest carbon sinks on the planet. And it has the opportunity both through natural processes, but also like accelerated technology to really sink and capture a tremendous amount of carbon. There's a lot of research happening and a lot more needs to happen to scientifically like ground truth, what's possible, but it's a really promising area for decarbonization.
Interesting. Thank you. Greg, I want to jump back to you. What do you see as the most exciting space in the built environment?
So we kind of see the world through the lens of a building. Shocking. So buildings start out as raw materials, right? And construction uses about 40% of the world's raw materials, which is a shockingly large number. But here, think about clean steel, clean glass, clean concrete, those sorts of things. They're boring, but they're all massive markets, right? You know, the concrete industry is an $880 billion market, for example. Next step, we kind of look at things that go into how do you put up buildings faster, cheaper, because frankly, we just need more houses, right? But then also better for the environment. So we would love if all of those new buildings being built are passive house standard, are net zero to run, things like that. I think the last numbers I saw is that the world is constructing round about one entire New York City every single month at the moment. So again, crazily large markets. So here we look at technologies like prefab construction, modular, 3D printing, things like that. Then we get into the life cycle of the existing buildings and how do we operate them. And this is where we collide with the energy transition. So this is take your existing buildings, and in terms of efficiency, we've got $362 trillion of buildings out there, and on average, from an efficiency point of view, I think the technical term would be that they're crap. And so how do we retrofit them with heat pumps, better insulation, better doors, a lot of boring stuff there. But then also on the energy transition side, those should all be energy assets, right? Put solar on all of those roofs, battery on the side of the building, EV chargers in the parking lot, right? We've got, the average gas station in America sells about $1.5 million of gasoline per year. That's just the gasoline, not the slushies. And that is revenue that over the next 10-ish years is going to move from the oil and gas industry to whoever's got the nearest EV chargers, right? And that's your parking lot at the shopping mall, it's your parking lot at your apartment building and at the office, right? That's hundreds of billions of dollars that's reallocating from one industry to another. So there's a massive, massive reallocation there, which is very exciting. Then we hit end of life and recycling. About 40% of all of the materials in the world's landfills is building rubble. It's kind of crazy. It would have been awesome if we had reused that, right? Or maybe not torn those buildings down. So we look here at recycling, turning the waste going through the buildings into energy and stuff like that, as well as recycling water. Then final piece of the puzzle is actually climate resiliency, which hasn't necessarily come up so far, but we see this very acutely in the built environment because the joke I always make is buildings are worth less if they're underwater or on fire. You should check my math on that. And so here we look at a lot of technologies, be it from financial products, better insurance and actuarial models to understand wildfire risk, all the way through on the other end of the spectrum to actual physical protection. So think seawalls to stop those tidal surges, or paint that can stop a building burning down in a wildfire. So really, we do look at that full spectrum. And then the hottest areas in here are honestly, it's wherever IRA dollars are flowing, right? Because we've got hundreds of billions of dollars of stimulus money flowing into many of these spaces, like the battery stuff and the EV charging, for example.
Yeah. Rob, just a kind of quick one from you, where you see the kind of hottest food and ag tech startups and innovation.
I mean, I think, on the climate side, right, we've got just an incredible ability for an opportunity for the Earth to capture tremendous amounts of carbon. And so either through like enhanced rock weathering or some other type of chemistry, but then also leveraging biology, which is incredibly scalable in a way that maybe direct capture and heavy equipment isn't. So I'd say that's kind of a pretty interesting area for us. And we're also looking a lot at ammonia, which can both be a reserve fuel for, I don't think hydrogen is going to be a great liquid fuel. I think ammonia would be a much better one. And so we're invested there a little bit, and we'll keep looking at that space.
Okay. I know the climate tech numbers, at least earlier in the year, kind of were looking at the fact that, growth funding had been more challenged, but, now with, kind of IRA dollars flowing in, it seems like a lot of growth companies are getting funded. So, but at least in the beginning of the year, growth was being challenged. And at the same time, startups are kind of trying to figure out how to close deals, taking longer to close deals, and valuations can be challenged in some areas. Wondering what you guys see as kind of the state of the climate tech funding market this year. Are you expecting like weaker numbers for the rest of the year? It was just like a tiny blip for the beginning of the year. Kind of, Kate, what are you seeing in terms of how are you feeling about the climate tech funding market?
Well, I think the money has to start moving at some point, right? Everybody has an investment period, and for most, that's 3 years, and we've kind of been locked up for almost a year. So the money does have to start moving, and we're seeing it moving. I think from the startup perspective, I think that the valuations and the structure is going to stay. So I think people are going to really be challenged on their valuations and kind of resetting their cap table. I don't think that's going to move as quickly as the money will start to move. But I think the rest of this year is going to continue to be hard. But I don't know. I anticipate that towards the end of next year, this year and early next year, we'll see things really moving.
Okay.
And we're seeing it now, right? Like as soon as someone gets a term sheet, there's a lot of people who are willing to tag on to that investment. It's really finding that lead investor that seems to still be what's taking quite a while.
Yeah, I to add on to that, Kate, I would agree with that. But I think you've got a couple of funds out there, ours included, where we're kind of saying that you should never let a good crisis go to waste and really leaning in here. If people aren't out there wanting to put out lead term sheets, we'll do it. And this is public information, but we've led on a dollars basis more climate tech fundings than any other fund in the entire world. And that's not to say that we're a big fund. It's just we are coming in with that lead term sheet to price these things and then bringing the consortiums together. We just, at the moment, the market kind of seems to need someone to just catalyze around to happen, but then the dollars are there once it's being catalyzed, right?
Greg, are you finding that you're having a lot of hard conversations around valuation expectations, or are you seeing that those are coming in line when you're dropping those term sheets?
I'd say they fall into three categories. And Rob, thanks for this question. There's still a cohort of companies out there that are raising money and able to do it at up rounds, almost like it's 2021. Now, they tend to be in the spaces where the IRA cash cannon is pointed directly at them, right? So where the investors are basically almost getting like a $1-for-$1 match of we're going to put in $1 of equity and we're going to get like $1 of IRA money. Those are great. Those companies, no down round situations there. But then there is an entire other cohort of ones where, last round was done at the tippy top of the market when these companies were trading because of SPACs at 20 times forward revenue. And I think everybody here around the table understands that if you're a climate company and you're building factories and things, chances are you should actually trade like an industrial company, which means like 3 to 5 times rev, but more importantly, actually an EBITDA multiple. Crazy idea. I know that most of the venture capital industry can't spell EBITDA.
What was it?
Yeah, what is that? Right. So I think in these situations, we've got rough numbers. I would guess it's probably 50-ish% of the companies at the sort of B and C round out there who they have viable businesses. They're actually good functioning companies. They were just like completely mispriced at the last round. And that's where you're going to have some tough conversations with, let's reset the valuation. It's not because you have a bad business. It's that the world went from 20 times forward revenue to 3 to 5 times trailing. And no one's going to make any money on your previous valuation. So let's kind of reset this down to a place where you as management can still make money and your investors can make money.
What type of advice, I was going to say, what type of advice are you guys giving kind of startups in your portfolio that this is happening to?
Yeah, I think generally speaking, especially for those who priced high, it actually feels like quite a healthy thing to be resetting valuations to a place that feels much more realistic to build kind of a resilient, steady company that can be EBITDA positive. I mean, I come from the lending world originally, so like you don't lend unless there's EBITDA. So I think it's a really healthy thing. It's a painful conversation and it's a painful moment in time for founders and the existing cap table, but it's a good thing in the long run for the company to be able to build from a position of strength and trying to catch up on a future valuation that may never have been the right fit for them.
Yeah, the advice we're giving them is we have pithy sayings for everything. No Diet Coke down rounds, which basically means if you're going to do this sort of a reset or anything, don't do like a little small bridge round and hope you can grow into the valuation, something flat, because the world is never going back to 20 times forward revenue. Like never. We're not going to have 0% interest rates. Well, at least we're probably going to have much bigger problems in the world economy if we have to go back to 0% interest rates anytime soon. And that's what was driving these crazy forward valuations. So if you understand that world is never coming back, then that tells you, no, a little like small bridge round is just a bridge to nowhere. And actually you should do like a heavy-handed push down the valuation as far as possible and reset yourself into this new reality that we're in, because it's going to be like this for the next decade at least, if not more.
It's somewhat situational dependent. Like, we have some alternative protein company investments. I mean, the market's largely foreclosed on that sector. And so for them, I'm saying just like treat yourself as a CPG company, get profitable with the money you have. Don't take any more dilution. And, you can still have a 3 to 5x revenue outcome, but just grow it over the next, 7 to 10 years. If you need a lot of capital equipment, that's another story. If you raised it too high of a valuation, that's another story. And some of the earlier stage companies that didn't blow it out, maybe we're also telling to put on the gas. So I guess it sort of depends on where the sector is. I think where the funding opportunities are, how quick they are, say, to revenue, or how far they are away from revenue. And those sort of capital equipment costs. Because I think when you get into CapEx, there's just fundamentally a lot less investors around who are willing to tolerate that or get scared by it. So you have to be a little more careful.
Okay. We talked a bit about the IRA, kind of where do you see the IRA delivering the most kind of help with the climate tech startups? We're going to wrap it up very shortly for 2024. Greg, I know you've been following it closely. Kind of what are you seeing for the future for that?
Yeah, I think actually just by happenstance, maybe it's more applicable to us than to Rob and Kate, unfortunately, which is actually very, very sad. Frankly, we should be shoveling money into the ag space, for example, and energy oceans. But in our space, there is a whole ton of money for anything to do with EV, and this might be EV battery supply chain. It might be going all the way back to mining, as well as the infrastructure there. So EV charging infrastructure and the renewable energy stuff to go and power all of that. I think most people are aware of that. What people aren't necessarily aware of is these other bills that are alongside the IRA, the Infrastructure Bill and the CHIPS Act, which are all about bringing manufacturing back to America. And so for many of our companies that need to go and build big factories, there are very large dollars in those acts, which people kind of forget about next to them. And so, for example, that's where Sand Elements got that $480 million grant, which was out of the infrastructure bill. So it's great that there are multiple pools of capital here, but they are very much designed to do two things. One is to increase electrification of vehicles, and then there's a smattering of things in there for other stuff like heat pumps and houses. But think of it as like $400 billion for EVs and like $8 billion for heat pumps, right? It's like a couple orders of magnitude difference. But then the second thing all of these acts are trying to do is something that very much appeals to the right side of the aisle. And I think historically, all people in climate have been very good at talking to the left side of the political aisle and terrible at talking to the right side of the aisle. And what is fantastic about these acts is they've actually brought sort of the national security side and jobs side of the climate crisis to the fore. And so people on the left side of the aisle might want to invest in this stuff because it's good for the planet. That's great. but people on the right side of the aisle want to do it because, national security and screw China. And at the end of the day, like, I actually don't care why people want to put the money in, as long as they're putting the money in. And that's the exciting thing about where we're seeing this money come from. They are actually bipartisan bills.
Okay. And we're going to have to do some closing thoughts here now. I know this conversation is about specialist VCs in climate. So kind of what's your final pitch for the startups, entrepreneurs, and other investors in the space? Why they should be partnering with a specialist climate VC? Why don't we go with you, Rob?
Well, why don't we go with Greg? I don't know if I have anything to add. I probably hogged some time there. So.
All right. Kate, do you have any final thoughts on specialists?
Not much more than I already said. I mean, I think right now because the funding hasn't really started moving yet, and a lot of, at least in the ocean space, what we saw is that a lot of generalist investors were moving into our sector at the tail end of 2020 and 2021 because there were great opportunities, there were great valuations, and a lot of the other sectors were very crowded. Those folks really pulled back a lot when the bottom fell out, and they're just starting to come back. But I mean, in our sector, a specialist underwriter and a specialist investor is, they're one of the handful of people who are looking at opportunities. And to Greg's point, we are actively investing because we see this as a moment in time where we have a great opportunity to, reset the chessboard a little bit.
All right. Thank you so much. Greg, you have final thoughts on specialist VCs?
I think specialist VCs are almost by definition, because we tend to be more hardware-y, industrially investors around climate space, going to give you a lower valuation. That is not a bad thing. It's actually a healthy thing, right? And so typically where we see people non-specialists making mistakes is putting software multiples on hardware companies. And as a founder, that is going to come back and bite you at some point. It might not be this round or the next round, but it's going to get you eventually. And it's very difficult, when you've got two term sheets and one is a materially higher valuation than the other, to actually think that far into the future of how this could really hurt you. So as a rule, we're never going to be the high bidders, the specialists here, but we would like to think that that's actually the right thing for you as a company to do.
Great. Well, thank you so much, Kate, Rob, and Greg. Appreciate your time today. And thanks for Ben and the SOSV guys for having us.
Katie, thanks for that great session. It's easy to see why climate VCs might want to specialize. There are so many deeply technical categories within climate tech that it's a superhuman feat to keep up with all of them. Well, folks, that's a wrap for my main stage hosting duties today. We will be back tomorrow with a full slate of awesome panels, and I'm throwing the hosting duties all the way over to the West Coast to my colleague, Dr. Wesley Dang, Program Director for IndieBio San Francisco. Wesley is awesome, and I'm sure you'll enjoy day 2 of the SOSV Climate Tech Summit. I want to once again give a special shout out to our friends and platinum sponsor, Goodwin Law. Thank you for all that you do in support of our climate tech companies. And thanks also to our bronze sponsor, Globalization Partners. I'm Sabriya Stukes, Chief Scientific Officer for IndieBio New York, signing off on day 1 from the main stage of the SOSV Climate Tech Summit.